All right, welcome everybody to day 3 of the 2026 TraderLion conference. The first weekend was fantastic. All the presenters were excellent, and this weekend should be no different. First things first, we do keep this conference completely free. So if you would do your part and help share this resource that we're building, I'd really appreciate it. Again, you can share it with friends, other traders you know, and an easy way to do that is by scanning this QR code and sharing the conference on X. And a huge thank you in advance. Our mission, our goal is to educate traders and help them learn risk-focused methods. And by sharing, you're helping us achieve that mission. So again, thank you in advance. Here's the schedule for today. It's fantastic. First and foremost, we've got market wizard Phil Goedeker discussing the longevity of a trader and becoming a market wizard. He traded $5,000 into 50 million, and we'll be sharing, his process for that, going through a bunch of trade examples as well. You don't want to miss that. Then at 11:30, we've got Pryzby discussing dynamic position sizing, also going through a ton of trades as well, discussing how to apply this most critical part of trading. Last but not least, we've got Clement Ang at 1:25 p.m. discussing trading market cycles and trade examples, looking at this last run as a case study and how you can basically apply it to future market cycles. That will be great, especially for those traders who are looking to catch those moves early and find those market leaders and ride them for their big moves. So again, a fantastic day 3. Let us know in the chat right now who you're most looking forward to listening to, but all 3 speakers today will be excellent. All right, so a huge thank you again to our sponsors. This TraderLion conference is powered by DeepView, TraderLion University, and the Trade Lab. Here's a little bit about DeepView. This is my one-stop shop for screening, charting, watchlist management, idea management. We've got integrated DeepView AI to help you find the reasons behind a move, the catalyst in real time. And we've got so much more pattern recognition, base patterns. And if you're a swing and position trader of growth stocks, momentum stocks, this platform is built specifically for you. Plus, we've got a lot of great things coming down the pipeline, including custom indicators, as well as deeper integrations with the AI, and also journaling and trade analytics. So don't miss out. We've got a special summer sale going on right now. So visit deepview.com for the annual deal. And that link is also down below in the description. As well as the DeepView Summer Sale, we've also got a TraderLion University Summer Sale. So if you found these conferences beneficial and you felt like they've helped your trading, this TraderLion University takes it a step up, and our masterclasses are compressed. They're designed to help you learn what you need to know to get to the next level. We've got the Historical Analysis Masterclass, Trading Psychology Masterclass, the IPO Masterclass, the Swing Trader Masterclass, Stage Analysis Masterclass with Stan Weinstein, just to name a few. And if you're looking to start with just one, I would highly recommend the Swing Trader Masterclass with Oliver Kell. This fully accelerated my trading journey, and I believe it can strongly do the same for you. So definitely check these out. And if you're a student who's taken one of these classes, let us know in the chat what you thought and if you would recommend it to other traders, and we'd really appreciate it. Again, you can visit TraderLion.com/university and use code SUMMER for 25% off any masterclasses. We've also got the High Tech Flag Masterclass with Leif Sarede, and also the Pradeep Bande Episodic Pivot Masterclass, and a bunch of other offerings as well. So check it out and you won't be disappointed. All right, I also mentioned the Trade Lab. This is my educational service where I provide a daily market report with market analysis, theme analysis, and my personal watch list going into the next day. And in addition, there's a lot of built-in education to the Trade Lab, including a building a system course, case studies, where we dive deep into a market leader from the past and distill the characteristics in a webinar format of how we can apply that into the future. We also got a bunch of educational articles and model books included. So if you're interested at all, email richard@traderlion.com and mention Trade Lab conference deal, and I'll tell you a little bit more about it and offer you a great deal as well. All right, so I know I'll get this question. So will this conference be recorded? Yes, you can already actually scroll back on the same URL and, watch me give this intro one more time. Again, this will be available at the same link. So if you loved a presentation today, tomorrow you can go back to the same URL and just scroll back in time. I'll add timestamps as well, so you easily be able to kind of navigate around and jump to where you want to go. So yes, this is recorded. And if anybody asks in the chat, please say yes kindly, it is being recorded. All right, how to get the most out of your experience. First and foremost, I highly recommend subscribing to the TraderLion channel so you don't miss any of the rest of the conference. And also definitely go ahead and download the VIP pass. We just set up the conference resource this past week where we've got all the recordings in there. We're making the slides available as we receive them and additional notes and resources that really tie everything together of this conference. So definitely check that out. It's 100% free. The link to do that is popping up in the chat right now and is also pinned and down below in the description. It's 100% free and helps keep everything you're learning in this conference organized all in one place right there for you. So again, highly recommend downloading and unlocking your VIP pass. Then also throughout today, engage in the chat with others and with the speakers, share notes and key takeaways on X. I saw a few people post last weekend's notes. I'd highly recommend, sharing it, bouncing back and forth, comparing ideas with other traders. That's the best way to apply the material. And then also, like I said, this is being recorded, so feel free to rewatch any of the presentations that you really loved. So those are a few ways to get the most out of the experience. And here's just one more reminder to unlock your VIP pass. The link is down below in the description and it's 100% free. And you can also scan this QR code and that will also give you access to that. And if you're having any issues accessing the TraderLion 2026 conference resource, email us at support@traderlion.com and we'll help you out. All right. So in addition, I did want to mention this, that the TraderLion University not only has fantastic masterclasses, but a tremendous amount of free resources, the ultimate screening guide, the study of historical bear markets and corrections, the stage analysis model book, the beginner's guide to stage analysis, so much material here. So if you're getting started, this is a great place to go and improve your foundation. So you can scan this QR code and it'll bring you right to this. All you have to do is create a free account. And again, all of these are 100% free and organized to help you accelerate your learning curve. So definitely check this out. If you haven't already, we've spent a lot of time creating these resources and they can really help you out if you're struggling. So definitely go ahead and check out these at TraderLion.com. Also, one more thing to mention, in addition to this conference, which is a fantastic resource in of itself. And our mission is to help thousands, ideally millions of traders improve their performance and systems. Each year with this conference, we also try to do something additional good, which is to partner with a charity that helps improve the world. This year, it's a little bit more personal for me because we chose a Parkinson's research cause, the Michael J. Fox Foundation for Parkinson's Research. And this is meaningful for me because earlier this year, my grandmother, Grandma Jackie, passed away from Parkinson's disease, complications of that disease. This is a very negative, obviously, disease. It is a neurological condition that affects your mobility. It affects your, dyskinesia can be a big symptom, your awareness, all that. And it not only affects people who have it, but also their families. So any amount that you can donate would be very beneficial. And again, even $10 is great. So if you've found value in this conference so far, pay it forward with a donation towards a great cause. And the link to that should be down below, right below the chat there. So again, here's my grandmother here, my mother and my aunt. So in her honor, I already donated. I highly encourage you to do the same, so we can help, build treatments and cures for this disease. And thank you in advance. All right. One more reminder to subscribe to the TraderLion channel if you haven't already. We've got great offerings in addition to this conference each year: the TraderLion podcast, the in-person interviews, tutorials, free webinars, and key clips. Don't miss any of this. Subscribe. It's 100% free. Look down below. And if you're not already subscribed, click that button and help us reach 200K. Our long-term goal is to help 1 million traders improve their systems and trading. But in the short term, we want to reach that 200K mark. So you can help us below. It's 100% free. Just make sure you're subscribed down below. All right. And with that, thanks so much for joining us once again. Day 3 of the conference should be excellent. Sit back, relax, get your notebooks ready, and we'll be right back. Enjoy. All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion conference, Phil Goedeker. He is a market wizard, professional trader, and is known for trading $5,000 into over 50 million. And of course, he was featured in Jack Schwager's latest edition of the Market Wizards. Phil, really looking forward to this, discussing the longevity of a trader, how to excel over decades. That's, of course, everybody's goal. So, Phil, thanks so much for taking the time, putting this together, and looking forward to it. Welcome.
Thank you, Richard. Happy to be here. Happy to share some thoughts and insights and hopefully give some people some tips of what they can do to be successful, not just in the short term, but in the long term. So to reiterate what Richard said, my name is Phil Goedeker. My X handle is trade at STL. I have been trading for over 20 years now, over $50 million in profits. Right now, about over $55 million in profits. Anybody that wants to read a little bit more of my story, you can check me out in the recent Market Wizards, The Next Generation. It's a great book. Their stories, mine is okay. Their story's so much better than mine. It's definitely worth $30. It's just a really good book for those that are trying to expand their knowledge. So what I have done, what I've specialized in over 20 years is selling stocks short and writing options. Today, I'm primarily just an option writer. I don't do a ton of active equity trading anymore just because I'm partially retired. But what I want to talk to you about today in this presentation is what has helped me the most, what I consider, my A-plus setups and where a majority of my profits have come from. So what is longevity? What does that mean? What I want to talk about are the steps that I took to make or to have a successful career over, 20 years. My hope is 30 years, maybe even 40 years. So I've been trading 20 years. I've been profitable 19 out of 20 years. I had one hiccup year 3. I lost about $30,000, but I've been profitable every year since then. When we talk about profitability in the markets, I never want to say markets are easy, but for those of us that have traded before, we've traded easy markets, we've traded difficult markets. Back in 1999, everybody was a day trader, making money was very easy, and people made a lot of money very quick. And how many of them were left in 2000 or 2001? Probably very, very, very few. And why is that? It's because, markets sometimes are easy, markets sometimes are difficult. And if you don't have a plan, if you don't have any action plan, then you're not going to really have what it takes to make a career in the market over the long haul. So, when we think about markets and trading are addicting, right? I mean, it's kind of like a video game. Anybody that does it loves it. And especially when you can make money at it, when you have the ability to make big money at it, it's addicting. So it's not something that people want to try to do 2 years or 3 years or 4 years. Anybody that has had success or has success wants to keep doing that. They want to do that 10 years, 20 years, 30 years. So again, it can be easy to make money, in the short term, right? I mean, we could buy SanDisk, we can buy Micron, hold them a few months and we can make big money, but is that a good, solid, long-term plan? So we need to have, kind of what I want to talk about is a plan of action to have a long career in the markets and not just the ability to make money, but the ability to keep money when markets turn south. So, anybody that's traded, we know that markets are cyclical, right? Markets go up, markets go down. And depending on what our style is, there's different times where the markets are going to be easy and other times where the markets are going to be difficult. And it's what we do during those difficult times, I think, that really help, make us or define us as a trader. And what I've mentioned a little bit before too is that, making money, sure, it's hard, but at times it can be easy. Setups can be easy. And we've all heard of traders that can make millions of dollars. I mean, I've personally known traders that have made millions of dollars, some that have made tens of millions of dollars, if not even $100 million, and have given most, if not all of that back when the market turns against them, even in 1 year to give it back. So even though those traders can excel, right, in the short term, how difficult would it be to make $50 million, $100 million and lose all of it, right? I mean, that would be terrible. I would almost rather not even make it to begin with. So again, traders get addicted to the trading life, the adrenaline rush of making money. And what I want to talk about is a solid long-term plan, both in the markets, but in your life, how to handle profits, what to do with, retirement accounts, outside investments, and things of that nature. So, starting at number one is really, I'm going back to when I first got started. Either when you first get started or maybe when you want to trial a different technique or strategy, you have to think of, do you have what it takes, right? Do you have what it takes to just work the long hours, lots of failures, lots of losses, that you have that willingness to basically keep getting punched every single day and just getting back up, just getting punched and getting punched and getting punched. You have that willingness to just keep getting up, keep getting up, keep taking the fight. Because again, that's what I went through. I mean, that's what it took me in order to be successful. Just almost just constant failure for almost 2 solid years before it finally clicked and before things started to make sense for me. So many times for traders, it seems like you make one step forward and then you take 2 steps back. And a lot of people maybe don't have that mentality to just keep saying, I'm going to keep going. I'm going to keep going. I'm going to keep going. But what I've learned in the markets from myself and other successful traders is you have to have that mindset, right? You have to have the mindset of you're going to go at any and all costs to win, right? To figure it out. So, for me, and I'll get into this a little bit more later, I'm a technical trader. I do use fundamentals, but the majority of my trading is based on technical. So, early in my career, and I still do this today, do you have the willingness to look at hundreds and hundreds of thousands of chart patterns or of charts to find patterns? And I talked about this in one of my previous interviews. I don't know who was with, but I've looked over 1 million charts in my lifetime. And now I'm not talking about just my monitors like you see behind me, and I have 50 different intraday charts. I'm talking about individual daily, monthly charts over the course of 20 years. And I've looked at over 1 million of them. And which is pretty extreme. But do you have that willingness to just keep studying, keep going, keep doing whatever it takes? And and I think one thing is that, do you think that research, whether it's looking at chart patterns or whether it's doing fundamental analysis, do you think it's boring or do you think it's fun and exciting? Because for me, I think it's fun and exciting. And I know that might sound crazy to people. Some people may say research sucks, research is boring, research is stupid. I always found it fun because I always found it like exciting that, hey, this could be my new edge. This could be what takes me from 500,000 a year to maybe 750 to maybe 1 million. So I think, in my head, it was always fun to sit at a computer and just do research because you were kind of putting pieces of that puzzle together. Um, Sometimes, the more you study, it can get bothersome, of course, but for the most part, I think if you enjoy it and you love what you're doing, it's going to be easier and more, it's going to be easier to put those hours in front of a computer and in front of screens to be successful. So, the same thing if you're more of a fundamental trader, do you have what it takes to just deep dive into financials and know companies inside and out? Do you know what it takes to research earnings releases inside and out to find the newest, latest, and greatest innovative companies, whether that's NVIDIA, whether that's Micron, whether that's SanDisk, Western Digital right now, whatever it is? Do you have what it takes to just sit and consistently do that? So, for me, and what helped me a lot in my early career was a lot of this work was done on the weekends, right? So even though I would sit and work a couple hours before the market opened, through the entire market day, even after the close for a couple hours, a lot of times during the market hours, it's distracting, right? Because even if I'm maybe not in a trade at every single moment, I'm constantly scanning the market for trades, scanning the market for opportunities, but you're not doing that real in-depth research. And you're really not learning as much as you possibly could when the markets are closed. So again, not that you want to work 7 days a week, but early in my career, for the first 10 years at least, there was absolutely never a weekend where I was not putting in hours on both Saturday and Sunday doing research in front of my screens, trying to tweak my strategy and improve my edge. One more thing is mental toughness. We kind of talked about that. You have the mental toughness to just get in and just keep getting hit, keep dealing with losses over and over. But do you have the mental toughness to deal with a job that has no boss, right? I mean, you are the boss, you are the CEO, and you have to deal with that. Most jobs, right? You're going to have a boss, you're going to have a leader, you're going to have someone that's going to guide you. If you make a mistake, your boss is going to say, hey, try to tweak this, try to tweak that. This is what you need to do. And you're a trader, it's all on you, right? So you have to realize that you are the boss, you are the CEO, you are in charge. So you're going to have to be able to deal, with that. It's kind of another component of, you're not just the trader, you're also the CEO. You're in charge. You have to follow the rules. And Rules is something I'll get into a little bit more, later in the presentation, but it's really important to have trading buddies, right? Because even though you are basically a sole proprietor, a trader on your own, it's important to have trading buddies to talk to that both share and trade your own ideas and your own strategies. But it's also really important to have traders that that might trade a different strategy, right? So you can kind of keep bouncing ideas and strategies off each other, and somebody to kind of maybe I would say cry on someone's shoulder once in a while when you have a big loss, and they're going to happen, right? Somebody to just to talk to, right? Because even though trading's a lonely career and you are the CEO, like I just mentioned, it's good to have other people out there to just confide in and talk to. So mistakes, right? We are going to have tons and tons of mistakes. I've had, I mean, I can't even count the mistakes I make. So when I analyze my trades and when I was a more active equity trader, my win-loss rate was about like 55 to 45. I won about 55% of the time. I lost about 45% of the time, which is barely better than a coin flip. So if I placed hundreds of thousands of trades a year, I lost on almost half of them, right? So you're going to make tons and tons of mistakes. What I think is important is that you learn from those mistakes, right? I mean, mistakes suck. There's no doubt about it. You want to try to move on and you want to try to forget about them, but you don't want to just keep making mistakes if you're not taking something away from those mistakes, right? So mistakes can be a learning experience. You want to look at a mistake and you say, "Hey, I'm not going to do this again. I'm going to tweak this entry. I'm going to tweak this exit, whatever the case may be." So, even though you're going to make a ton of mistakes throughout your entire career, I don't care how great you are. We see some of the greatest traders of all time, even Warren Buffett. He's still making mistakes today, or he just retired, but learn from those mistakes, right? Create something of value from your mistakes to help you improve in the future. So again, work on your entries, right? Work on your entries, work on your exits. I would argue that your entry is your most, it doesn't matter what style of trading you have, your entry is probably your most important part of any trade, right? How you get in, when you get in, your patience, your position sizing and all of that. So you can learn from your mistakes. You can create some value out of them. And again, I think one thing is studying some of your biggest wins and your biggest losses are where you can create the most value. Because I think for most traders, if they look at their P&L at the end of the year, it's going to come from a handful of trades, right? They might have 10 or 15 really big wins. They may have 5 to 10 really big losses. And then they have thousands of trades in the middle that kind of are just meaningless, right? But if you can take your really big wins and your really big losses and try to really glue down and spend hours analyzing these, I think you can really take your trading and your profit and loss to the next level. So, what traders also need to do, think about entries and exits, is that the more trades they place, if you're placing thousands of trades, you probably look at a few pennies here and a few pennies there is really meaningless, right? But when you add it up over thousands and thousands of trades, so those pennies add up, right? So any little tweaking that you can do will help your bottom line at the end of the year. Rules, right? We have to have a set of rules, and I'll get into some more in-depth rules a little bit later in the presentations, but rules are, for me, over the course of a 20-year career, and I think over anybody's career, the most important thing you're going to have. Now, everybody's rules are going to be different because everybody's strategy is different. Doesn't matter if we're going long or short or options, equities, doesn't really matter. We're all going to have a different set of rules, and those rules will change over the course of time. The same rules that I had 10 to 15 years ago don't really apply for me today. I'm going to take those rules and I'm going to constantly tweak them. So, when we think about big companies, do companies have rules for the employees? Of course they do, right? Do parents make rules for their kids? Of course they do, right? So what happens if you break your rules? Well, you get reprimanded from your company. You get in trouble from your parents, and I have heard the saying before, have good rules, but know when to break them. So I don't want to sit here and say, well, I've never broken my rules in a career. Of course, we all might do that, but I think 99.9% of the time you need to have a set of rules and you need to stick with them, because at the end of the day, my philosophy has always been, what is the point of having rules if you break them? And you maybe just break them once a month, once a quarter, a couple times a year, because again, if you break the rules, you know, it can work out for you maybe 9 out of 10 times, but that really, really important rule, that the 10th time could blow you up, right? It could, end your trading career. It could be a devastating loss. So you have rules in place for a reason, and you need to hold yourself accountable to those rules, right? So it goes back to being, you are the CEO, you are the sole proprietor, you are the one in charge. And somehow you need to realize these are the rules. This is why I put them down. And this is how I'm going to hold myself accountable to follow those rules. Because over the course of a career, what I've learned in 20 years, rules are extremely important. And even breaking them a couple times, it might feel good. You say, oh, I broke my rules. I made a little bit of money here. I broke my rules, made a little bit of money there. But that one time you break your rules, it depending on your trading style, could be the end. So it's not something that I would ever recommend doing, is breaking your rules. So,
And Phil, can I jump in with a question just on the
absolutely.
last slide? Yeah, I was curious, for looking at your best and worst trades, is that
Yeah.
something you would do on a weekly basis, a monthly basis? What kind of cadence have you done throughout your career? And also, maybe this is a good
Sure.
homework assignment for everybody watching. How much would you recommend other traders, maybe very early on in their trading when they're still kind of figuring things out? Would you
Yes.
recommend a higher cadence of looking at your best and worst
You know,
trades?
no, that's such a good question. The more you can look at them, the better. I mean, at minimum, if you are really, really lazy, once a year at minimum. But again, it depends how good you want to be. So I would throw that question back to you, Richard. How bad do you want it as a trader? Without a doubt, if I see an A plus setup and I'm trading that setup, let's say this Monday, Tuesday, Wednesday, I finally nail it Thursday, Friday, that next week, am I going back to revisit that setup? Absolutely. Absolutely, because the next A plus setup might come next week. It might come 2 weeks later, it might come a month later. So the more you revisit that setup, the better off you're going to be. So I'm going to get into that kind of in the very next slide, which
Cool.
I'm going to go to, and that is analyzing trades. So to kind of go back to your question, Richard, it took me probably almost 4 to 5 years of trading to really start analyzing my trades before I really had a breakout year. And that's what the second slide is, what got me over $1 million. So, when we think about big corporations, what do? They constantly look at data, right? They're constantly looking at data to figure out how to get to the next level. And again, being that you were the CEO, you need to review all of your data as much as you possibly can. I would recommend once a week, right? Once a weekend. If you're super busy, once every 2 weeks. At minimum, once a month, to go back, look through the data, see where you're making money, see what time of the day you're making money, maybe what day of the week, what setups, and just as important, see where you're losing money. So a quick story here. I'm going to talk about what got me over $1 million. So my first 2 years of trading in college, I was unsuccessful. I lost money for 2 straight years, lost around $3,000. My third year in college, I turned 5,000 into $1 million. This is when I found out that shorting stocks was possible. Now that year, I also went from $1 million down to 500,000 pretty quick, but I ended the year, I wired out 400,000. So I made, right around $500,000. Year two, I made about the same money. Year three, I had that loss. It was either year 3 or 4, but for the first 4 to 5 years ish, I was making around 500,000 a year, 5 to 600,000 a year. And I kept saying to myself, what do I need to do to break $1 million? Right? What do I need to do? Yes, trust me, I was very happy making $500,000 a year. 15, 16 years ago was fantastic money. It's still fantastic money today, but I wanted to grow, right? We want to consistently grow. We want to get to the next level. So I thought, there's two ways to grow. There's two options. I can either take my position sizing and all my A plus trades and just double it, right? Or finally, I'm a slow learner. It took me 4 to 5 years. I sat down, I looked at my tax return, I looked at my Schedule D, and I went through every single trade that I have. And I found the 10 to 12 really big trades, really big setups. And I made 50,000 on this, 80,000 on this, 60,000 on this, 40,000 on this, whatever the case may be. And then I found all these losses, lost 30,000 on this, 20,000 on this, 15,000 on this, 25,000 on that. And I don't even, when I was looking back, I don't even remember those tickers. I don't even remember why I put that trade on. I thought, why did I even trade that stock? If I did trade that stock, why in the world did I trade with that position sizing? I didn't even know it. So my thought is, going into the next year, I am going to take my A plus setups. I am going to increase size, maybe 10%, 15, 20%, whatever it is, whatever I was comfortable with. But I'm going to take some of these losing trades, majority of losing trades, and just not trade them. Say, hey, if this is not an A plus setup, I might trade it because I'm bored, right? Which is another flaw of a trader. I'm bored, boredom trades. But if I'm going to trade it, it's going to be with very small size, very tiny size. And I did that next year, and I broke $1 million. And I thought, it's incredible, right? So, and the only reason I learned that is from going back, analyzing all of my trades to really figure out what I was doing well and what I was doing poorly. And come to find out, what I was doing poorly was going long on stocks. I was still really bad. I mean, I did not have the patience to buy and hold stocks. I had the patience and I had the understanding to find stocks that were overbought, which I'll get into at the end of the presentation, my A plus setups, and I could short those successfully. But if I was trying to buy breakouts or buy reversals or just buy whatever, I couldn't do it. So I just minimized those, cut those out, and bam, my P&L almost doubled the next year. So that is what analyzing your trades, how that really helped me. And that's why it's really important to just say, I'm going to talk about our edge and getting into our edge a little bit further on, but we need to realize, is it worth trading what we would consider coin flip opportunities? Is it even worth it, right? Is it even worth our time? Is it even worth our patience? And if we're trying to learn a new strategy, if we're trying to say, hey, I'm a good short bias trader, but I want to learn how to buy earning winner breakouts, right? Or whatever the case may be. Yes, you can try it. Yes, you can learn it, but do it with tiny size. Do it with size that if you lose money, it's minuscule. It doesn't matter. It doesn't really change or affect your P&L at the end of the year. So again, the biggest thing is stick to the best and forget the rest. So if I could go back and talk to myself 20 years ago, that's what I would say. Stick to the best. Don't trade anything else, because all it's going to do is take up your time and take up, commissions and take up frustration and take up some of your profits. So, trading and focusing on A plus setups is really just such an important way to go. So next, I want to talk about your edge. And what is your edge? And again, how do you find your edge? For the most part, you're going to find it from using the previous slide. You're going to analyze your trades. You're going to know where you're making money. So your edge is going to be different for everyone. And the thing is, I've had probably, over the years, I've had countless people in my office right here showing them exactly what I do. And I go over my exact process and I want to explain and tell everyone, this is where I make money. But that doesn't mean that's how you are going to make money, or that guy's going to make money, or this guy's going to make money. We are all wired different. We are all made different. So, you can follow somebody on X that trades the news, and you can follow somebody on X that trades options. You can follow somebody that buys breakouts or trades commodities. Doesn't matter, but do not try to mimic them. You can try to take their strategy and tweak it into your own, but everybody needs to find their edge, what works for them, what works for their personality, what works for their temperament, right? What helps them sleep the best at night, right? I've shown some traders my strategy back here and they said, oh my God, I could never sleep one night doing what you do. I said, well, it's not, it is what it is. I do it for a living, right? But find somebody's strategy, tweak it, make it your own, but you cannot try to just copy it, because I do not believe you're going to have success doing that. So I've talked about this before. I do think it's a great idea to try and find buddies that have either the same or a very similar strategy to you, because you guys can share patterns, share analysis, share whatever it is. And it's always good to just have someone else out there to, bounce ideas off of and whatnot. So, you want to find your edge. and you want to try to perfect your edge as much as you possibly can. So again, where do you want to spend your time? Where do you want to spend your focus? How do you want to spend your research? For me, it was saying, okay, I know how to trade this parabolic short. I know how to do it. I know that is my edge. That is how I want to spend my time and focus. So I would basically look at that chart, the intraday chart, the 5-minute chart, 50-minute chart, daily chart, monthly chart, yearly chart, whatever it is, all those, and just trying to figure out, the patterns as to where this might top, right? And to figure out how long do I want to hold this on the short side. So, it's important to find your edge, try to perfect your edge as much as you possibly can, because I believe that is where the majority of your profits are going to come from. So I do think it's very important for traders to try to expand your playbook, right? So you can say, hey, I'm really good at this one strategy. I want to perfect this strategy. I want to focus on it. At the same time, it's never a bad idea to say, you know what, this guy's making a lot of money doing this. Let me just think about it a little bit. Let me spend, 20 minutes a day tinkering with this. Maybe it's something I can do. Because depending on the market you're in, you may get into a market environment where, things change and you need to adapt a little bit. So, fundamental and technical analysis. So, I talked about this a little bit before. I'm obviously heavily into technicals, and I've looked at, like I said, over 1 million charts in my lifetime. We all have our preferences. It doesn't really matter. Um, I want to know why a stock is moving, right? So in my career, yes, I want to know the fundamentals. I would always research the companies. I want to know why they're moving, know a little bit of the background. But for me, the most important thing is from a chart pattern, from a technical pattern. And I really think it's important to know, are you a trader or are you an investor? And I would argue from a trading standpoint, the technicals are probably 90 to 95% important, right? Because when I'm talking about trading or day trading, the fundamentals matter, but they don't matter all that much, because we have seen price deviate, grossly from the underlying value. We can look at fundamentals and we would say there's no reason for this stock to be up, 500% in the last 1 week or 2 weeks, and nothing has changed. So from a trading standpoint, I would heavily favor the technicals. From an investing standpoint, obviously, I would want to get into more, fundamentals. So what I did, what has really helped me in the past, is I would have a binder, right? A binder of actually printed out copies of all the charts, what I would consider A-plus setups from the past. I mean, a binder with just hundreds and hundreds of examples that I would just go and review and review and review. So when I saw other examples come up, I could go back and say, hey, I saw that chart pattern or something very similar to that chart pattern 2 years ago. This is how the stock reacted, right? It broke intraday. It maybe peaked at 10 a.m. It reversed on heavy volume. And after it did that, it didn't have a green bar the rest of the day. And maybe the next morning it gapped down, right? So the more you can research and spend time looking at, again, for me, it was technicals, the more it's going to really help you in the future determine what could possibly happen. So that's fundamental versus technical. So adapting, like I talked about early on, it can be easy to make money in certain markets. We heard about, traders making money in 1999. We heard about a lot of traders had record years back in 2020, right? After COVID happened and the Fed released and pumped so much money and liquidity into the market just took off. And a lot of long bias traders made an enormous amount of money. 2020, also into 2021. What happened in 2022? We had a bear market, right? And we heard of a lot of traders giving a lot of money back, again, depending on what your trading style is. So you need to think in your head, you always need to be adapting to the current market environment. So it's not just looking at your setups and looking for A-plus setups. It's also looking at the market as a whole, right? How is the market trending as a whole? The market trending up, market trending down. What is seasonality, right? Seasonality becomes a big play. We know right now, we're in a holiday week around the 4th of July. Seasonally, going into holidays, we're quite strong. Same thing going into, November and December. So think in your head, look for those A+ setups, but always be willing to change and adapt, because the market can change on a fly, at any given time. We have seen the markets go from a sell-off to almost a euphoric bull market overnight. One great example is back in March. Mid-March, we were starting to trend down. We were in the Iran war, and Trump announced, this is one of like 30 announcements, that the Iran war is almost over. And since then, markets just take off. And we went from literally almost a market breakdown to, a bull market that now there's almost no end in sight, and things like that. So, always be looking at the overall market and just never get complacent. So when trends change, just, be willing to change with it. Don't be stubborn. And I think a lot of times people will get stubborn. One example is maybe Palantir. Palantir's had a great bull run the last several years. Palantir peaks, and now it's just been trending lower and trending lower and trending lower and trending lower. How many dip buyers have been out there trying to just catch the bottom? Same thing with Bitcoin right now. Bitcoin, Ethereum, the crypto markets, we see them up to 100, 120,000. We get bull targets of 250,000 at year end, 500,000, a million. And now all of a sudden we're under 60,000, right around 60,000. And you have to have in your head willingness to change, willingness to adapt, because it is so easy to be complacent and say, the bull thesis, or whatever thesis you have, is just going to live on forever and things are never going to change. They do. Things change, and it is just very easy. Again, this is where it gets back to longevity of a trader. Things change, and it's very easy to just give those profits back. That's what you don't want to do. You want to keep your profits, be willing to change, be willing to adapt. And, the news flow can be really key. How do both individual stocks and do the markets react to news releases, right? So if the market as a whole is selling off, and, or let's say we get really good news in the market, really great inflation news, or whatever the case may be, but the market sells off hard. We got to think stuff that, some of these news releases, or some of this news might be baked in, right? So looking at news, reading news releases, and seeing how both the stocks and indices react to both bullish and bearish news can be a key to predict, how the overall market will go. So one thing about adapting, this is kind of going back to adapting. It's a little bit about A+ setups and profit and losses, but know when to press and know when to back off. Not to be a broken record, but we will hit good times in the market. We will also hit weak times in the market. So for me, when things are hot, or things, were hot, I would be pressing. I would have no problem adding more size, taking on more risk. Because again, there are times in the market, if we've traded long enough, we've all been through times in the market where things, I hate using the term easy. I don't want to say anything's ever easy, but easier than normal, right? So we've all traded times in markets that are just easy. Like the money's almost easy. Those are the times you need to press, right? You want to, I don't know if I want to say double down, but don't be afraid to bet big, right? Bet big. And conversely, if you're in a downtrend, that's the time to just take money off the table. Either stop trading a little bit, take money off the table, take the pedal off the gas, whatever you want to call it. That you might be in a slump. The market might be changing, might be a little bit of everything. No matter what it is, stop pressing. Whatever you're doing, just stop, wire some profits out, size down, whatever. Just make sure. Again, it goes back to the initial thought of preserve your capital. I'll get into this in one of my next slides, but preservation of capital is one of the most important things that's helped me be successful over the long haul.
Can I jump in with one more question? Sorry.
Yeah. Absolutely.
Yeah. So obviously it's super important. Like you kind of alluded to, knowing your A+ setup is the market regime, and the big picture is a part of that. When you're going back and studying historical examples, do you make a note of kind of what the market or kind of that environment was like as well? Because that's like an additional context layer that makes something an A+ setup. So I just want to know your thoughts on that. And if you do, kind of when you're studying something, from 2003,
Mhm.
what's kind of your method for figuring out what the market regime was like?
Yeah, that's a really good question. So I always do. I always want to know where the market is, but what is my emphasis when I'm seeing an A plus setup? It's hugely important. Because again, if I'm primarily a short seller, I
Mhm.
know if I'm looking at a stock in, let's say, late November, early December, historically, we are in an extremely strong market, extremely strong seasonal trend of the market.
Right.
I'm going to be very cautious as a short seller because going back, reviewing all my data year after year after year, I know that, hey, these are difficult times as a short seller, right? So it's a fantastic question to know both what the market was doing at that time when I have an A plus setup and what time of the year it was, right? Because
Right.
I have known, going back, analyzing my trades, that I have been sometimes burned in the month of November shorting stocks too early, because when you have a big theme or trend going into holiday time, both Thanksgiving and then pre-Christmas, those trends just go way further than you think is possible. It also happens sometimes in July, believe it or not, July, maybe August, during a dull market, right? Volume is light, people are on vacation, people are bored. We think this little stock can't do this. This little $3 or $4 stock, it could never hit 10. It could never hit 15. And guess what? Not only does it not go to 10 or 15, it might do 20, it might do 30, it might be 4, it might do 40. So such a
Right.
great question to know what time of the market you're in and what year, seasonally where you're at, because it can really change and it can really affect, your trade analysis.
Cool.
Yep. So the next, I'm going to talk about um, compounding versus wiring out. And this is something that, you know, does it really belong in a trading, um, does it really belong in a trading, uh, strategy? I believe it does. Even though I was in the market wizards, and I've made over $15 million, there's people in there that have made around 500 million. Now I wired out every single year. I'm also in paying taxes. Um, so for me, I first had a lesson in money management my senior year of college when I turned 5,000 into $1 million. I thought I was on top of the world. Nothing can stop me. I know everything. I thought in the next few months I want to turn 1 million into 3 or 4 million. Needless to say, the market turned south. My 1 million went to 500,000 really quick. And I thought, holy crap, what am I going to do here? This won't work for me. So I wired out 400,000, put it into the bank, and I thought, for the next 5 years, I've got living expenses. I'm fine. I'm taken care of. So that was my first lesson in money management and wiring out. Now, everybody has to compound when they're first starting. You might start with $1,000, 3,000, 5,000, 10,000. Doesn't really matter. Everybody's going to have to compound because you need to get your account up to a certain level to either make enough to live on, plus put money aside, whatever you think. And you really have to think in yourself, what do you want in your life? How much do you want? How much do you need? How well do you sleep at night? That's another thing. My friend Lance has talked about, he gave up trading because he can't sleep, right? And some traders, that's the case. I mean, you're putting so much money on the line every single day. You don't want anything to affect your health, or you don't want anything to affect your life outside of trading. So for me, I've always wired out. I've literally done it for 20 years. I wire out at the end of every single month, and I put that money and I put those profits into numerous investments all over the place, into land and income producing this and real estate and trust and index funds and CDs and treasuries and bonds. So for me, I will never go broke, right? I will never go broke. I have enough to live on through fixed income the rest of my life. And will I ever be worth $500 million? No. But guess what? I'm okay with that. It doesn't matter. I don't need that. I don't care. I mean, trust me, if I saw a trade tomorrow that could make me 500 million, will I put it on? Of course I would. But, you have to know what you want in your life. Are you willing to be worth, because I've seen this, trust me, I've seen this firsthand. Are you willing to be worth $100 million and have all that money in your trading account and putting all that money at risk every single day and have a 6-month drawdown where that 100 million is now down to sub 5 million, are you willing to do that? I've seen it happen. I've seen traders worth 10 million, 20 million blow up overnight. I've seen people who have owed their broker money. So you have to think, what do you want, right? So again, you have to compound it first, but you need to have a plan, right? That's the point of this talk, longevity of a trader. What is your plan for 10 years, 20 years, 30 years, 40 years? So I had a plan up front. I wanted to fund my retirement accounts and all these other accounts enough where if I ever wanted to stop trading, which I don't know if I will, I'm very addicted to the markets, but I've definitely cut my trading back. I'm at a point where I don't need the money anymore. I don't need the money. I can sleep well enough. And what I really love about wiring out is if I have a drawdown, my trading accounts, to be honest, are less than 10% of my net worth. So if I have a drawdown of 10%, that sucks, right? But it's 10% of my trading account, which is like what, a percent or maybe 2 of my net worth, which is, I don't want to say it's meaningless, but I don't think twice about it. I just don't. I just don't. So, you know, that's really important as to how do you handle drawdowns with large numbers. And, you know, I'll throw Jesse Livermore in there. We all know him. He might be one of the most famous traders of all time. There's so many books written about him. Back in the 1920s and 30s, he made and lost millions numerous times. I forgot what his net worth was at one time. I think it was 100 million, maybe more. I don't remember. I need to read the book again. But at the end of the day, he lost all of it and he committed suicide. And that's a horrible, tragic ending to what was a fantastic story. And his story is not just one. It happens, right? I'm not talking about the part of harming yourself, but we've heard so many stories. I've heard so many stories of people that make so much money, but they lose it. They lose it and it's gone. And you only need to get wealthy one time. And so you need to have a thought process. What do you want in your life? How much is enough? So I love looking at my alternative investments all the time, whether it's now my latest one is private equity and logging into these accounts and seeing where they're at. It's fun. It's fun to just see them grow in a passive, in a passive way where, you don't have to do much. You don't have to manage much. And, you're still taken care of for your life. And again, it helps me sleep well at night, right? I take care of myself. I can sleep well. I don't have to, risk blowing up. So we've talked about rules a little bit. I'm going to talk about the golden rule. So I've been asked this question before, if you could give me one tip, what is one thing? Well, there's not one thing. I've gone through this presentation, several things that have made me successful or I think are successful. But if I could only give one tip from myself, what have I learned the most? It is minimizing losses. It is cutting losses. It is being unstubborn. It is being willing to admit that you are wrong. I admit that I'm wrong all the time. The market is always right, and you are always just following the market, right? So, at the end of the day, traders are risk managers. It's all we're doing is we are managing the cash in our account. And, something that I would tell traders to think about, whether you have $100,000 in your account or $1 million, let's just say we have $1 million of buying power. I think there's so many traders out there that have been trading several years. You have $1 million of buying power and you say, let's buy this stock. Let's short this stock. Let's just, they throw it around like it's just a number. Treat that, think about that money as your last money that you have. If you have $100,000 in your trading account, before you place a trade, think about it as the last dollar that you have to your name. Would you still put that trade on? If it's still just the last little bit or last amount of money that you have. But having the ability to follow your rules, cut losses, take losses is the number one, the golden rule. And I've always used the term paper cut losses. So if you think about a paper cut, how does a paper cut feel on your finger? It doesn't feel good, right? It hurts, but how many paper cuts can you take before your finger has to be amputated? You can take a lot. You can take a lot of paper cuts before your finger is gone. So I've liked that term of taking paper cut losses when things are not going right and getting back into stock. And I think, we've all been there where We say, this time is different. I'm going to let this stock run a little bit more, a little bit longer. And, that's okay. But if you get out of a stock at 10 o'clock, you can get back in 1 minute later, 1 second later, 1 minute later. So, there are times where I have exited losses and just saved myself, just hundreds, just countless money, just hundreds of thousands of dollars, millions of dollars by just having the ability to say, I'm wrong, get out. Your entry was incorrect. Get back in later today, get back in tomorrow, get back in when conditions improve, whatever that is. So, the other thing about taking losses, here's the most important thing. So when you take a loss, you lose money financially, right? It sucks. Your trading account goes down. There's no doubt about that's a bad thing to do. But what traders, I think, maybe don't think about enough is the psychological impact that goes through a big loss, right? I'm not talking about losing 1% of your account, meaningless, right? But when you lose 20% of your account or 30% of the account, what that does to you mentally, I mean, that is extremely tough to make back, because you know what it creates? It creates you going to the computer the next day and saying, I got to get that money back. I got a revenge trade. I see this setup. It's not an A plus, but it's a B setup. I think it's going to work. I'm going to double down because I got to get that money back. And guess what? You lose again. It's a snowball effect, right? So having big losses, psychologically can really burn you, and it can create more big losses, right? We've seen and heard of stories of other traders that's happened to. So that's why it's so important to have your rules, especially when it comes to cutting losses, and follow those rules. Don't let yourself get into a place where, you're in a tailspin and you're just trying to dig yourself out of a deeper and deeper hole, because, you just keep saying to yourself, just get me back to even, just get me back to even. And, unfortunately for some traders, it doesn't happen, right? You dig yourself into a deeper hole until you got nothing left. I've seen it happen. It's a devastating tailspin to be in. So we've already talked about, if you're in a rut, if you're in a slow time, just size down. Size down. It's not the time to press. If you have a goal of making, this much per day, just lower it to just bare bones. Try to make just scraps. Try to make scraps, right? Until you can get yourself back on track, and know when and if you need to take time off, right? You need to reset your brain. And, something that's really helped me over the years is knowing how I feel. And I'll talk about this a little bit and I think the next slide, but knowing how you feel mentally. So when I trade the best, I am trading free and clear of any, I don't want to say mental issues, but I'm not sleepy. I'm not tired. I'm not stressed. I'm not trying to revenge trade. The craziest thing is, when I go back to think of some of my biggest trades, I went into the day saying, if I make money, great. If I don't make money, great. I don't really care. We'll just see what happens. And when I go into the market with that mentality of just, let's see what happens, I have some of my biggest days, right? But when you go into a day with huge expectations, or, you only got 3 hours of sleep the night before, or you're very stressed from, it could be whatever, a breakup, a death in the family, your son lost a sporting event last night, whatever it is, it affects your trading. I mean, it does. It affects your trading. And again, the way you know that is through analyzing your trades. You see your trades, you see you lost money. How did you feel that day, right? How did you feel that day? What did you do the night before? Whatever. It all comes into play. It all comes into, again, maximizing your profit and loss. So, again, my number one rule over the course of 20 years is having the ability to cut losses, having the ability to get out of trades when they are not working. So, the last slide, I talked about this a little bit, in the previous slide. I don't want to spend much time here, but again, there is no doubt that taking care of yourself and how you feel going to affect your trading, right? When you think of a top performance athlete, are they out drinking the night before a game? Are they boozing? Are they partying? I mean, there probably are a few, right? And maybe they can get away with it, but there is no doubt that over the course of a career, I'm very health conscientious. I take my health very serious. I eat right, I exercise, I rest, I minimize alcohol, I take time off. I know my body, and you got to know your body, know how you feel. And I think, and I probably didn't as much in my early 20s. Now that I'm 42, it's something that, definitely I take more serious, but it is true here. The better you feel, the better you're going to trade. So the more you can take care of yourself, the better results you're going to have. It's just a fact. So take care of yourself. You will see it. I firmly believe you will see it in your trading results. So we've gone over all that stuff, the psychology, the thought process, the studying, all that good stuff. What I want to talk about today is my A+ setups, right? So how did I make money over my career? How have I made, over $50 million? What have I looked at? I am looking to short parabolic setups. I'm looking to short parabolic stocks. That's what I'm good at. I've tried a lot of other methods. Tried to buy and hold stocks. I don't have the patience. I'm still trying to learn that. Maybe one day I will. But this is how I've made money now. Again, depending on the market environment, these could be one-day runners, right? It could be something that just gaps up in the morning. Company put out a news release. They're going to partner, it's a company that's been trying to cure diseases forever, but now they're going to go into AI, right? And then their stock jumps up 500%. I'm going to trade that. Okay, I'm going to trade that. And what do? I'm going to go back. I'm going to look at the financials. I'm going to see, I'm going to try to break that company down. I'm going to see how many employees do they have? What is their history? What other PRs have they announced in the past? How much cash do they have on hand? What is their burn rate? Do they need financing? Do they have warrants out there? I'm going to do, and again, after doing this for a long time, I can do that analysis pretty quickly. It doesn't take long, 10 to 15 minutes. And I've got a fairly good feel for the company. Now it comes down to just trading that chart. So I do trade one-day runners, two-day runners, but my top choice, I don't know if you want to call it my A++ setup, would be a multi-day or multi-week runner, because I think they offer an easier mean reversion and better profit and loss potential. So the first one here I'm going to talk about is SMCI, Super Micro Computer. This was over $1 million win for me back in, got to go back there. Was that February of 2024. So what does Super Micro do? They build, high performance servers and storage solutions. It's an AI trade. It was kind of one of the early AI trades. They partnered with NVIDIA. So the stock here, as you can see, this is split adjusted. They did a 10-for-1 split, so it's not as easy to see here. But the stock took off in the 30s, which is, back then it was about the 300s. It went parabolic into over $1,000. And my next slide is going to be an intraday chart, so you can look at that as well. So basically, you have 3 extended candles here. And on the 4th day, it gapped up over 1,000. I believe it hit $1,050, instantly reversed, closed that day at 800. And that trade was a $1 million trade for me. So now I'm going to go into that intraday chart here, and you can see how it trades intraday. Okay. And you can see how, we gap up, we trade off a little bit into the afternoon. The next day on February, it's hard for me to see some of these dates here, but we're gapping up, but it never really breaks support, right? It never really has a breakdown. It will sell off a little bit, but it never really breaks support. So the day before the finale, or the climax, whatever you want to call it, we can see it gap up here again. It does sell off a little bit at the open, but it immediately catches on. There's immediate support, and it trends up throughout the entire day. Okay, so on the peak day, we see that it gaps up again. Okay, so this would have been 1, 2, 3. It would have been your 4th pretty decent sized gap up in a row. And what do we see right at the open? Right at the open, we get an opening shove up, but we get an immediate reversal on record volume. Okay, an immediate reversal on record volume. And that to me was a key to say, hey, let's get involved. Let's get involved. And it is worth kind of getting involved with some size, which I did. I played both. I shorted some calls on this. I bought some puts on this, and I also shorted the comment on this. And by the end of the day, I forgot my exact P&L. It's been a couple of years, but I know this was over $1 million trade for me. Now, Super Micro Computer, if we do go back, this is kind of key. It actually did, a couple weeks later, make a new all-time high about 2 to 3 weeks later, which is kind of unique. A lot of times, the peak day or the climax selling day will be kind of I don't know if I want to say the all-time high, but the high for the run, where this actually did make another all-time high. But after this move, Supermicro Computer has been in a downtrend ever since. So this again for me was an A plus setup. Now we
Oh,
run into
can I jump in, Phil? One
yeah, go
question.
ahead. Yep,
Yeah, go to the previous slide here.
sure.
Did you take it as so that last gap up? Did you kind of start putting on your position as it broke that first 15-minute bar low? Where did you kind of start building your position? Because I assume you kind of added as it started working for you.
Yes, absolutely. So, I wish I had the intraday chart here, like the intraday, like 5-minute chart where as soon as you have that gap up, it started selling on high volume almost immediately. And as soon as I started to do that, I started to scale in. So what I would do, and again, what I would do over the course of my career is I would take a starter, maybe 1/4 size, maybe 1/5 size, and I am adding. Now, some people trade differently than me, but I am adding as the stock is going in my favor. Again, we talked about cutting losses. I don't want to add when the stock's going against me because, again, I want my entry to be right. I want to be green right off the bat. So as the stock is falling, as Super Micro is falling, I'm adding more. And then I'm adding more. And then I'm adding more. Now, I don't want to chase it too far. I think my first short on that was again around 1,015, 1,020 level. I shorted a little bit more around 1,005. I shorted more around the 990s. Do I want to short more in the 930s, 40s? No, I don't want to chase it, but I'm watching that chart and I am shorting more as we're breaking down on heavy volume throughout the move. And again, what you can see going back to this chart is this makes it both good and bad as a short bias trader. But when these stocks break, they break hard. They break hard, they break fast, which means what? You've got to be there, you've got to be available, you've got to be ready for action fast. Because it's like we've heard the term escalator up, elevator down. When there's a rush to the exits, when support finally breaks, it breaks. And it can break very, very fast, very, very hard, as you see right here with Supermicro Computer. So the next is MicroStrategy. We were lucky we had, couple of these in 2024. This was up in November of 2024. MicroStrategy is obviously a Bitcoin play. And, my fundamentals at the time were telling me, MicroStrategy, what do? All they do is own Bitcoin for the most part. They're a Bitcoin holding company. So at this time in November, we had a similar breakout. Bitcoin was breaking out at the same time, but MicroStrategy was breaking out much faster with a much more violent move to the upside than Bitcoin itself. So even though MicroStrategy follows Bitcoin, they have a NAV, right? So at the peak, right here, when MicroStrategy hit around $540, they were trading over 2 times the NAV to Bitcoin. Right? So you think to yourself, why in the world would anyone want to be long MicroStrategy when you can just buy Bitcoin itself for literally half the price, right? So I kind of knew that in the back of my head. That was my fundamental story. But again, like we talked about before, I'm really focusing on the charts. And again, if you look at the situation, it's very similar to Supermicro Computer, where you had 3 big up day candles in a row. You have this 4th day where you gap up. And again, when you look at this intraday chart here, I believe this is a 15-minute chart, you have a big, right after the open, selling on really heavy volume to the downside. And I played this stock very similar to how I played Supermicro. I sold some calls in this stock. I bought some puts. And I also shorted the common. This was another $1 million plus trade for me. And it worked out very similar to Supermicro. Now, the only difference in this stock is that MicroStrategy has been in almost a bear market ever since then. It's just been almost straight down with some fluctuations. MicroStrategy today, I think, is like at $83. But this is something else that I would consider an A-plus trade. Now, I want to go back. I don't want to take long. I'll maybe take 30 seconds. But today, these 2 setups, Supermicro and MicroStrategy, are things that I study and I want to keep a close eye on to know the next time one of these comes up that's a higher price stock with a lot of liquidity, a lot of volume, and that has heavily traded options, I want to I want to study how these trade in the past. So in the next time, I don't want to just, yes, I made $1 million, I made a little over $1 million, and that's a big number, but these had potential to make way more than that. I mean, I could have easily made 5 million on that, 7 million on that, 10 million on that. So yes, I'm happy with how I traded these, but in reality, there's so much potential. There was so much more meat on the bone that I left. So the next time one of these setups arrives, I hope that I'm going to hit them even harder next time. So next time we are going to go into silver. We saw a massive silver bull run in November and December. Just here recently, and again, I tweeted about this. This trade was very difficult. It was a commodity trade. Commodities are not going to trade the same as stocks. They are very wild. They trade, all night. They trade, overseas, and they can be very difficult. So I definitely, I'm not scared to admit that I took some losses on the front end of this. This chart went parabolic. I want to call it almost extreme parabolic. What made this setup so difficult is in its final week right here, it made several moves that you would think that are characteristic of a peak, but it would never give it up, right? It would never give it up until I believe this move was on a Friday. It happened on a Friday. If I remember correctly, Kevin Warsh was going to be nominated by Trump as his new Treasury Secretary. That maybe had something to do with it, but silver gapped down the next day, had a huge gap down, and I did not hit this or trade this nearly as good as I wanted to. During all of its other previous gap downs, it had bounced. It had been a buy time. And not only did silver not bounce, but it got absolutely crushed. Now, some of the reason it got crushed was from the AGQ. It's leveraged silver holdings. They had to liquidate. So there were some reasons behind the massive move in silver. I think silver fell that day around 35%. But again, this is another great example of an A+ setup. And if you want to look at this move, where is silver trading at today? It's trading even lower. So again, this is another great example of you see these extreme moves. And once they put a top in, a lot of times, I'm not saying silver won't go higher 2 years from now, 5 years from now, 50 years from now. I have no clue. I'm sure at some point it will. But during this short-term run, this is the peak, right? This is the peak in silver, and it's been down every day since. We see the same move in gold. Gold did the same thing. We saw a parabolic move back here in October. This did offer a nice mean reversion trade here. Its bigger trade was timed directly with silver. And it offered just a great mean reversion extension pullback, right? So these were two big trades. Again, these were difficult trades because they are commodities, and commodities they are a different animal of their own. I've traded commodities before, natural gas and oil. If we want to talk about parabolic charts, I don't have that one here today, but back in, I think it was 2008, oil went absolutely crazy. Once it peaked, it just crashed throughout the whole year. So commodities are known for kind of their boom and bust cycle, but this is a great example of another A+ trade. So this is another recent one, Beyond Meat. This went crazy several months ago. We was talked about, I believe, the story with this was they were talking about, bankruptcy. I believe, I could be wrong on that, but that stock went from sub $1 all the way up to $7.50. I did not trade the stock. There was a reason for it. My kids had an event at their school, and I strictly chose at this time to go to the event at the school, and I don't regret that at all. It's part of me being kind of semi-retired, more of an option trader now, but this is absolutely an A+ setup. This was part of my bread and butter for 20 years. You see major volume, major liquidity. And if you are solely focused on the fundamentals here, this is why I want to make a real quick point about fundamental versus technical. If you're strictly focused on fundamentals, you could get burned, because on this day two, you could say, holy crap, Beyond Meat is up to $3. There's no way it should be $3. I'm going to go all in. Well, guess what? It doubles the next day, right? It doubles the next day. It goes up another 100%. So as a short-term trader, as a trader, you really need to be favoring the technicals over the fundamentals. You want to know the story, but at the end of the day, the chart is the most important. So, and what you see, what did Beyond Meat do? It gave it all back, gave the entire move back. Okay, this is also the intraday chart. I got it at about Beyond Meat, so you can kind of see how it had that opening shove up the first, I'm going to say maybe hour of the day, starts to pull back, and right here it couldn't hold support, and it just kind of cracks and crashes huge on pretty heavy volume. And again, a lot of these stocks, once you see them break, these big momentum stocks that are almost like a balloon, right? An overinflated balloon. Once you prick that balloon, the move is done. The move is done. It's hard to time that, right? As a short trader, the most difficult thing is timing that top, timing that peak, and you'll never be accurate. I mean, you'll never be spot on. It's very hard to do. But again, once it peaks, it's usually straight down from there, as we see in that example. So next, I'm going to go to CAR, Avis Budget Group. This was from a few months ago. I'm sure there's a lot of traders out there that remember this one. This move started, sub 100, and it went up to $850. This was just an unbelievable move. The fundamental story here was the entire float is held by, I think, two fund managers, and until they sell, the stock will never go down. And you know, and you always want to know the fundamental story, right? You always want to know the fundamental story, but at the end of the day, the price action is what matters. So the stock went just hyper parabolic, and it was one of the best charts I've seen in a long time. Did I trade this? Yes. I was a little more nervous on this because of the liquidity. This was not a liquid name. Even the options had big spreads on it. There were big, spreads on the equity. I made, a little under $500,000 on the stock, mostly trading the options over the stock. Looking back again, when you see this chart, it just looks like the easiest opportunity ever. But when you're involved with it and you have several days in a row here that look like it's going to break down, but then it, holds support, looks like it's going to break down, hold support, looks like it's going to break down, hold support. So sometimes it's hard to really have the conviction to play massive size on some of these names that aren't as liquid. It's still a very good trade, very good setup. This is absolutely a chart I want to keep in my binder to look through and study through in the future. Again, here's an intraday chart. You can kind of get another look at that breakdown. And again, part of my strategy over 20 years is looking at charts on all time frames, okay? Looking at charts on all the time frames that I can, and looking at that volume. That volume is always a big key to me to see, okay, how does the volume look when it breaks down? What time of the day is it breaking down? How does it handle when it hits a level of support or maybe hits a level of resistance? How does it react? So looking at as many charts as you can on different time frames is extremely important. So here's Circle. This is another example. Now, this was an IPO. So IPOs are going to be a little bit different, but this IPO'd around, what is that, $70, $80. Within a few days, it went up to 300, unbelievable. It's just, again, another example of what I would consider an A or an A plus setup. Now this didn't offer as this offered a better almost swing short. If you can hold this short for a few days, or if you can hold it short for a month or two. We've seen what it did in the next couple months. It gave all of that gain back. Again, my overall thesis here is I want to look for parabolic charts, parabolic setups. So again, that's really what I'm looking for. Those are my A plus setups. I'm looking for overall just extreme moves in the market, and again, the hardest part of the strategy is trying to find out, trying to time the top, right? Because if you want to short a day early or 2 days early, as you saw here in a few of these charts, it can be, it's very detrimental. I mean, it can cost you a lot of money because parabolic charts have the tendency to keep going more parabolic. So timing these is obviously the most important. And you have to understand too is always know the float of a stock. Lower float stocks can be easily manipulated. Some of the examples I gave here were now CAR was not. CAR was an extremely low float stock, but Super Micro, MicroStrategy, Circle, they were higher float stocks, so they could not be as manipulated as low float stocks. So again, the biggest key is, start small, add to winners, and look for, watch the volume and look for the volume as a key. So how do I find these ideas? I find these ideas on FinViz. I scan on FinViz. I scan on FinViz, nightly and intraday, looking for overbought parabolic moves. I use the gap scanner. I want to find the biggest, 1-day movers out there, 5-day movers out there, monthly gainers out there, finding what's moving, how parabolic is that chart. So next, you want to look at the history, know the fundamental story. You want to know the background of the company, what they're doing, the flow of the company, their cash position, and the overall thesis as to why the stock is moving. Research filings to see if they need any cash or any financing or any warrants. And again, then you want to look for borrows. Again, as a short seller, something that, is taken for granted. You have to find shares to borrow through a broker, right? You can't just hit the short button and think they're going to happen. Now, in higher float stocks, like the examples I gave, they will be available. On CAR, though, I don't think they were just readily available at any single broker. You have to go out. You have to find a locate, and you have to secure that locate so you can short that stock. So again, that is my presentation. That's how I've made money over 20 years, what I've done to be successful. So I hope some of you guys can take a few, keynotes away from that.
Perfect. Well, Phil, this has been fantastic. I've got a few follow-up questions if you're willing.
Sure. Absolutely.
Yeah, first, for anybody outside of the examples you showed today, if someone wants to study the parabolic short setup, are there any time periods in history or key examples in history that you think are like really good textbook ones where they can start building that chart book of 1,000 great examples of parabolic shorts? Any recs for stocks in particular to study?
Every year is going to have those handful of stocks. You see, I got a few from this year, a few from last year, a few from several years ago. So it's really just researching those years. What were some of the biggest winners of the market at that time? Now, again, they won't be the biggest winners because a lot of them go up and then they end up crashing. So it's year by year, just getting those examples, printing them out, taking notes on those charts, going back and looking at those intraday charts to, try to figure out how to perfect your strategy as best you can.
Cool. And then I'm looking for a little bit more of the nuance about your entry. So let's say it's set up for a short. Obviously these things can happen. It can happen multiple times. Over a span of days, and it can fake you out quite a bit. But let's say it looks set up on a daily time frame, weekly time frame. It looks ready. It gaps up in the morning. What causes you to start trying to test a short position? Is it a break below those opening range lows? Is it a little bit more nuanced to that? Do you wait for the big volume to show up? What are kind of the key things you're looking for to kind of start?
Yeah, sure. No, it's such a good question because, again, I've used the term paper cut losses. If anybody thinks that I trade these and nail that entry the first time, it's maybe happened a couple times in my career. I mean, out of the hundreds of thousands of trades I play. So what do I really look for? It's really just that reversal. When does the momentum break? What is maybe the first sign of exhaustion? I love if you see an exhaustion on big volume, right? Because that means, hey, the sellers are overwhelming the buyers. So if you can get the volume on your side, that's great. But yeah, it's that opening range. Give it some time. Let it go up. Starts to break down. Hit some weakness. Start with that entry, then give it some time. What does it do? How does it react to this? Do you see more weakness? Add a little bit more. Do you see it bounce a little bit, but it maybe can't get through resistance and fail? Then I want to add a little bit more, So it's just starting with that entry, going from there, looking for more weakness. Again, as you've seen through some of these charts, when the weakness comes, it can come very quickly, right? It can come very quickly, very fast. So you just have to be ready for it. So again, when a lot of these stocks break down, it happens so fast and there's so much profit potential. You don't have to go all in at your entry, right? Take a fourth size, add when you got some green to it, add a little bit more when the trade's working with you.
Yeah, perfect. And then for those initial entries, how are you managing risk on that? Obviously, you're sizing into it as it works. That's part of the risk management. But are you measuring risk versus the high of the day with a stop? Are you structuring the options in a certain way to cap that max loss if it turns against you? How are you keeping those losses as paper cuts?
Yeah. Great question. Looking at the chart and chart only, not looking at the options, and just basically saying, what do I consider resistance? Or, what do I consider resistance on this chart? And if it gets through that, if it's going to break above what I consider a range that it shouldn't, I'm usually getting out, or I'm cutting back. Say, hey, I'm getting out half. Give it a few more minutes, 5 minutes, 10 minutes. Does it keep going up? Does it fake you out and break down? And again, this really goes back to the float. If you're trading a lower float stock, those can be so easily manipulated. We've heard about, chat rooms or different individual manipulators on their own, like literally wanting or owning the whole float where they can play so many games. The manipulation doesn't happen as frequently on the higher float stocks, but it's really looking at that intraday chart, having your own levels of support and resistance. And again, this goes back to me looking at over 1 million charts in my lifetime where I only look at price and volume. So I want to say that I don't have any other really indicators on my screen other than price and volume, but it's knowing in my head, looking at these levels, what is resistance? If it's going to get through that, I'm out. I'll look for another entry.
Yeah. You've trained your eyes to understand what does normal action look like for how this trade should progress. Makes
Absolutely.
sense.
100%. Yeah.
My other question was on the profit taking side. So what's kind of your general process for that? Are you waiting until the end of day one of the trade? Is there a situation where you'll hold overnight? What are some things you think about there?
Again, great question. And every situation is different. It depends on the float of the stock. A low float stock, I don't want to hold overnight. We've seen games and news after hours where a low float stock can jump up 100%, hundreds of percent overnight, depending on the news. That's dangerous. It also depends on the cost of the borrow. How expensive was this borrow? What's it going to cost me to hold overnight? It also depends on, I'll go back to super microcomputer. Let's talk about that example. So it's looking at the overall picture, the 3-month chart, the 6-month chart, the 1-year chart, and going back to some of my previous examples, if I have any, of when this stock finally broke, what did it do that day? What did it do that one day? How much did it give up that day? And then also, how did it react the next day? How did it react the day after that? So if I have a lot of profit on the table day one, like super microcomputer reversed at 1,000, it closed at 800. It was $1 million trade for me. I just got completely out. I thought, you know what? I'm out. I'm done. Don't want to deal with it tomorrow. But a lot of times in my career, early in my career, if I had a multi-week runner, something that had run up and run up and run up and run up, a lot of times when these broke, they would go down for weeks at a time. So a lot of times in my career, when borrows were cheap, I would hold them for weeks. I would have no problem doing that. Because again, if you go back to look at Circle right here, look at gold, look at silver, look at MicroStrategy, when they hit a peak and they reverse, that's it. That's the move. And really, it was the same move with Super Micro. It did make a new high 2 weeks later, but since then it's given back, I don't know, 80% of the move. So you can hold a lot of these. Every situation's different, but again, that's what kind of goes back to your analysis of the situation in its entirety.
Perfect. This has been fantastic, Phil. Thank you so much. I have kind of 2 last questions for you. First, any book recommendations for traders out there? And this could be a trading book. This could be anything that you found helpful to you in some respect. You've talked about longevity and how taking care of yourself is really important. So there could be plenty of books along those lines. Any names of titles that come to mind that you would recommend to everybody watching today?
I have a extensive library of books upstairs, and I think back to, if I have people in my house and they say, hey, give me a book, what do I want to look? And I give them the library, say, just take a few books out, return them when you're done. But I tell them the truth. I say, there's almost no book that taught me do this, read this, you're going to learn this style and do this. So I like, to be honest, I know I mentioned I was in the Market Wizards book. I'm not hyping that book up, but I like that series in its entirety. I've read the Market Wizards. I love the Market Wizards, not so much from a standpoint of this is my method, follow my method and follow me and make money, but it's more from the psychological standpoint, learning to cut losses, learning to size into winners, learning how did the big traders make money? That's what I want to learn. So I like that in the Market Wizards series. And again, William O'Neill had some great books about if you want to do the Can Slim, the buy and hold good quality companies, earnings breakout, things of that nature, I think are good. I'll be honest, I've read a lot of books are good. They're entertaining. Did they teach me a lot? No, I love the Market Wizard series more from the psychological standpoint. And when you think about books, and again, not to hype the Market Wizard series at all, but if you can come away from a book or a chapter and just take one takeaway, and I'll talk about Lance's chapter in this most recent book, and I don't have that quote in my head, but it's like, it's not, and I forgot what he said. I wish I had that quote, but it was like, it's not the trade that causes you to lose the money or blow up, but it's the size of the trade, right? It was just, if you can take one quote from different people away and come away with stuff, I find it extremely beneficial.
Awesome. And my next question was gonna be, was there a chapter from the recent book other than your own that like stood out to you or you learned something? So
Yeah,
that's perfect.
I think there are so many chapters better than mine. I loved all of them. Everybody has a different story, and I find it so fascinating. One thing I've always found fascinating is, how do traders make money? This guy's made tens of millions of doing that. That guy's made hundreds of millions doing this. This guy's made whatever it is. So I find it so fascinating to figure out how traders do it, how they've done it, and their thought process and their mentality. So
Yeah.
I liked all of them. Something I found interesting was Simon Russo in his chapter, how he made 500 million, and in his, I forgot what it was called, it was his conclusion or his post follow-up write-up, how he took a drawdown, I believe, of 120 million, which is, he made most of that back in that same trade. I think it was Carvana. I could be wrong, but the point is, I thought to myself, that is why, yes, would I love to be worth 500 million? Absolutely. But how could I sleep at night being down 100 million on a trade? And it's like, wow,
Yeah.
wow. I find stuff like that fascinating. And again, I take little bits and pieces of way of more of psychological stuff than anything else. Of, this is what is going to help you be a trader. And that's the point of this talk today, over the long haul, over 20 years, 30 years, 40 years. I couldn't have a drawdown of 20% or 25% of my net worth and sleep at night. I wouldn't want that stress. So,
Right.
but every chapter is really good. Qualmagi was good. Lance was good. Short Bear's great. All these guys were great. It was really good to just read some of those stories.
Yeah, awesome. Perfect. Well, again, Phil, this has been fantastic. Just like you said, if you get one takeaway from a chapter or a book, it's worth it. For today's talk, for you, what do you want traders watching this to remember? If there's like one idea that you want to really emphasize and get across, what do you want to leave everybody with today?
My biggest thing is two things: cut losses, and I firmly believe in having a backup plan. What is your plan outside the market? We've heard other traders make lots and lots of money. And again, I would love lots and lots of money too. That's why I trade. I like, making money, but it is so easy to make the money, but it's just as easy to lose it by one mistake, one bad streak, one market change. You hear I've heard of so many traders giving back 20, 30, 40, 50, 60, 100% of their net worth. These guys were set for life. They were set for life, in a life that 99.99999% of the world would have dreamt of having. But, I don't know if they just wanted more, or just didn't think about the future, or weren't happy with whatever number they had. Have a backup plan, index funds, whatever it is, treasuries, CDs, cash, funnel money away, because you will retire one day. You will look at your side accounts at one day and say, man, I'm glad I did that. Glad I did that, because drawdowns suck. Losses suck. Losses are how careers end. And as I talked about Jesse Livermore, it's how his life ended, right? I mean, don't end up that way. Don't end up broke. If you're fortunate enough to have a plan, make money, keep the money, invest the money, have it somewhere else, you will be happy you did it. So that is what I think is so important for traders.
Great. Let's all get rich once. That's the goal. Let's do
Exactly
that.
right. Yep.
Perfect. Well, Phil, thank you so much for your time. To
Sure.
everybody watching, I hope you guys enjoyed immensely. Leave a like down below if you did. Subscribe to the channel, and we'll be right back. See you there.
Thank you, Richard.
All right, welcome to the next presentation of the 2026 TraderLion Conference. Super excited for Sheikh Pryzby today. He is a professional trader. He's the author of Pinpoint Trading, and today he's going to dive into dynamic position sizing and really when to push it as a trader, and crucially when to know to step back, because that's where the true performance lies, both to the upside as well as protecting those profits. So Sheikh, thank you so much for your time, man. Really excited for this one. And I think this will, turn on a lot of light bulbs for folks watching this. So thank you so much for putting all this together. I've seen the slides. They're fantastic. Let's go ahead and dive right in.
All right. Thanks, buddy. Again, thank you for having me. What an opportunity. Nothing but great respect for TraderLion. I've learned so much from the interviews, constantly optimizing my strategy based off, grabbing bits and pieces from different traders' interviews and such. So you guys have such an amazing product, and I couldn't be more proud that, I'm a part of this conference right now. So let's get into it, baby.
Let's do it.
And before I start, I'm going to say, last time I was very excited. And I told you before the interview last time, I said, this stuff gets me very excited. I get a little wound up. It's your job, Richard, to slow me down. You did not slow me down. Do you remember what the top comment on that interview was?
I don't remember. What was it?
The top comment was, it's like I'm watching Matthew McConaughey on cocaine. That was the top comment. And I was saying to myself, that's the nicest thing anyone said about me. Yes, but I got to slow it down a little bit. So that's the goal of this presentation.
There's a compliment in there, I think. I think there's a compliment in there.
And, yeah, somewhere.
And you're gonna fit a lot of information, a lot of experience from your years and years of trading into this. So, if people need to slow it down, feel free to do so. But let's get going. This should be fun.
Cool. Let's get right into it. So today I'm going to talk about dynamic position sizing. I'll get into all this, the little nits and details in a little bit. So a little bit about me. I've been a full-time trader since 2013. I'm located right now in Long Beach, California. It's very important for me to say this is not LA. This is not Los Angeles, right? This is Long Beach. We're very proud about that factor. I began as a prop trader at T3 Trading in New York City. I was there for 5 years, 2013, 2018. I came in second place in the U.S. Investing Championship in 2024 in the $1 million Enhanced Growth Division. I founded Pinpoint Trading last year, September 25, but I've been doing the teaching thing for a while now. I had a former business called Trading Experts, which ran from 2018 to 2025. And as you mentioned, I have the Pinpoint Trading book available on Amazon. Let's get right into it. So I'm a big believer that we're all products of our environment. So I came from that day trading pedigree at T3 Trading. And my first boss would always say, risk a nickel to make a quarter. And this guy was like super intimidating dude. He had a glass eye from old Brooklyn, like just an absolute savage trader. He told me, and he told me so much about the market, but you take that ideology of risk a nickel to make a quarter, and you compare that to someone like William J. O'Neill, who's completely focused on weekly charts, and it's just completely differing ideologies about how you're going to treat the market and your positions and your time frames and such. So a big part of my learning process, it was unlearning the bad from the day trading, right? And that's more geared towards expanding my time frame and such, which is something I work on every single year. But it's also keeping the good because, I spend so much time day trading, and day trading, it's not great for long term. There's a saying like, you don't meet many old day traders. My guy Al, he is an old day trader, fastest hands in the East. But so I'm trying to keep the good from that strategy. I was trading 10 to 15 names a day. And in doing so, you're going to learn so much about the physical execution of the game, about the technicals, about when to buy and when to sell. So in transitioning to a full swing trading strategy, I was trying to mesh these, right? And in the first interview, we talked about how I'm from the Dan Zenger ideology. So I was mixing the Dan Zenger, aggressive momentum swing trading along with the entries that, are so profitable in day trading. And lastly, understanding personal risk tolerance. This is something that it takes years to develop, and it's super personal for you. I can't tell you what percentage of portfolio position is good for you. These are things you have to determine on your own over the long term. You learn so much more about yourself year by year. So this is when I began trading in 2013, and the low of the year was January 2nd, 2013, and the high was literally the last day of the year, December 31st. This is the worst market to learn in, right? I was just buying resistance breakouts with a low of day stop. I was selling randomly. And I had no real strategy, and I began trading November here. I joined the firm in October. You do a month of training. This is when I began trading, and into the end of the year is and then we moved on to late 2014 through 2015, not so easy. And this is where I had to really develop a differing strategy from that classic just breakout approach, that ZERP era, zero interest rate, right? When markets were going straight up, every prop trader was just simply buying breakouts. This year happens and about 90% of the firm gets extinguished. And I'm just trying to make it at this point in my career. I'm not sitting there saying I'm going to be a super millionaire off this stuff. I'm literally just trying to pay rent. I have to constantly take money out of my account. And what I do in these times, how I optimize my strategy, I'm literally buying support and I'm selling it 3-to-1, 4-to-1, 5-to-1. There's no trailing. And in this market, that it was like a thing of beauty because there was no trailing when there's just completely chop. The thing about the last 5 or 6 years of trading, we've had such directional markets. And even though 2022 was so difficult, it was a horrible bear market, it was very directional. And if you noticed, October to March of this year, we had that choppy market, similar to this, 15-month choppy market I'm showing you here. And that's what really, really kills traders. So what we're going to get into today is, the dynamic position sizing, but also different playbooks for different markets. And this strategy I'm going to tell you about today is just the pure momentum risk on strategy, where I'm trying to be 150% invested on margin, concentrated in the highest of beta names. We're going to talk about optimizing classic technical analysis, utilizing intraday timeframes, going deeper to recognize external factors. We'll talk about that stuff later. The dollar, I talk about the Kospi a lot in this, and then specific strategy objectives. What are our objectives in risk distribution, name selection? We're going to talk about layers of probability, our objectives when entering, and our objectives in trade management, as well as exiting trades. So caveats for running this strategy: it's got to be a momentum playbook, trending market, indexes respecting a rising 20-day. The trend filter is binary. This isn't feel, right? So I have to see these things out of the market in order to put this strategy on. Strong themes, strong groups, strong earnings, strong outlooks. We want to see leadership. Leadership must be broad. It's not 3 names carrying the tape. And we want to see earnings season tailwinds, power earnings gaps, and raise guidance appearing across the watch list, not in isolation. We want to see that in the leading groups. And then we'll talk about external factors line, the dollar, rates, foreign markets, low VIX. Again, in order to execute this strategy, the VIX has to be consistently low because this strategy relies a lot on moving average trading. The higher the VIX gets, the less moving averages are respected, right? The more volatility there is in the market, the less these perfect little moving average holds come about. You have to understand that. It's understanding the strategy. So, for example, understanding the strategy and when to apply. Here's a great trade I had in ARM earlier this year. Best trade in my career. And you'll notice, here's the day I bought it on a daily time frame. Here's the fast move it made, right, on a daily time frame. Makes that first run. And here's the complete move it made. It makes that fast run up, consolidates, and then gives us that crazy, crazy run. Here's how I entered it though. Again, on this day, I'm buying a 40% portfolio position on this 30-minute pivot right here, just against this little stop at lows. I'm going full size. What you have to understand, in the wrong market, this is going to be a loss. Okay. So it's really about understanding when to turn on the aggressiveness and turn off the aggressiveness. We'll talk about advantages and disadvantages of the strategy. Advantages: over here on the left, you have your sharpest equity curve gains during the hottest market periods, and you have enough size and positions to take profit into strength while still keeping a large enough weighting to capture the macro move with meaningful size. So in that first interview, we talked a lot. We were going through, and I'm very grateful for you to give me that first interview. I do so much deep dives on my members trading and all younger traders and things like that. I never really go 3 or 4 hours into my own trading, right? Yep. And I'm always going to be very honest about my executions. And in that interview, I had such glaring mistakes. And I was doing things that maybe I didn't realize were my strengths. And I was talking about an iron trade, an Oklo trade, where I'm letting these things go early. But really, what I learned about myself is that I'm going to have a higher position size than most. I'm going to trim that into strength so I can have a 10, 15, 20% for the macro string, because that's what I can handle in terms of volatility in these high betas. Again, understanding personal risk tolerance. And earning the right to chill. The big advantage of the strategy, I'm able to sit out choppy periods because I gained so much during the momentum period. Some disadvantage of the strategy: it requires constant focus on discipline, portfolio heat, and positioning. Very costly if applied in the wrong market. You can chop yourself to death. It requires trade and name selection to be A+, and just an understanding of emotional decision making. There's a quote: size kills, right? It's very true. Having too much size in a trade will only increase your emotional decision making. And the number one thing we're always trying to avoid as traders is emotional decision making. So you have to kind of walk that tightrope in terms of sizing yourself. You want to be aggressive with the sizing, but you have to understand you can't botch the trade in doing so. Now let's get into dynamic position sizing. So the goal of this strategy is to enter the trade with first buyers through perfect entries. I was reading this, the New Market Wizards last night, and a great quote I came about from Simon Russo. Relying on willpower and discipline is not noble, it's stupid. The smart solution is not to fight temptation, but rather design system to eliminate it. That resonated so much with me because I used to be that aggressive trader who would have too much risk on, who would be trying to chase names, who'd be entering at the wrong times, get shaken out and see a name move higher and just go crazy over it. And this game is all emotional. We got to realize everything is emotional in this game, and we're just trying to, keep that emotional beast at bay. So I'm utilizing intraday levels and entry tactics in order to have larger portfolio positions. I'll quantify this at greater than 20%, up to 40%, while maintaining strict risk parameters, typically a 0.5% account risk per trade, up to 1.5%. I'm going to have strict name selection rules. Again, risk management always comes first. I'm not going to be applying the strategy in earnings list names like a quantum stock, for example, because those names gap up, and the first thing those companies are going to do is raise money, right? Causing the stock to aggressively gap down. We're always, live to see tomorrow was the first rule I learned in trading. So these names have to have earnings. They have to have sufficient liquidity. They got to be over $10. I'm not really trading small caps. And the strength is it allows profit taking into strength while maintaining manageable portfolio weightings, 10 to 20%. And then price distance from cost on day one in order to mitigate overnight risk. Again, live to see tomorrow, right? I need that distance. I need to be up in the trade in day one to hold that 40% portfolio weighting. I can't hold that type of position overnight because the gap down, I can't, it's just too much of a risk. And when I say 40% portfolio weighting, that doesn't happen very, very often. It's only a handful of names per year when they're screaming at me, and we'll go over a couple examples that I had this year. ARM, Twilio, and JFrog were standouts, and I had these huge positions that allowed that huge equity curve game in a short amount of time. So objectives and risk distribution. We spoke about this in the first interview a bit. I look at risk a bit differently. Systems are judged over the aggregate. I want to optimize that thought process. Meaning, you look at any system and there's going to be times where they have 10 wins, right? 10 straight wins. And there's going to be times when they have 10 straight losses. That doesn't mean when they have 10 straight losses that it's a bad system. It's just a bad environment to do so. So I want to have a hyper focus on the underlying conditions in order to successfully apply this strategy only in the right times, right? And then earn myself the right to chill when the environment breaks. And that comes through that Zanger ideology, which I'll speak about. He has a famous interview from 2005 and some quotes from it. Biggest lesson was to not be in the market all the time, to trade far less than I do. Market may have two big moves during the year. They may last 6, 8, 10, 12 weeks. Other than that, they just exhaust themselves. We're just coming off a run where the S&P went up 10 straight weeks. I pretty much got out of my risk at the top, not saying I'm ready for a bear market, but I avoided that huge drawdown with this thought process in mind. They may last 10 weeks. Other than that, they just exhaust themselves. And we saw that market have that drastic pullback, and high beta stocks got crushed for a few days. Doesn't mean the trend is done. That's what I'm trying to avoid in that thought process. And he says, just trade out, go to cash, have fun, enjoy yourself. So my objectives in name selection. And name selection is 75% of the battle. This is what I've really, really learned in my latter years of trading. You can be the best execution trader in the world. If you're trading the wrong stocks, you're not going to have success. So we're not using technical analysis. One thing I used to do was I used to type up like 2,000 names a night. And I would pride myself on doing this, saying I'm working harder than everyone else, right? And what I learned over time, that's a fool's errand because it made my universe too large, and then I'm not focusing on the best stocks. So now how that has optimized, it's, I'm keeping a tight watch list full of the leaders, and then I'm trying to wiggle in these names using technical analysis. So I'm not trading small caps or earnings list names under the 200-day, names with liquidity and constraints. I want this strategy to be able to build up to a $100 million portfolio. I'm trading higher ADR names. That's where the most, trading higher ADR names. That's where the most opportunity is. If I can have tight risks, I need that wide expansion during the day. We're focusing on the highest time frames first, and we're letting earnings season guide us. And a stock is typically 40% the market, 30% the sector, 30% itself. It's a famous trading quote. Where did it come from? So a study from 1966, Benjamin F. King at the University of Chicago, he talks about market and industry factors in stock price behavior. He applied factor analysis to 63 NYSE stocks across 6 industries using monthly changes in log price over 403 months from 1927 to 1960 in these industries, right? And the core question was, to what extent can a stock's price change be explained as the weighted sum of a market effect, an industry effect, and a company effect? And what were the findings? The findings were that stocks variance decomposes into the market, industry, and firm specific findings. The original findings were it was 50% market, 10% industry, 40% stock. That was coming right out of the Depression era, right? Where, after such a drastic down move in stocks, names are going to trade differently. They're going to be much more a factor of the market when 80% of the market is wiped out, right? As the end of that study went on, the weighting shifted towards that 40%, 30%, 30% that I just mentioned. And the implication here is 60% of a stock's move is decided before you ever analyze the company. You just have to get the market and leading group right first, and that gives us an empirical basis for leading names and leading groups. That's kind of what transitioned that thought process of typing up 2,000 names a night versus I just need to be on the hottest 30 stocks, 20 stocks, and just focus on them and just wiggle my way in however possible. Earnings season is my highest, is where I have the highest activity levels by a landslide. And that's because the opportunity set is highest. So I want the action to pull me in via change of composure. And how I'm researching fundamentals, I'm letting the action tell the story first. I'm such a big believer in technical analysis. They're going to tell you when there's game-changing news, and then we research after. Again, we want to save as much time as possible in researching. There's 5,000 stocks out there. How do I know what to focus on? So I keep a power earnings gap watch list, and you have to understand the power of power earnings gaps is it's usually the genesis of the start of a large move, right? And I want to be in the names with the best earnings growth. They have to have raised guidance because that's future looking, and I want a story being told. So this quarter, I'm going to talk a lot about the software names because at the end of the run, I just killed these names, and it was just like they were screaming at me, right? We see Frog, Snow, D-Dog, Twilio, Akamai, DigitalOcean, all with power earnings gap. When you see a single sector all having that huge change of composure, that's the market screaming at you that there's a massive re-rating about to happen. And what's the story behind that? It was agentic AI. The beginning of the year, all these stocks were killed because of every Anthropic update. And then, they just came back so aggressively, and now I believe they're set to go higher the rest of the year. So we'll talk about these stocks in a bit. And optimizing classic technical analysis. So earlier in the year, we heard Stanley Druckenmiller say technical analysis is about 20% as useful as it was 30 years ago because everybody is using it. I could not agree with that statement more. And I am trying to constantly optimize my strategy in doing so, right? You spend a few weeks on X, right? You learn so much about traders' emotions. When we're at highs, there's everyone screaming about how great they are in their P&L. And then we get that rinse out like we saw a few weeks ago, and traders are starting to feel it more, and it's utilizing that as part of your strategy becomes pretty key. But in this optimization, you see classic buy points have become areas of chop. For me, they require too wide a stop location. And what I call is I want to mix the micro with the macro, right? And here is a chart of seed containers from How to Make Money in Stocks from 1976. Classic weekly cup and handle buy, right? And he's buying through resistance, which I told you that's what we started doing at T3 in 2013 when we had that crazy market run. And I had to unlearn this strategy because I was just getting chopped up, losing money in stocks that eventually went higher. And we'll look at this JFrog, for example, a nice little cup and handle on the weekly. That's a classic technical buy point on the weekly chart. Here it is on the daily chart, right? We see this area of chop. How much size can I really have if I'm buying in this area? Where do I put my stop? How can I have a huge portfolio allocation to this stock at that juncture, right? And now where I'm buying down here, that's the advantage of my strategy. I can really load up on stock. I'm buying at a huge inflection point where if I'm buying here and I take a loss, I told I'm just completely wrong in the stock, and the stock probably needs weeks to set up. But if I'm right, this is what we get. We get this huge winner on tight risk where I have that huge weighting. So the advantages of optimizing classical technical analysis, I'm buying with quote unquote the first buyers. I quantify my risk at a price point that indicates your trade is wrong if failed. Again, if I'm buying, this day up here and I have a tight stop, maybe I get tailed out in one of these days. I'm not going to let that happen anymore. I'm avoiding breakout area chop, and I'm allowing for positioning into weekly chart breakouts on extremely tight relative risk. And this allows extreme juicing of an R, right? The risk reward in a trade. And it gives the optionality of taking profit into strength while holding significant portfolio weighting for manageable long-term swing. I have tried to be the guy who doesn't take any profits. And what would happen is I'm puking these stocks up at the wrong time. I'm getting shaken out with the weak holders because I have too large of a weighting. So what I've done to optimize, I realized the taking profit I do to get it down to a more normal long-term weighting, that's my biggest advantage in the market. And in the first interview, I'm talking about in my full form, I'll just have this whole position. That's not going to be me. I have to understand that, right? My personal risk tolerance doesn't allow that. My advantages on the shortest time frames, right? I have to take advantage of that. And that's where this really comes into play. So my objectives when entering, I'm guided by the weekly charts first. I'm stacking layers of probability in these areas, these inflection points that I'm either wrong small or I'm right quickly and very right. And perfect entries only. I'm always executing around the moving averages, right? There's a lot of power in that statement because you rid your life of FOMO. I say to myself, let it come to me, let it come to me, let it come to me. I say this to myself thousands of times a year out loud at my desk. Because if you can rid your life of FOMO, again, this game is so emotional. If you can rid your life of FOMO, you live such a better life. You have much better executions. You miss a few trades, right? But you're not going to take so many horrible trades. And it just, it takes away so many bad trading setups. Names might go higher in time, right? But if you have the confidence in your strategy to let them come to you, that's how you can really excel. I focus on inflection points, as I said, and then day one price distance from cost. I want to mitigate that overnight risk. I can't hold a 40% portfolio position if my stop's $1 lower, the following day. If the market gaps down, whatever news, I'm smoked. I can't have that happen. Live to see tomorrow. So utilizing intraday timeframes, and the two strategies that have I've utilized most during this recent run, 30 and 65-minute pivots. And I want to shout out my guy, One Chart Master, Elite Swing Traders, Captain Joe. We spoke about him in the first interview a little bit. 5 years ago, I taught this guy to trade, maybe 6, whatever it was. He's become such a beast on his own. Now he's teaching me things, right? He has this 30-minute pivot strategy. He's been pounding the table on, the last year or two, and it's become such a huge part of my strategy. So I want to shout him out to doing that. And the mark of a great trader is always being able to give credit to other traders who we learn from, because we're constantly trying to destroy our egos. If you go on Twitter after one of these hot runs, you see newer traders all flexing their gains, all talking about how much they made in this run. That's an immediate red flag to me. It's like you haven't been through enough in this trading world. You haven't had your ass handed to you enough times, right? If you still have that behavior. So the pivot strategy, and then VWAP reclaims intraday. So let's talk about them in a little bit. We talked about this classical technical buy point in JFrog a minute ago. Let's talk about the entry a little more closely, right? Earnings day gap low, right? Many traders are chasing this first day of earnings. I'm never doing that anymore. There was a time in my life where I let it come to me, right? We're seeing this in real time. I'm letting it come to me. Days and days, I'm letting it come to me, let it come to me. Shakes out the earnings day gap low, right? Shakes out those weak holders, has an inside 30-minute candle, and then that's where I'm looking to enter more specifically, right? Shakes out the weak holders, inside 30-minute candle. I'm buying. In the scenario, I bought more than 0.5% account. We'll talk about that later, 0.5% of my account risk. But this is the entry. You're buying 64 with a low of day stop. 62.04 is low of day. 61.89. You always go 11 cents below the figure. I've avoided so many shakeouts in my life having that 89 stop instead of 61.99. It's fun. You'll just see it over time. Just a little word to the wise. And then that day one price distance from cost. So I buy the stock here, 38% portfolio position, but the stock closes up here, 67.94. I've got that price distance from cost. I can hold this big position overnight. If I don't have that price distance, I'm going to trim the position down to 15 to 20%. It's always about keeping yourself safe.
And Shake, before you go to Glow, I want to re-emphasize a few things on Frog. First, if you go back to the first slide on Frog, the first chart. So we've got this big weekly base, this big weekly pattern. Then we have this earnings gap, which causes you to focus on it. You see the shift in the software names too. And now it's about your entry, fine-tuning the entry, finding the spot where you can take low risk. So the reason that you're focusing on the intraday charts here, you're not doing it, in isolation, trying to make a trade happen. All those layers of probability are coming together where you've got the big overall pattern, the theme catching fire. Then you get your ideal setup, which is the shake below a key level, reclaim, tight spot where you can manage risk really tightly. And I was going to ask you why 11 cents and not 12 cents, but obviously that's just semantics. But yeah,
It's
I just want to emphasize
it's
yeah,
funny because you'll see it shake down to 90 so often. It'll come down. Let's say, and this 61.90 will be the low, and that 89 stop is going to see. It's just saved me. So it's something we learned very early on in the trading desk. It's just a little thing, that extra 11 cents is always worth it. Keeps you in a trade. Trade becomes a big winner, and you're like, oh wow, I got to do this every time.
Yeah, exactly.
But right,
I just want to reemphasize the like big picture, zooming into the small picture.
Yes,
that's why we're focused here. Yeah,
exactly. And again, it's not about that. If I'm typing up 2,000 names a night and I have that huge universe, when the stock is, I'm saying it, let it come to me, let it come to me, let it come to me. I'm going to prioritize other sexier charts, from a technical analysis perspective in that time. If I'm not laser focused on this weekly chart and I have a small universe in doing so, I'm just going to miss this trade. So that was a huge adjustment I've made over the past years. Okay, we got that price distance from cost, and then let's talk about this GLW. And shout out to my boy Ramey, aka Purple Drank. He was pounding the table on this. He pretty much made me buy this one. And one of the biggest edges I've gotten over the past few years is having great trader friends. I listened to Dan Loeb in his I think it's called Invest with the Best podcast, and he's talking about the most information he gets is from smart traders. And that's become such a huge part of my universe. I resonated with that so much. I call, people, I am from the school of technical analysis. I'm nasty at all the technicals, and I constantly work on my fundamental analysis grasp, the story stocks and all these things. But that's not my strength. So I talk to the smarts, and they help guide my name selection. Clement, he's definitely one of the smarts. My buddy Mark Nagel, he's nasty. He's one of the smarts. And all these like hedge fund managers I began to become friends with. I utilize their information for, sector themes and the story stocks. And, that's what lets me guide my name selection. So shouts out to Purple Drank on this one. But let's talk about this entry utilizing intraday VWAP. We see GLW, Corning Inc., and it's retesting the 50-day here. It's got this retest level of this prior resistance. It gaps down on earnings, but notably, so I'm only, again, I said let earnings season guide you. The only time I'm taking an earnings gap down is that if it was a leader, gapping down and staying in trend. What was William J. O'Neill always said, buy the first test of the 10-week. That was one of the big things in his strategy. The 50-day is the 10-week, right? So a name gaps down that's been a leader to the 10-week, that 50-day, that's that first test of the 10-week. And that's what this kind of entry is all about. So again, yeah, okay. I was talking about this here. First test of the 10-week. And that's really what the entry is about. So we look at it more zoomed in. You can see the very tight entry location. And then I got up eSignal here. This is my charting platform. But you can see VWAP is this blue line. And, sometimes entries aren't going to happen. You're not going to have that 30-minute pivot strategy. This is more designed to get in names earlier if these trades come about. And I completely stopped executing in the beginning of the day, those first 30 minutes. It takes a very special situation to do so. I had to really deprogram myself from doing that because it made me way too active. And I would take a loss early in the day, and I would be always trying to make it back. Again, we are just emotional beings, and we have to have constant check-ins with our emotional state. So I'm buying this thing. I buy a little bit on this first reclaim of the VWAP intraday. Inside 15-minute candle, a little 15-minute pivot there. And then when it reclaims, that's when I go full size. I go big on this one. And to clarify, I'm not giving it to this low of day. What I've learned since our last interview, I've done a lot of deep thought on my process. I have such a huge aversion to shakeouts now, is that I'm never keeping that too tight of stop. I'm just buying in the area, and I'm always giving it to this out that really, really tells me I'm wrong. If this low of day is taken out, it banks off the moving averages and bounces. I take a loss there. I am mentally crushing myself. And that's what I'm trying to avoid. So let's talk about trade management and taking profit. In the simplest sense, I want 50% of my position trimmed into strength at 5 to 10 hour multiples. And I want to trail 50% of that position on the moving averages, but I'm dynamically shifting this weighting based on my assessment of the location and cycle, how extended any given name is from a natural pullback, right? How much percentage of a stock's natural pullback I can handle from a portfolio heat perspective. And we'll talk about this lesson I had in AAOI that was like this aha moment, and just really, I'm grateful for the mistake because it really allowed me to crush the end of the run. And, what percentage of my position am I truly willing to give back to proper stop locations without puking on weakness is realistic. So as traders, we'll have 8 positions on, and we won't realize that when the market pulls back, they're all going to pull back, right? They're all going to drastically pull back. And we have all this open P&L, and it's how much am I really going to stick with, right? We tell ourselves when everything's at highs, like, oh yeah, but what I'm doing is I'm doing the math on these positions every night. What's my actual P&L on this pullback? If all these names have a worst case scenario, what's that? And I'm sitting there in my notebook every night going position by position. What am I up, unrealized, percentage wise, right? And I'm going through trade by trade. Aha moment, as I mentioned. So this gave me a really deeper understanding of high beta stocks movement and my own portfolio heat capabilities, right? Understanding personal risk tolerance. So early in the cycle, there was this momentum consolidation in the SPY, the S&P, and it was just a 2% range. I got shaken out of AOI, who had a 24% pullback. It was a 16 when I was entering. We'll talk about that in a second. Because the other holdings came in too much for my personal risk tolerance. So let's get into this a little bit. So AAOI has a 2% range in the SPY here in the circled area. AAOI has this 24% pullback in 3 sessions. It's the optics leader, and now it's shaking the weak holders out of a market leader. This is a buy point for me. So this is where I buy the thing. Perfect entries, right? It has the 30-minute pivot, and then all day just consolidates, and end of day it gives me a nice little move. My cost base is like 135, 136. Low of day gives me a little bit of cushion into the close. 28% is not 40%, so I'm more comfortable holding that. Gives me that huge move the next day. Here's where we're at heading into Friday, right? I have this great position. I'm so psyched about it. I'm like, what a buy. This is incredible, blah, blah, blah. Simultaneous. Oh, and here's the SPY, the Friday close, right? We are very extended. We're riding the 5 EMA. And we're just pushing after this huge run. So any consolidations are going to hurt my portfolio, which is pretty much loaded, right? My simultaneous positioning is ARM, MOD, Q, Dell, SKM, DigitalOcean, Powell, ODFL. But here are the 4 that kind of made the biggest moves that affected my positioning, right? We see this ARM entry here. Here's where it closed Friday. This Dell entry here against the 20, and where it closed Friday, MOD against the 50 here, and SKM here against the 20. All these things, great entries. And now it's about managing the position properly. Here's the Friday close in the SPY. And by Tuesday, it's like nothing happened. We push up Friday, we're at the same price we were, but look what happens to high beta stocks in that time, right? ARM, 15% drawdown. Dell, 10% from high to low. MOD, 11% pullback. I give SKM back. I sell it break even. So, I'm taking on all this portfolio heat. What does that make me do back to AAOI? I get completely shaken out. I didn't even care at the time I'm getting shaken out. I'm like, get me the hell out of this name at the time, right? Again, our emotions in the moment are often incorrect, especially if we have too much portfolio heat on. Size kills, and we have to understand that dynamic constantly. So a natural pullback of 16% was too much to handle with my current sizing. And instead of manipulating the weak holders, I was the weak holder. Bought this thing here, sold it break even. I was up 16% of the name at 28 portfolio position. I had this great position on, and then I just sell it break even. It's just many R's I'm giving back. It emotionally hurts while I'm giving all these other names back. Emotionally, it's not fun to deal with. So I sold at Lowe's Tuesday, and I'm licking my wounds, and then it gives me that perfect entry the following day. And I don't even have an interest in re-engaging, everything looks easier in hindsight, right? Woulda, shoulda, coulda, 3 best traders I know. I could have entered this thing and had that sick run from there, right? But I didn't. I was licking my wounds. And that gave me, I'm so grateful for this mistake because I used it to optimize my strategy later on. So, and then let's talk about going deeper to recognize external factors. What I always tell traders, the most beautiful part about trading is how much the knowledge compounds. I've learned so much more about myself in years 10 to 13 than I did in 0 to 9. I can't believe the things I'm seeing now versus the things I used to see even 3 years ago. So external factors relate to the dollar. This is prices, commodities, and global earnings. Strong headwinds for metals, energies, multinationals. Rates, discount rate on growth, rising yields, compressed high multiple valuations first. I read this great book, Stock Market Logic by Norman Fossbach. Deep dive on rates and think about trading, talk about knowledge compounding. You want to constantly be taking in information, and you never know where you're going to use it in your life. And having a deep understanding of rates, how markets move around the rate cycle, I highly implore everyone to read that book. It's just a book from the 80s. Quick story on the guy. It's funny. Guy from the 80s. And, I know I'd be good friends with this guy. He's got this yacht, and he named it after his wife. You know what he named it? Bad Girl. I was like, God, I love that guy down in Miami. Cool guy. So, all right, back to external factors. And this become a huge part of my system in these last few years. Foreign markets, the Kospi, Hang Seng, Shanghai. What are overnight markets doing? Overnight price discovery for USD. In Korea, trades memory before Micron opens. And what allowed me to crush the cycle was recognizing that way before anyone else did. In our last interview, we spoke about Chinese stocks. And I'm telling you, and we're joking around, and I'm like, it's exhausting on these momentum runs because I'm up all night. And this time, I'm rocking my baby at night while rooting on China. She was 6 months old at the time. And we're like joking about it, right? But I didn't realize the power in that statement. I've really optimized my strategy. And it goes to speak on how exhausting these momentum runs are, because I am literally exhausting myself because the risk reward of understanding this information is so great to my equity curve that I have to stay up and watch the Kospi trade every night. And finally, credit, risk appetite. Equities rarely lead credit and they follow it. So the chart tells you is what is happening. External factors tell you why and often before. I don't care about the why. If it's going to tell me before, I want to know. And learning from past mistakes. Shout out to my boy Clement. We took this trade together. We have like an 80% hit rate. I heard, through the grapevines, he might have a little TL presentation coming up too. That's my boy. Again, talking to those great traders, he gives me a lot of conviction in my own trading. But this trade, this one was one of the ones we got absolutely smoked in. So earlier this year, I had a portfolio concentrated metals names, Alcoa, FCX, XME, which is the metals and mining ETF. Buying these things, great. I bought this FCX reclaim of the 20. Take a tiny bit off, nothing substantial into this strength at the retest. These things are sitting in huge weekly bases. I just don't want to go through all that right now. Again, the XME, surfing the 50-day, I buy some inside day. These arrows, it's important to note, these are the Monday and where the mistake comes in that I missed. And I buy AA against the 50-day here, great entry. This is the Monday. And then I get shaken out of these things. I sell these things at lows, pour too much portfolio heat on, and I make a big mistake. And the mistake is I don't see the dollar running that Monday. This is a mistake I'll never make again. The Iran war kicks off Sunday or over the weekend, whatever it is. The dollar begins to surge. And that Monday, look at these arrows, all these metal names shrug off the weakness. And I am so laser focused on these guys, just price action. I'm not seeing the dollar's strength. I got to be lightening up in these positions. Shoulda, woulda, coulda. 3 best traders I know. But when the metals are shrugging off that weakness, it's saying somebody's lying. Both of these things cannot resume. The dollar cannot resume its strength, and the metals cannot resume their strength, right? Sometimes the external factors tell us what's going to happen before. Should have trimmed heavily Monday, seeing the DXY surge. External factors told us metals would sell off before they did. And I had that day to get out. And I took an 8% equity drawdown that day. And I don't take, even though I'm a very big gunslinger and I have this very risk-on strategy, I have a percentage risk aversion. I don't have 8% down day is very, very strange to me. When we had the onset of this interview, I was telling you I came off my best day I've had in years, whatever. I had 11% up day. It was like, that's crazy for me. I'm trading much smaller and controlled. So an 8% down day is huge for me. So I had that and it was just, it was crushing. It's crippling to have that loss. What can I learn from the mistake? I had a day to get out. So it's important to find the cycle's lead instrument. And this is something I started noticing in February, the Kospi importance. Again, it's not like every cycle is led by the Kospi. But every cycle has a lead instrument. The skill is identifying the cycle's tail before everyone else does. Memory is the leader in the cycle. Korea is where memory trades first. SK Hynix and Samsung price the theme 8 hours before Micron opens. Korean overnight action was genuine price discovery for the dominant US theme. To take that a bit further, this is when I first noticed it early in the year, that we had that first parabolic top in the Kospi. And it led our markets initially topping and consistently gave clues as to short-term direction once we gapped up and began trending in the US market. So these candles, it's very important to note, these candles all happen the day before all these candles happen in the US. And we'll look at some examples. And it's kind of astonishing seeing the stuff after the fact. It's so simple. So throughout the duration of this euphoric run and the subsequent market top, I'm dynamically adjusting position sizing in order to maximize my gains from the run and mitigate the give back by watching the Kospi closely every night. And I'll tell you what I mean. Here's a tweet I had in the middle of the run. I'm saying just absolutely staring at this Kospi inflection point, quite the short-term domino, depending on which way this thing breaks. This thing breaks lower, we're probably going to have a pullback in the Qs because SanDisk and Micron, these things will pull back and it'll lead the whole AI trade to pull back, and these things happen as domino effects, right? But instead, we break higher. And again, so this, right, you see how identical these are, Richard? Right? We wake up and this candle happens already. And then this is the candle that happens the next day in the Qs, right? And it's just consistent. All these candles are happening the day before, the morning before. I'm waking up and seeing these candles. I'm watching them overnight, but I'm waking up and this is the first thing I type up. So what allowed me to not give back so much in this run was recognizing this hanging man at the top. We were in this extended run. And again, a big part of the run, we have this first leg, momentum consolidation, we have the second leg. Oftentimes in these extreme euphoric momentum runs, we get these two legs, and it's understanding that as well. So I am very, very risk on for this run, but I've got my blinders on. Whatever. My vision's, looking at this thing like, this is a great run, yes, but any pullback relating back to AALI story, any pullback in high beta is going to be very, very, very drastic, and I have to be ready for it. So finding the cycle's leading instrument again. So I noticed this hangman candle, but by the time I see it, this is when I'm going to bed the night before. It's a king and queen. It's a completely red candle giving that back. I don't know if this is, I've never heard this term before, or the Eiffel Tower. This is something we just kind of made up and came up with. The king and queen, this is like an extreme reversal signal. A hangman has to be confirmed. We have to break lower this following day. If we see a king and queen, a momentum run, just right in the 5 EMA, breaks out at highs, completely gives the name back. That is a huge reversal signal. So at the time, yes, it closed the hangman. At time that night, I am beginning to dump positions. And it's funny because this is when we spoke about doing the interview, and I tell you I have my best day and what a cherry on top it is. And I don't talk about my P&L anymore. This is the growth I'm having as a trader because I'm always trying to crush my ego. And then I'm telling you I have my best day. That's information in itself. And then, factor in, we're 10 straight days up in the S&P, in 10 straight weeks of green, right? All these things are factored into my decision-making process, and I just start dumping my portfolio. And I want to make very clear, because in the last interview, we had that October 10th bar. That was the absolute knockout bar of the trend. And I was saying I dumped my entire portfolio there too. And that was a great decision as it led to months of chop. And, I earned the right to chill, and I wasn't as active in those coming weeks. And it was all a great thing. In this scenario, I want to make very clear, I don't think the trend is done in dumping these stocks. I'm lightening up these high betas so I can keep all this P&L that I required from this run. And I want to be ready to buy all these shakeouts that are likely to happen without giving up a huge percentage of my P&L. So I began aggressively selling that night, seeing that potential king and queen. And then here's what happened. And this is what I'm telling you is the amazing part. Here's the Kospi top, and this candle happens. And then this is the micron candle the next day. It's like just screaming at me that, something's about to happen. And here's the QQQ. And again, I go from coming into this day, right? I'm 100%, 150% invested. And then we have that breakout day. I tell you my best day. I start trimming. I get down to 125, and I enter the next day at 80% invested. I sold 45% of my portfolio that night, and I'm just dumping every day. The next day I went from 80 to like 50, down to like 30. And I really was able to hold on to my gains. So you see the MU top and the hanging man and the resulting action again in the Qs. And then here's my equity curve, right? Not much give back. Not much give back. And that's the thing I've been trying to work on most over the years. It's dynamically understanding when I want to adjust my rules. I'm a big believer in that you cannot outsmart the moving averages. It's true. But if the moving average is 30% below my price, I don't want to give back all that P&L, especially if I have a lot of conviction and belief in my strategy that it'll set up again for me to add. And we'll talk about ARM in a little bit, but these things just keep happening over and over. But the important part to see here is like I had no equity curve give back. I was able to hold on to, I think, 93% of my max gains from this run. And now, as I told you, I don't think the run's done. I'm ready to buy. I'm ready to put on risk. My confidence is at highs. I don't have this huge equity curve drawdown where it's just mentally crushing me over the next few days. So I'm ready to put risk on in this market. And what I really think is going to happen, we'll talk about this at the end a little bit. You let me freestyle a little bit. I believe we're going to have this insane market run, better than 1999. But if you look at 1999 and study past cycles, yes, the market went straight up and had this crazy percentage gain, but it had such violent shakeouts along the way. And that's kind of what we're seeing. That's what we saw this past week, at least, right? So in doing so, this is where my dynamic position sizing is such an advantage. I can take profit into strength, but I can hold on to a portion of the trade, and I can add back when it permits. Right? So putting it all together here, and let's talk about this JFrog example. So what we're going to do here is we're going to go from, trade, entering my universe into trade genesis, into execution, and the full picture here. So this JFrog, it gaps up on earnings, after DigitalOcean, after Twilio, same day as ACAM. It's software is just screaming at us. I don't want to buy that day one. But again, I know this thing is sitting in a huge weekly base, right? And the thing about power earnings gaps, especially when they gap up to these huge macro levels, it's often, very, very often, I don't have percentages on this or stuff. This is just what I've seen. It's very often the catalyst to begin that stage 2 breakout. So when I see a power earnings gap up to a huge weekly resistance level, potentially entering stage 2 soon, that's when I aggressively keep the name on a watch list. That's when it's high on my focus list. Like this Datadog was a sick trade for me. We'll talk about that in a bit too. So stock begins to pull back to the earnings gap. I head into the following day, right? We get 1, 2, 3 days down, head into the following day looking for a shakeout and reclaim of the earnings day lows to potentially enter. I also understand if this were to play out in reverse here, it potentially creates a future ghost touch of the 10 EMA. So where I've really optimized technical analysis is, I would say, front running and understanding traders. How do I say this?
How they might see the chart play out in the future.
Right, after the fact, right? And, everyone's going to be looking at the sexy charts and going nuts on them on Twitter after the fact. But if I can position myself before, I have the huge advantage of not dealing with the subsequent chop that plays out. So again, we talk about this entry. I shake out of earnings day low, fast reclaim, inside 30-minute candle. I buy through the inside 30 high, stop low of day. I bought 64 with a 61.89 stop. 38% portfolio position, about 1% account risk, maybe a little bit more. But, again, there are 5,000 opportunities every day in the stock market. For me to put on 38% of my portfolio in this is a load. This isn't a feeler. I'm buying my whole position. I'm already on margin in other names, and I'm aggressively going after this stock in this little price point, right? That's the advantage of the strategy. I have huge focus and knowing how and where I want to buy, right? Never chase, let it come to me. These things are instrumental in my trading process. So it closed the day 67.94, gives me that ample price distance from cost and the green light to hold such an oversized position. So, take the trade candle by candle. It's just acting well, right? And, this is the first time it breaks through that weekly resistance level, but I'm just sitting. Maybe in the old me in that interview, I'm much more willing to kick this position. What I've done instead, where I've really improved over that time is instead of staring at P&L and R multiples, I'm staring at daily charts. And, I'm Xing my P&L out as much as possible. It's like the biggest thing I've really, really improved on. I just keep my P&L closed all day, every day. And I worry about the X's and O's of trading, right? The P&L, the numbers flying around, it's only going to get us in a more emotional state. And that's what we're always trying to avoid. So technical breakouts confirmed. This is when everyone on Twitter begins saying, oh my God, look at this frog weekly breakout, right? Meanwhile, I'm up like 10, 15 R in the trade, positioned super well. This is what the strategy is all about. So now we have that second breakout day. And this is where risk tolerance becomes personal and the big advantages of my strategy and how I execute it based on my personal risk tolerance. So I sell half of my 38% position into strength at Monday's close around $88 for 12R. And in the first interview, I kept saying trading is largely a simple game of math. So let's look at the math behind this. 38% portfolio position, 37.5% stock gain, portfolio gain of 14.25% in that time. Selling half, I can book that 7.12% percentage gain into my account. It's mine, right? Mentally, now I can manage the trade. Now I can give back to this 10 EMA. If I completely give back this trade, again, back to that AAOI example, when I have too much portfolio heat on, I am likely going to make an emotional decision. That's what I'm trying to avoid at all costs. So my original risk, 1.2% of my account. And then this is where the strategy, about the entire strategy. I still have 19% portfolio position for the weekly breakout to manage. It grew to 23% of the portfolio in this move, but that's what the strategy is about, right? It gives me that first deep extension. I can sell, I can book a bunch of profits, but again, 19 to 23% portfolio position, that's huge. That's great. That's great. But already I've booked, what did I say? 6, whatever the number was, amount of R's. And then we see that Kospi reversal, and that's when I began dumping positions. But the reason I stopped on this slide to talk about the math is that this is what the strategy is about. When I start dumping the Kospi, dumping because of the Kospi overnight reversal, dumping my entire portfolio. These are very rare occurrences throughout the year. This is because we're 10 days up into the 10th week up in the year, and I'm expecting a high beta pullback soon. And again, understanding portfolio heat, names that trade together, I'm looking at as kind of one position in a portfolio, because they're all going to pull back as drastically together if they're in those same kind of sectors or adjacent sectors. So trade review here, cost base is 62, 38% portfolio position, average sale is 87.27. Just really, really proud of this one. 36.36% stock gain, and this portfolio gain booked 13.22% portfolio gain booked. That's mine, in these 2 weeks. That's what the strategy is about. So you kill these hot periods when these entries are really screaming at you, and I'm still holding a 1.9% portfolio position. It's nothing. It's, that's the little drag on you see this little drag at the end. I'm not getting completely out of these names because I understand they're not invalidated from a technical analysis standpoint, but my thought process is these things will set up again, and the pullback is going to be too much for this sort of positioning to handle. I want to avoid that. If I'm 150% on margin, all high beta names, I can't handle that as well. So it's putting all these thought processes together, right? So,
sorry, Sheikh, are you keeping that small position just to keep an eye on Frog as it sets back up? Why are you holding that?
So here's a huge part of the process, and what I've begun doing the last few years is buying a single share of stock. So again, back to that thought process of we have 5,000 opportunities a day, and it's very easy to get distracted away from the best opportunities, right? There's a million setups every day, especially in a hot market. There's so many names setting up. So if this thing's in my portfolio, I'm looking at this portfolio every single night. I'm going to be watching this name like crazy. So oftentimes when things are in a really sick earnings flag, for example, and I'm looking to eventually trade this name, I'll buy a single share of the stock. No stop. Thing can go to zero. I don't really care, but I'm always watching the name. And then it helps me. Well, there's a Twilio example where it helps me so much. I'll talk about in a bit. But earning the right to chill. So I crushed this run, 73.5% cumulative return. But the important parts to me are my best return, 10.82%, and my worst return, 4.63%. In order to have these 150, 200% years that, all the best momentum traders are going to have, you have to be willing to have kind of these 10% down days, leaving all this open P&L. I'm just not willing to do that. You have to understand your personal risk tolerance. So I had a 73.5% portfolio gain. My max drawdown was only 7.74%, that kind of 10 to 1 relationship there. And my Sharp, 6.92. Again, this is a very cherry-picked stat from this little run, but what I'm trying to tell you is that's what the strategy is about. We're trying to cherry-pick these really, really hot 10-week periods back to that Zanger ideology, 6, 8, 10, 12-week periods, where we're on that huge momentum run, right? That's when I want to be as aggressive as possible. And the thing I'm most proud of, 93% of peak gains kept. So again, you can't outsmart the moving averages. I'm in high agreement of that, but you can use external factors in your profit-taking kind of ideology or assessment, and really do well. I had very little give back, and now I'm ready to buy. And that's the most important part. So let's get into a little rapid fire trade review, shall we? A few of the names I took in this run. This ARM, best trade of my career. So, it has that gap up, the weekly chart gap up, and this puts it on my radar. Game-changing news. It's making its own chips. It's now in that CPU trade. And what are its peers doing, like Intel, who's in that CPU trade? Intel is the absolute market leader at this point. So I have an initial entry here, but and it comes back at me the next day. This ends up being a mistake, but I don't let it bog me down. I'm waiting for it. I'm saying to myself, let it come to me, let it come to me, let it come to me, just constantly. And I talked about this entry on the 30-minute, just honestly an insane entry. I'm buying a 40% portfolio position here, and I'm buying this thing, whatever the numbers are. I have like a very, very little stop compared to its ADR. And again, I get that price cushion, right? That day one price cushion a little bit. So it held me hold. And it's very important understanding the strategy and the optionality of the strategy during these aggressive times. This isn't going to be every week, month, year of the market. But again, here I'm buying this off the 5 EMA at a micro retest, right? On the 30-minute, we see this micro retest. I see an inside 30 candle. I'm buying through high. I have this tiny stop against lows, but it's because my focus is on the weekly chart and I'm just trying to wiggle my way. I've been sitting there. A very important thing is when names are sitting in huge bases, you just stuff them into your memory. Like this ARM, I've been staring at this. I tried this up here. I knew at some point in my career, I'm going to trade this ARM. I'm just waiting on a catalyst for it to enter my focus list. So I've had this base sitting kind of in my brain for years, and it's just always stuffing that in the back of your memory somewhere. And also with, knowing SoftBank, right? Masa controls so much of this stock. This is essentially a low float stock because he owns 87% of the float, right? So it's going to make a huge move if it breaks out, and it does, right? This is the initial move. This is how I handled the trade. All right. So this is kind of how I'm dynamically dynamically adjusting. So it makes this huge move in the beginning, and it looks like such a tiny move, right? But it's what are these prices? 180 to 250 in a short run. The huge run in like 5 days, just right in the 5 minute. So I trim half there. And the lesson here in dynamically adjusting my strategy is I take off 46% of my stock. In these scenarios where it's extremely extended, I need to get that down to about a third, and potentially look back, because this drawdown, because I had such a large percentage of my portfolio in it, it caused those emotional decision makings in the AAOI that we mentioned, right? And it was a lot of heat. And I was really mad at myself during this time. And I'm looking back, and this Friday close, where it's up so much, it's so extended from the moving average at this point. I'm sitting there, and it's funny. I'm drawing the monthly chart up. And I don't know where, I don't have it anymore, but I'm saying, this is ARM, and I'm literally drawing a picture. I'm saying, do not sell. Look at this monthly base, but not really understanding the natural pullback the stock might have, and the emotional pitfalls with that if I'm long 8 or 9 names at this point. And I know guys who are able to hold their entire position or maybe they have a bigger stomach than I do. Maybe, I don't know. I can only do what works for me. And I have such an advantage in that short-term strategy. This entry is like an absolute joke, that I need to excel in these, but I also need to understand my personal risk tolerance, right? This Twilio was such a great entry in this Twilio. So let me go off script a little bit in explaining this. Has the power earnings gap. I try it the first time off the 10 EMA. It fails, but I hold on to one single share. It stays in my portfolio. It's still on the focus list. I've done the research. I don't want to lose track or lose sight of the name. Eventually, this gives me an entry on the 30-minute. I'll show you the entry, and it becomes a Friday swing. So again, when I'm entering this trade, right, I'm entering it here, and this is like a huge relittle. I'm going from one single share to 38% of my portfolio. It's like, what am I seeing? How do I make that decision on that note to do that? A large part of it is that here's what the weekly chart will look like if I have that successful day, right? William J. O'Neill, 3 weeks tight. When the closes, after a significant move are all within 1.5% of each other, that constitutes 3 weeks tight. And then a momentum move is likely to come soon. But let me show you what I saw in this one specifically. What's the date here? Friday, May 29th. So I'm sorry to go to a 2-minute chart, but this is an extreme mixing of the micro and the macro. And I just kind of have to tell you this because there's so much game. There's just so much. Where was that entry? I think I was buying 185. Okay. So this is a 2-minute chart. I'm sorry to do it to you, Richard. It's disgusting to even talk about a 2-minute chart. Again, here's the 30. The important part is it's in this make or break spot, a huge focus on inflection points, right? Before all that happens, what did I see when it's testing these lows, right? And zooming out on a weekly chart, again, having the biggest time frames guide us, zooming out on a weekly chart, that area, the area it's testing is just it's a stage 2 resistance turn support. If it holds this area on a weekly time frame, it's going to give me that 3 weeks tight. It's going to give me all these other setups I have in the back of my mind. This plays a big part in the front running. Going to the daily chart, it's a Friday swing, right? And I know the weekly chart will look so beautiful if this trade works out, right? But the big part is if it breaks this area, it's going to need weeks to set up. If it breaks the 20 EMA and this 180 area, it's either going to head to the 50-day. It's going to need to chop around, right? And because it's Friday, and I know what the weekly chart will look like if this trade is successful, that is what allows me to put on a large portfolio position. Again, I'm loaded with stock. I don't anticipate having a 38% position on this one, but again, this leads me to have my best day. And let's talk about the 2-minute here. I'm sorry. I apologize, brother. So let's look for 185 on that entry. And again, all this stuff is with the understanding that if this doesn't hold up that day, it's going to fail and it needs more time, but I'm giving myself the optionality. And that's the important part. So, when it comes down here, I don't wait for a 30-minute pivot. I add from one share to like, a 10, 15% portfolio weighting just because it's a make or break spot and it has to hold, right? Then we look at the 2-minute. I'm staring at this thing all day. This is just, you see this volume come in, somebody's buying this thing. I go 10, 8%, maybe 12% portfolio position, 38%. I triple up on stock. And I get huge right here because I see this. And again, I have all these other factors. It's a make or break spot. It has to hold up here. The weekly is going to look so beautiful if, again, focus on the highest time frames. Weekly is going to look so beautiful if it's able to hold up here. Now I got a big buyer on my hands on some short time frame. Boom, that's the load. That's the load button right there. So this, again, did not intend unloading this thing as much as I did that day, but seeing that intraday volume come in, mixing the micro with the macro, because my strategy is so built on those short time frames, because I'm a product of my environment, right? Those day trading years, this is the next day. It has a, what's this percentage move? Percentage is up, but it's huge percentage move. Just absolutely rips. And I have my best day trading, first time in years. I want to hear something funny, ironic. The last best day I had was Twilio, and it was getting lucky, but this time it wasn't getting lucky. It was just dynamically, affecting my strategy. But this is the last best day I had. Again, sitting in this big base, right? Retest the 20 EMA. I buy that new high of day. Same thing I've been doing. And then the CEO gets on some interview and he kind of dictates that earnings are going to be great, and it has this huge gap up. I just sell out the next day. That's my best day in Twilio. Full circle moment. I have another best day in Twilio, but this time it was earned, right? That one was getting lucky. Again, you do get lucky in the best names and the best setups, right? You don't get lucky in $5 stocks. You get lucky in leaders. That's who has the good news. But it's just, isn't it such a beautiful full circle moment? I go from my last best day to my current best day. So let me get back to this presentation.
Actually,
right?
can we jump to the entries there? So that second ad, after you notice the big volume,
you want to see the 2 minute? This is your
if you
prerogative. I'm not doing it this time.
You're good.
It's just messing.
Where are you managing risk on the position if it did turn against you there? Did you adjust your stop?
No.
Yeah.
Again, aversion to shakeouts. Because I'm still giving it the room that it has to fail. It has to fail in order for me to get out. So back to that. No, this was the volume.
Yep.
And then this was that second entry. I'm still giving all of this to 180. My price is 185. My stop is like 180. And this ad ends up being, 180. But this is where most of my stock comes from.
Gotcha.
Aversion to shakeouts, knowing this 180 is a make or break spot. So I'm giving it all to below 180. That's the big difference I've made. In the last interview, we were talking about if someone banks off the moving average, I'm going to have a hardcore tight stop on that moving average, right? Not so much anymore. Big aversion to shakeouts. I want to be taking less losses. I want to be focused on less names, and I want to commit more so to the names, right? I took a loss in this Twilio on the daily, on the 10 EMA test. I hold on to one share. I'm committing to the name. When it sets up again, I'm going to buy the hell out of it. And, this sort of setup screaming at me. And again, this goes back to really focusing on your strategy, knowing where you want to buy, ridding your life of FOMO, right? Never chasing, letting it come to me. Look at how this thing came to me. I was already so much on margin. And then I add a 38% portfolio position, like kind of nuts when I look back on it, but it's the right decision because again, the environment's screaming at me, the software's screaming at me. This is how I love to enter stocks. Now I see the volume on the 2 minute. So I'm mixing the macro. I see the weekly chart. It has all these qualities. And now the smallest time frames also have these qualities. And that's really where this is like my complete strategy in one trade is right here. Right.
Yep. And sorry, just a scenario to ask
you. Please.
Yeah,
I love to chit chat.
If this closed negatively, like it's not at your stop yet, but it closed, 182, close to the low of the day. A lot of your premise for the trade was that it would look good on a weekly basis on the weekend. How would you have handled that scenario? Yeah.
I'm dumping. I'm getting back to probably one share.
Gotcha.
Right? It's got to close well today. The weekly chart's got to close as sexy as it eventually does doing because all of the retail traders who I'm trying to manipulate, they've got to get excited about this one over the weekend. And then over the weekend, you go on Twitter, you say, oh, Twilio looks so great. Twilio looks so great. Meanwhile, I'm saying, let's see this breakout Monday. I'm already positioned, and that's where the strategy comes from. So That's giving back to that optionality. Right? If this closes well, if I get that price distance from cost on day one, I'm going to hold it all. If I don't, I'm going to protect myself.
Yep.
It's understanding that we got to live to see tomorrow. So let's go a little rapid fire trade review from here. So that was the Twilio. This Datadog was one of my best names as well. And again, power earnings gap screaming at me. Power earnings gap coinciding with that IPO based breakout on a larger time frame. This is mixing the micro with the macro, understanding power earnings gaps and how important they are and how much juice they have behind the move, right? All of Wall Street is caught off guard by this insane gap up in this name. And it's like huge volume. They're all buying it. All the Fidelities and the guys who are trading for months down the line, right? They're not looking at a 2-minute chart, brother. They're adding every day for 6 months. And those are the real whales. We're just the little minnows of the situation trying to ride their coattails, but it's recognizing all these little qualities in directing our exposure in these names. And I was big in this D-Dog too for the run. And here's how I entered on a 30-minute chart down here. Gives me that little 30-minute pivot, understanding the 5 EMAs here. This is only a half position. Adding off the 5 EMA, I understand like that arm, but arm was a load because the weekly chart hadn't broken out yet on arm. And even though this one is still hasn't broken out yet, I'm buying up the 5. You got to understand that this weekly chart is still very extended. Where in the arm scenario, it's still building that base. So this could need 3 weeks tight. This could pull back to the 20 EMA like that Twilio, but it doesn't. So I buy off this 30-minute pivot just against this, little 5 EMA. I see it holding up. I kind of have a theory that it might give out this lockout rally, that it might not give a chance to get in. Its earnings were insane. The agentic AI case it had, all these things were just shouting at me that this one wanted to break higher. And again, I've been staring at this D-Dog IPO base for years, and I'm just waiting on a catalyst. That it's a very important part of the equation to just stuff these things in the back of your mind. I got all these bases, Boeing, XYZ, Square, right? I got all these Boeings that I'm just staring at, that I'm thinking about in the very back of my mind, that if they ever have this big catalyst, I'm buying for the stage 2 breakout. Maybe we'll talk about Yeti in a bit. I had a nice trade in that one, but wasn't on the schedule. But now I'm just trying to keep you and freestyle for a bit. So then D-Dog has that, kind of momentum add, and it's breaking new highs, and it's kind of a now or never moment where that's when I go to full size. I get back up to 36% portfolio position. I kick a little bit into, only 8%, let's say. In this, the thing about having that big of a position at this juncture, right, where it's just grinding every day, the 5 EMA, if it pulls back to the 10, like it should, or like it might, or even retest these, what am I going to do? Am I going to hold this position? My stop's only 195 at this point, and it's like I'm trying to manage it against the 10 EMA. But again, I don't want all this stock. It might be too much heat if it does pull back. Again, I'm constantly dynamically adjusting that portfolio size, right? So I get a little kickoff here, but I hold on to the rest. And then it has that day, that Twilio, they're all breaking out, all these software names. And I'm just completely selling these things. I get out, I go from 30% holding down to, let's say, 10%. I kick like 2/3. And then we have that overnight with the Kospi thing. And now I'm getting out and I have like 2% of this thing left. And at the time, it's always easy to do this, always easy to see after the fact. This isn't always going to be a great decision. Maybe the stock just keeps going without me, but it was understanding where we were in the cycle. 10 weeks up, 10 straight days up, every retail, 10R trades are not easy to come by in normal years. We're just dicing them out left and right. There's 10R trades, 20R, 30R trades. It's like, I know this isn't a normal environment. I'm trying to take advantage of it. But also it's like in my head, I'm like, all right, it's getting a little overheated. This trend, this momentum trend might exhaust itself soon. So, I get out there and it just ends up saving myself so much money in doing so. What we got here, we got Dell. And this is one where a big lesson in this Dell. We have the entry. Shouts out to my Dell boys. I did not call this trade out. I got my killers in pinpoint trading. 3 of my dudes called this out. Shouts out to my guys. But you'll see the entry here on the 20 EMA. And, this is the 30-minute entry, right? It makes a break off lows, sideways for 30 minutes. I buy this. And again, I'm buying this against lows. I'm not trying to cheat on this little day trade setup. Maybe when I was younger, I would tier my stops and give some to these lows and some to the real lows, right? In my older age, I'm just having an aversion to shakeouts. And I just want to commit to names more. So want to take way less P&L realized losses, and it's really helped my equity curve. So here's the entry. And here's the mistake is I get out of a bunch on that market gap up, the Trump tweet, right? I kick into strength on these big moves, but I don't have enough to, and here's where it goes. And do I have it? Sorry, I'm off track here. These are my kicks on this chart, right? It looks like it went so far, and then the name ends up going to 460. So again, dynamically approaching this, the big lesson was names. I was buying before that Trump tweet. I was pretty bearish, on the bottom of that run, and I flipped pretty well. And we had such a funny circumstance on that. What was the Trump tweet where he's talking about that eventually caused the gap up? He said, "I'll obliterate." Do you remember?
I don't remember. I don't remember exactly what he said, but I know exactly what you're talking about. Yeah.
Well, for the viewers, it was something like, if Iran doesn't come to a deal overnight, I'm going to obliterate them off the face of the earth, or something like that, right? And simultaneously, all these charts are setting up: Dell, Q, UCTT, whatever these names I was in at the time, MOD. And we have this scenario. My buddy Tech, Goldman trader, he calls me out, and he has this theory. He's like, this is kind of, you always talk about a doomsday scenario, right? A nuclear war scenario. And it's like, you should buy stocks on a nuclear war scenario, because if we don't have the nuclear war, stocks are going to gap up. If we do have the nuclear war, we got a lot more to worry about than stock prices, right? And it's like, we've been talking about that for 20 years, joking about it. And now we really, really have the circumstance. So I'm a big believer in, a semi-believer in progressive exposure. But in that scenario, what helped me jumpstart for this run was I put on a lot of exposure before that day into that tweet. And, to go off script a little bit, again, we want to let the opportunity set guide us. We had so many charts looking like this heading into, the gap down in the market. So this was what? April 6th. You look at the SPY at that time, we're still at this point. We're testing the resistance. I think we have another down day, reversal. I'm actually buying stocks this day, and this is the night of the tweet. And then the gap up happens. But all these stocks told us beforehand, look at this setup. There's an A+ setup leading picks and shovels, naming the AI thing, and the AI trade, right? Cup and handle breakout, recent IPO comes and retests the resistance, and then gives me that really, really tight consolidation, right? I'm always buying the moving average. This is something that's screaming at me to get involved with, for example. And the big lesson, again, going back to understanding where we are in a cycle. You see this gap up, and I'm taking most off into this gap up, because the next day it's like he calls out the ceasefire, and we do have that gap up, and it begins that power trend. But if you're focusing too much on the news, it was like we had this ceasefire, and then Iran's firing at Israel like an hour and a half later, and you couldn't believe it. And we were coming off this 5 months of choppy period. So I was much more willing to trim stock into that gap up. I was very happy with the P&L burst, that I have to kind of in the future see the forest for the trees more, and those names coming out of a correction, the first names to move well in that cycle, these are the names you really, really, really got to hold. So Dell, again, market's selling off, and Dell is giving this great setup on the daily here, where I'm buying a 20 EMA pullback, and then we look at the move it makes. Here's the where it started in the beginning. Stock quadrupled or whatever it is in the run, and there are a bunch of names like that. Marvell, whatever it is, all the leaders from when we were showing those names, showing the relative strength when we were still gapping down in that tougher environment. You really got to understand the forest for the trees when we come out of those corrections. You got to hold. You just got to hold those names, right? But again, it's coming out of 5 months of chop, right? That's 100 trading days of chop.
Yep.
Of just you come into the day, and all the feedback you're getting is that I should have a really short time frame, and then the environment changes on a dime, and it's hard to change up your strategy dynamically. Position sizing myself, that can be one of the weaknesses of the strategy, not understanding the cycle early enough. That's something I really learned this time. This Qualcomm, again, very textbook trade for me. The funny part about this trade is it's not like the frog trade. I am very excited about it. I'm waiting for it to come back to. I'm waiting for it to come back to that earnings gap level. This one, my baby girl's crying all night. I'm on like 3-4 hours of sleep. I get to the desk 6:17. The market's opening in 13 minutes. I don't have a huge. I'm not looking to put on risk. I'm exhausted, whatever. But my process has become so mechanical that I notice this, and I just have to buy it type thing. So Qualcomm has that change of composure, game-changing news, right? It pulls back to the earnings gap, makes a brief run lower, and I just buy this new high, 164.50 or 159.50 stop. I sell most into this 2-day move, just an insane move. And the reason I do that, going off script again, brother, sorry to do so.
This is where the good stuff is. Don't worry.
That's my thought process, but if I could figure out how to work this computer. All right, so Qualcomm is where we at. Let's go to the daily chart. All right, so this Qualcomm, the reason I'm pretty much getting out of the trade here is because it's so extended. And it does go higher, but eventually gives me a chance to rebuy it. But real quick, why was I taking so much off the table here? Very extended. From moving average is at this point, right? If we negate all this trading, right? Just at this point, it's like, you know, the 10 EMA where I'm trailing it, it's at 225. What is that? You know, 20% lower. So seeing this, I didn't want to get Oscar. Let me tell you what happened in Oscar last year. And I had so many traders mad at me for this. It's so funny to look back on, right? So Oscar has this setup, and now it, you know, healthcare looks so good that it might actually work out now. You know, cup and handle base, IPO, huge short float. If this thing ever breaks, this area is 24, it's probably going to get up to this 36 and then break those highs eventually and really go on a run. And knowing that there's 30% short float on the stock or whatever it is, it's got the juice to do it. All those shorts are going to have to cover. The momentum traders will recognize this. They'll buy this stock aggressively, and that's how these stocks make these huge runs. But back to this Oscar, take it bar by bar. We're sitting in this consolidation pattern. This healthcare looks strong at this point in the year. We're looking pretty good. Take it bar by bar. We're waiting on it, waiting on the weekly chart. And we get some great entries in this thing. And here's the first entry, right? I'm buying this thing, $19 against this little 18 area. Great first entry, right? It's the second day. I buy a little more. It pulls back to that EMA. Probably like 25% of my account or so. I'm not super oversized. It didn't give me a huge distance from cost. But again, great entry, perfect entry, right? Gives me, look at this. Whoo, whoo, whoo. I'm killing it, right? I'm killing it. I give the trade away a little bit. So I have 2 days up, and you know, it makes this huge percentage move. I'm up many R's, and then it gaps up the following day on some whatever news to this level. And I'm in the pre-market saying, I'm not selling squat, guys. I'm not selling a share. I'm not selling anything, right? What happens? Punishing day. We're gapping up here, push higher for 17 seconds, and just crushing the P&L all day. Then what happens the next day, right? All right. So now at least we got the 5 EMA test. We got the 10 EMA coming up. Our cost basis is low enough where we're, you know, I'm going to be able to handle pullbacks. I just got to, you know, stomach the pullback a little bit, right? Oh God, just another day of just pain, just absolute pain. Just, you know, again, 2 days ago, I'm saying I'm not selling a share. Everyone is very upset with me at this point. What happens the next day? Oh, brother. Oh my God. I get out of the trade break even, right? So this is an integral part of my trading development where I have to take some. This is when I'm trying to just hold all, right? I'm trying to be Oliver Kell. I'm trying to hold the name for the entire cycle. I learned that's not me. I'm just never going to be like that. I have these great entries where I can load up, you know, I got to take some off here, and then this isn't so painful, right? So a lot of traders were very mad at me with that Oscar. So that is why for this QCOM, right, I take off so much on this retest right here. But back to the trade, makes that move, pulls back. And again, I know exactly how I want to buy. I'm always buying near the moving averages. I'm buying tight consolidations. Again, this name is screaming at me. I don't think this trade's done. When I sell most here, I'm waiting for the reload. And then it gives me that re-entry. And I'll show you an important part of my kind of trader development there. Didn't plan on going this off script, but
this is good. This is
perfect. Aversion to shakeouts. And this is what I really want to tell people, because I used to get shaken out and take so many losses, and I just take way less losses. This is May 21st, right? So when I'm buying this name here on this May 21st, I'm not using a low of day stop. I'm buying a normal position size. This is not what I'm going huge. I already have huge P&L in the name, which allows me to attack it again. But I'm buying this thing here against down here. And what happens? A bunch of my traders end up getting shaken out because they're trying to keep it too tight on this move, and it's never really a concern for me. That's kind of the big adjustment I made to my strategy, is I just really don't want to get shaken out. And then you look what happens. It's one of my best names. Instead of me getting, you know, mad at myself on a shakeout, it makes the move. I'm trying to have too much stock with too tight a stop. Instead, I give it to this pivot low, you know, sell some here, you know, take some off. Again, this is the Cosby day when I really get out of a lot of stock, and then look how much P&L I saved myself, and I get out completely here. So again, it's dynamically understanding all these little things that help the strategy. And this Navin, this is a HVE candle. I believe your boy Rye is big on the HVE candle, correct?
Yep.
Yeah. So it's like, I have learned that this is such a powerful candle in probably recent 1 or 2 years. And Fastly was where I really recognized this. Fastly had a HVE candle off lows and had just a huge change of composure. And that was the only stock that was strong during the March kind of chop. February, March was Fastly. So I said to myself, I'm buying the next HVE candle no matter what. I'm buying this thing perfectly. It's retesting the 10 EMA here. I buy some. I'm not full. I'm not huge or anything like that. But this day is where the magic happens. You see this day right here. It comes and tests the 20 EMA. I was just doing a trade review with someone about this, and they said, why did you double or add like 250% of the position there? Because again, it's that make or break spot. If it breaks the 20 EMA here, it's going to need weeks to set up. But if it doesn't, if it holds, that's when I potentially have that asymmetrical opportunity. And then we look at what happens. It gives me it gives me price calls from day one, gaps down a little bit. But again, here's the trade. I'm taking some off in this run, and it keeps going. And now I have maybe like 10% remaining, nothing huge, but it beats earnings, right? Things back down. I can trail this on the 50-day from here, like the William J. O'Neill kind of standard stuff, and it's mixing these time frames and mixing all these different ideologies. DigitalOcean. So DigitalOcean part 1 and 2 here. This is where the strategy can be very powerful. Let me talk about first tests in a little bit if we freestyle. DigitalOcean, right? DigitalOcean is a brother to Fastly. This is what these names look like. Again, this is March, when the market is so difficult selling off, and it's like, how is DigitalOcean and Fastly? They're just up every single day. How is that happening, right? So it has that first test of the 50-day inside day, and I'm just buying through the inside day with a low of day stop on the reclaim. That's not like, something that's just like a normal trade setup, right? I kick 15% here, 6-7R, kick 15%, but then I'm holding enough of the position where it makes a meaningful move. I can capture it, right, while I've covered my cost basis, and then it has this the huge earnings move. I sell for 100%, right? But again, all these software names are screaming. I'm holding on to one share, and I'm saying, let it come to me, let it come to me, let it come to me. And then I eventually have that ad here. I'm staring at this name every single day. I have that ad, and then I kind of get out in that cost reversal. Name still looks good, but that's kind of the process of the entire strategy in one clip there. It's like, I want to get price distance from cost so I can hold through earnings. So something amazing can potentially happen. And that's what happened in this DigitalOcean. And I can sell into the strength because at this point, the name's like 50% above its 10-week moving average. I know myself, I can't hold that back. Even this name trends higher over weeks, it's just going to mess up my thought process too much. So I take the win into that strength, and then I'm very ready to reload on the setup. Bought some, I sold most into that cost reversal, and I still got a little bit here. So let's talk about some losers. It's not all winners, of course. But again, what you'll notice about all losers is, if I'm wrong small, I'm wrong tight. There's Warby Parker, who's oh my God, this thing was such a disaster on Google I/O when they're supposed to present. Whew, we got pretty smoked on this one, but I'm trying to position myself at the Warby Parker for his potential stage 2 breakout. It's got the Google Event Catalyst, just a nasty failure. I got to take a loss there, right? CF Industries, this thing's got an amazing weekly base. This is more of a war stock, those fertilizer stocks, right? The Strait of Hormuz constraints. I take a loss there. It's trading around the moving averages, amazing weekly base. This is, kind of a perfect entry location for me. I take a loss there. That's fine. It's, all part of my strategy. ALB, same thing, war stock. I look for the entry there. I get shaken out. It eventually does make a move. I do get shaken out, but, name kind of comes back, so it doesn't matter too much. And then this 5N with the software stocks, right? This is another one of the software stocks that gapped up, wants the re-rating, change of composure. So I tried to position myself, right? It has that pullback to the 10 EMA, and it closes at lows of the day. That's fine. I take a little loss there, and I don't re-engage because I'm just so focused elsewhere, and I have so much portfolio heat on. But, again, all these losses, I'm wrong small. And because I tell myself not to chase every day, these are fine, right? These are little tight losses. I'm not, embarrassed about any of these. It's just all happens part of the game. And then you'll notice some of these structures are all very, very similar. This is why my activity levels are highest during earnings season, right? Look at all these similarities, right? Sezzle gaps up on earnings. I buy a little bit against the earnings day low. The base builds out. It gives me that 10 EMA test. It closes above it. I add heavy against this little support level. I scale out into strength on the Kospi stuff, and I still have a little bit of this one left. I'm looking to add back. This is the one that it didn't pull back too hard, and this ends up being a mistake, right? You can't be perfect in every stock, especially trading this strategy. But again, the amount of money I save myself elsewhere makes it all worth it. Powell Industry. Oh no, let's look at these. Look at the structures, right? AAON gaps up on earnings, right? Base is out, gives me that perfect entry off lows. I sell into resistance here. Most of it is exited here. And then I get out, with the technical break of the 10 EMA on this low. And same thing with OSS. Again, shouts out to my boy Purple Drank who forced me into this one. Same thing, 30-minute pivot, earnings flag, buy against support, trim into strength, scale out. I scaled out of this one completely here because it's just not a priority for me, this OSS, compared to like some of the big, market leaders. And then this Powell is a high and tight flag. I buy a 30-minute pivot, position myself nicely. I sell this one. I take a trim there, sell this one into earnings. It goes higher, but I don't want, unless I have a 20% price distance from cost, I'm not really dying to hold things into earnings. I don't care that much. That's fine. So the conclusion is, here's the system in one slide. It's like, this is the aggressive momentum strategy. It demands that the conditions are perfect. There's a trend filter as well as the external factors. We talked about the dollar, the rates, Asia overnight, and deciding when risk is on and risk is off. Name selection needs to be the best. It needs to be leading names in leading groups. Earnings driven, liquidity filtered. This is 75% of the battle. The entry has to be an intraday inflection at a weekly time frame. Location. So this way, my stop is around 2% when classic technical analysis is probably around 8%. Size, risk is the constant, 0.5 to 1.5% of the account. The position weight is the output of the stop, never the input of conviction. I'm not saying I love this name, so I'm buying a ton. It's, am I buying this Twilio? I'm buying this in make or break spot. Okay, it's got to hold here. This is where I'm putting a ton of my risk on. And then managing it, trimming into strength at defined R multiples or extensions, again, staring at the daily chart more so and not staring at your P&L, trail the rest. And this is all governed by portfolio heat. So, the edge stated plainly, I'm exploiting intraday timeframes and classic technical analysis to participate in weekly chart breakouts while risk is compressed to its minimum, allowing position size to be pushed to its maximum. So in the same stock, same weekly setup, same 0.5% account risk, that's pretty standard. On the breakout entry, you're going to have an 8% stop and maybe like a 6% portfolio position. For me, buying these intraday inflection points, I'm going to have a 2% stop and like a 25% position. So I get to have full participation in the weekly move at 4 times the size for identical risk. So why can't everyone do this, right? It seems so simple, right, Richard? Traders love to trade. It's like, unprogramming that button clicking is the hardest thing. What the edge demands is you have to be able to sit out. You have to understand when conditions change and the charts break a bit so you don't crush your account. If you're overtrading the strategy at the wrong time, it's going to be very painful. Strategy only pays in trending regimes. The rest of the time, the correct size is 0. This is for, again, it's not like I'm not trading market. This is for the 150% margin, aggressive momentum trading strategy. 6, 8, 10 weeks. I need to kill this period. It's my job to kill this period of the market when the easiest trading occurs, right? I'll hold 100% cash for weeks while other traders, are working and, continuing to enter stocks. But again, I'm going to trade other markets. I want to make that very clear. I have different strategies for other markets. I'm still I will typically like overperform in a choppy market and underperform, maybe not underperform. I still did 73.5% in this run, but underperform guys like Clement, my buddy, who will do 150% so easily in this run. But he can handle a lot more portfolio heat end. And that's like understanding your own risk tolerance. He can do those gyrations more. So I have to, kind of understand that more about myself. So you got to wait. Traders want to chase. Letting it come to you requires faith that it will, right? I'm not even interested in that day one earnings opening range breakout. There was a time I was, because I have faith that the stock is going to come to me at some point. It's either going to create this base off lows, as I just showed you, or it'll give me some sort of moving average setup, and I'll have the chance to buy. I'll let it come to me. Most just cannot do this. And you have to be selective. Size punishes B+ ideas. There's 5,000 stocks that fight for 20 watchlist spots and 20 fight for size. So it's really, and it's holding that like one single share of a stock so that I'm always focused on the name. Like, a bunch of my traders were focused on this Twilio for weeks. I was the only one who went super, super big when I did. A lot of people were getting chopped up with it, over trading it. But I understand that I'm letting it come to me. And then when it gives me all these signals that I love, it's like it's begging me to put on that size. So recognizing I've done the research for the stock, keeping it in my portfolio, keeping it at the top of my radar. That's what really allowed me to kill the trade. And you have to respect heat. Correlated names are simply one position. Portfolio heat, not per trade risk, is what breaks you, back to that AAOI lesson. So, that's what I got for the slideshow, the presentation. Thank you again for letting me have it. If anyone wants to reach out to me on Twitter, I am Pryzby1. You could email us at info@pinpointtrading.com. My buddy Heaven will handle those emails. Shouts out to him. And if anyone wants this slide or the full report, it's available upon request. Anyone can have it. So you want to talk about the market a little bit? We got time?
I got some questions for you, if you don't mind.
Oh, please. All right.
All right. First,
In one of your first slides, and you talked about, or you alluded more towards your early trading at T3, more day trading aspect. You talked about having to unlearn a lot of stuff to kind of expand your timeframes a little bit. What was the good from day trading that you've kept, and that's become still a key part of your strategy? As it kind of those precise entries, is that the heart of it, or how do you expand on that?
It really, it's like I learned to read tape. I learned how to, there was a point in this presentation where I'm embarrassed to say it, but I showed you a 2-minute chart, and that 2-minute chart was what had me take a 10% portfolio position up to 38 or whatever it was, which allowed me to have my bet. It's like that little decision there, seeing that volume come in on a 2-minute chart is what allowed me to make 7-8%, whatever I made in that name that day. But it's all like these years of learning, right, come to that one single moment. Right. So it's like taking the good from the short term, but also understanding the trades that you stay in the longest. That's where you're going to make the most money.
Yep.
So, that's something I've had to just work on every single year. And I continue to work on it every single day, is expanding that time frame. And when I sold out of all my positions, I want to make very clear, it's like a once in a year thing. It's funny. It's like you only hit me up after the market has like an absolute knockout bar.
Yep.
After that October and then this one. But it's very rare I'm going to clear out a portfolio like that, because I'm trying to catch the bigger moves on the bigger time frames.
Yeah, and you mentioned earlier, and this is like a key point here, is that, like Dan Zanger says, there's 2 to 3 times a year where you want to press the gas, and the other times you want to be, as little involved, doing other strategies, whatever. But just to kind of reaffirm, maybe summarize kind of the key things you look at, how are you determining when those sweet spot periods are coming up? And also that shift from, okay, maybe we're getting to the end of this easier period, and I want to be pumping the brakes a little bit to keep those equity, to keep your equity curve as close to highs as possible. So what are a few things that you think would be important for traders watching this to keep in mind to assess whether it's an easy period, getting towards the end of the easy period, or just a time to more be sitting out?
Again, we want to let the 2-part question. So first I'll answer, how do we know it's momentum time, right? And the most important thing is you always got to keep tabs on the market. Again, leading groups, leading sectors. What's the opportunity set? What do charts look like? Are there, like, for example, maybe we'll talk about some charts in a bit. What got me, I started to rebuy a little bit this week. It's because the opportunity set in charts, in semis especially, they look amazing, right? And it's like, I want to be pulled into the market. I'm not interested in, well, maybe this chart holds up and blah, 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 blah. It's those Twilio scenarios where it's like, oh my God, I have to buy this name. Everything I've learned about technical analysis and my strategy is pointing towards pushing right here. So it's like, I avoided the big drawdown when we had the quick 8% pull in for the NASDAQ, but it's not like I'm out and done with the market for good. I'm just, protecting my gains there. And I understand I'm going to be, maybe buying soon, whether it's a day, whether it's a week, whether it's 2 weeks, right? But I'm letting the opportunity set from the leading sectors guide me. What do these charts look like? That's the main thing. And then the second thing was, how do I know when it's risk off? And I've become, an absolute expert at retail traders. That's the one thing I know, because I've worked with retail traders for 8 years, and now seeing Twitter, it's like the emotions of Twitter are such a tell, right? And then something, a little game I could give you, let me bring up the S&P, is if you notice, if you go stare at a lot of stock runs, if you go stare, and when we're going vertical at the end of a run, typically we start riding the 5 EMA and just, guiding higher. And then that, nasty pullback occurs. And I've just seen that so many times in my career, that, 10 weeks up, 10 straight days up, looking at the emotions from not only my traders, but like the retail traders on Twitter and stuff. Everyone's patting themselves on the back. That's usually a signal that we're going to see this huge down move soon. The same guys who are obsessed with, posting their gains and such, I'm sure they gave a lot back, and it's, the nature of the beast, and that's what it is. But again, in seeing this turnaround, I put some risk on. So it's what I wanted to say is, when we have 10 straight, again, this is all in the context of the market, 10 straight weeks up is insane. And now looking at SPY weekly chart here, right? Let's look at the 10 EMA. What was I just saying about Bill O'Neill? Where did he want to buy? First test of the 10 week within the trend is a spot he's looking by. And now we look at where we pulled back, right? We go 10 straight green weeks, harsh pullback, right? Look at where we hold up, the 10 week moving averages. And do you have another question?
Yeah, dude, I got plenty.
Okay. But let's touch on that first test of the 10 week in a bit.
Yeah. Let me write it down.
Yep.
the next thing I want to touch on that you just alluded to was when the momentum period is starting and as it's getting going, you want to be focused on the themes that are likely to be leading. So how do you keep track of what themes are developing together? Is it just the stocks themselves? Are you using ETFs? How do you kind of determine, okay, this is a leading theme?
Yep. It's both of those things. Most nights I go through this watch list right here, and it's where is it? ETFs, sectors. It's called. Every night I'll go through these sectors, right, and I'll see the leading sectors. We got materials. See how materials come around, nice little bull flag, and I'm gonna let this stuff guide me, right? I'm going through this every night. We see semis, and the big thing about what we saw this past week is the opportunity, the expectation breaker in the semis.
Yep.
Right. So again, it's a constant focus on the leading charts, the leading names, what those charts look like. Again, I'm talking to great traders. This has become my biggest edge, is talking to great traders, seeing what they're focused on too. That really helps me funnel down my name selection. And, for example, like what got me, again, maybe a little more bullish on the market in the short term was seeing this expectation breaker in semis, right? We're looking at ETFs every night. We have this, hanging man top. We break down. It shakes out and it looks like, we could be ready for a comeback as soon as last Tuesday. And then what's the next day like? And again, this is why it's important to sit out sometimes when these things break, because, when this candle's at highs, at the end of the day, it looks horrible. This candle's at highs. It looks like we just, right? We're back to biz where we're going to, hold up. All these semis are ready for action. And instead it closed at lows. And a lot of traders are taking huge losses in that because they're just trying to position themselves too early. So and then we saw the big, you'd see this chart and you would think we're going to break down the following day, right?
Yep.
And then we had this expectation breaker, right? And back to the Cosby gapped up, right? SanDisk, Micron, new highs. All these things look good. But what I wanted to touch upon is, so I talk about in the strategy, I want to be buying with the first buyers, correct? But as far as turning on the strategy, I want confirmation of the strategy after I'm told the market is ready, right? And it all started on that gap up, right? I don't want to be executing the strategy in here because I'm going to kill my account. This on margin, super risk on momentum strategy. We see this gap on that gap up. That's what turns on the strategy. And this was, over the weekend, again, I'm still kicking myself for this. I was selling stock. Big lesson is coming out of corrections. You got to hold your best winners. You got to program that into your mind. But we get this like huge run up into prior resistance so quickly after, I'm trimming. So, because I don't want to deal with the pullbacks and the heat. And it's like, we've been in 5 months of chop. I'm just happy with the gains, right? So I'm missing the forest for the trees there that we just broke the new highs, that we have this huge momentum trend starting. I'm trimming stocks because of this retest higher. And then a big part of the strategy when trimming stock is, where do I think we are in the cycle? So if we're earlier in the cycle on week 1, that's when I have to hold and be willing to deal with more portfolio heat. But on week 10, after 10 days up, that's when I'm looking to clear out all that unrealized gains in order to keep it. But it's dynamically approaching that. And the thing is, everything's easier in hindsight, right? We don't know what's going to happen. I don't know that if I knew we were going to have 10 straight weeks up, would have made 6,000%. We don't know. Hindsight's the easiest thing to look at charts after the fact, right? And we want to be systematized as much as possible in order to deal with the emotional status that really happens every single day.
Yep. And to add one thing to kind of my question, how do you find leading themes? And I'm kind of assuming this, but you kind of mentioned it before too. Like, to use the software names as an example, they were all gapping up, showing huge power, huge volume, setting up together. I assume that gets you very focused on a theme when it does that. Is that right?
They're screaming.
Yep.
They're screaming at me, right? And like the market's selling off. This was the Q was probably one of the biggest trades I had.
Yep.
As long as that Dow pre gap up, right? Like, this is just an A+ chart for me, and I'm scoping the market every day for these charts, and everything's wide and loose in the sell off until, look at this part, this is like, whew. And then what we do is, I buy it. I buy a feeler this day, right? Perfect entry, right? It taps the 10 EMA, reclaim of highs. I buy this. I buy some more the next day when it just kind of validates my strategy. But I'm kicking too much on the gap up. Again, it goes back to the opportunity set, always focusing on the charts and knowing how you want to buy. That's the most important part. It's like, I have no FOMO or desire to chase these names because I have such faith that at some point they're going to come to me, right? This RMBS, for example, this is one I recently bought this week. New story with the semis and the smarts. The smarts is what I call them. All the smarts are telling me this name's up next. Clement was telling me I had a couple of hedge fund managers. RMBS is up next, right? At this point on the gap up, when it has the whatever news, everyone's trying to chase this thing up here. I have no interest. I called out this trade here against the 10 EMA, but again, this is when I started clearing out the P&L, June 1st. So I wasn't interested, and I missed this trade and whatever, I ended up coming back. But I say, let it come to me, let it come to me, let it come to me. And like remembering everyone wanted this name up here. Now it's really set up. So I put on some risk here yesterday, bought that one, just a little bit, pilot position. Again, conditions broke. And we, again, trend filters, right? Big part of the strategy is we got to be riding this 20 EMA. We got to be riding comfortably for weeks on end, right? So it's like, yes, we reclaimed, but we didn't, this broke. We don't know what's going to happen next. What I kind of think is going to happen, we'll chop around and give some good setups and kind of give, this sort of action, chop, chop, chop. And I'm still very, very, very positive market. I began buying things again today, but, the strategy has the filters for a reason. So it's not calling for me to be on margin just yet. If we consolidate for 4 days, let's say, really, really tight, and then we break out higher, that's pretty much my first signal to start buying, maybe get on margin again. Maybe we have that next leg of the run. Again, I'm very, very positive on this market for the years to come. I think we really have to kill these cycles and understand how to trade these names, but also understand, looking back at previous cycles, they come with violent shakeouts. 99, went straight up, 95 to 99. It was such a great run, but there were such violent shakeouts along the way. I know myself, I'm not going to be able to hold my entire portfolio. So I'm dynamically adjusting that position sizes into strength, whatever it may be. Right. But it's all those trend filters, and all right, let's move on from there.
No, perfect. This has been great, Shake. And I think just to kind of close things off.
Can I talk about first tests?
Oh yeah. Sorry. Yeah. I wrote that down. Go for it.
Yeah. No. So, what I wanted to mention in the thing is, like, I look at trading as a very creative endeavor. I'm constantly using trial and error and adding things to my system, right? A big thing in my system is Friday swings. I see people on Twitter saying Friday swings. They're not crediting me. Don't think I don't notice, guys. Okay. Don't think I don't notice, right? Layers and probability. It's become my thing, right? And it's just this trial and error process. So like we spoke about, William J. O'Neill, he talked about the first test of the 10-week, right? What I began to notice looking at this Fastly and all these things is it's like first tests of moving averages. So first test of the 20, first test of the 50, right? So, and again, we're manipulating retail traders. We're manipulating the weak holders. This is that Fastly I spoke about mid-interview where it was like, the market was a disaster at this point. You look up, Fastly's up every single day. Again, this was a high volume HVE candle that has so much more power than I realized, adding it to my system as time goes along. But again, we're riding the 10 EMA higher the entire time. And, it's like every single trader in the world, every retail trader, where are they going to trail this, right? 10 EMA, correct? Preserve gains, all makes sense, easy stuff. So when it shakes out the 20 EMA, I actually bought this name on a 30-minute pivot at the end of the day. I did not hold it. This is like trial and error. And it makes the move. And it was just like, confirmation of this strategy. But where that really, and now I have a saying, it's like first test of the 20 in a momentum trend is a buy. It's like sources, I made it up because I'm just looking at so many charts. I'm getting inventive based on William J. O'Neill's past teachings. Where did he learn to buy the first test of the 10-week? Sources, he made it up, right? It was just looking at charts over the long haul. So what really helped me in this, so again, I end up buying that DigitalOcean. Again, first test of the 50 has that huge run. Where this really helped me is understanding the first test of the 20 in a momentum run is an absolute buy. So we have this run and I got the 20 EMA up, and this is just something I came up with myself. That's why I kind of want to talk about it. It's like, I think it's such a cool thing that I'm just, this really helped me kill the end of the run. The first test of the 20 in a momentum trend is typically a buy. It's typically the low for weeks on end. And where I got that from is just studying a ton of charts. So we got the SPY daily here up from last year, right? We got the first test of the 20 here, right? And what's that? And at this point, again, I'm studying human emotion. I'm studying retail traders. We have the 200 day, I want to say right here, and it coincides pretty quickly. Most people on Twitter after this big run or whoever you're talking to, they're expecting chop. They're expecting a pullback, whatever. This is when I covered a hedge and I began buying again. This is kind of the first real application of it. And then I was legitimized again after. First test of the 20 and the momentum trend, typically a buy. Back to the semis here. We're so overbought, right? Semis have their crazy run. And I'm trying to work on my hedging game. I'm short the market off these highs because I'm right. We're just so overextended. And then we pull in, and I trim down my positions here from, let's say, 120. You know, I'm back to like 40% invested right here. And people are wondering if we have weeks of consolidation up next, or what's next. But we have the first test of the 20 here, in the leading group, in the leading sector, right? This market's just all about semis, and it's going to continue to be all about semis. So I cover my shorts, and I go, again, this day I go 150% long. And that's what I can put on risk very quickly, because I know how I want to buy. I have a very tight focus list, and I have all these external factors where I'm just constantly studying. So I go from like 30% long to 150% long that day, kill the end of the run, right? That's when we have 10 straight days up. But it's very important to also note the cues here. I understand the leading sector. I get short this day. I actually kill. I crush a hedge short, and I cover this at lows, like literally at lows, and I flip, and I just get so aggressively long because I have this theory about the first test of the 20-day, and I see semis, the leading sector, the leading group, do it. Again, at the same time, Kospi inflection point, right? And it's all these little, and then I see the next day, I wake up to this news, I begin buying at this day, thinking it's going to hold up. When I see this, that's like confirmation. And you look at semis that time, it perfectly coincides. So it's like finding that driver in the external environments, right? The external drivers. And it's constantly mixing all these layers of probability together. It's important I tell my traders all the time, you win a little, you win some, you lose some, you keep on fighting, because you never know where you're going to be in the end. That's unfortunately a Gordon Gekko quote, and you notice I grew out the hair a little bit. That's kind of the next, next thing. But you win a few, you lose a few, you keep on fighting, because you never understand how much more you're going to learn in future cycles, how much better you're going to be able to handle these environments. You just got to stay in the game and keep fighting and keep learning. So, I keep telling people I learned so much more in the last even in the last 8 months since our last interview. I feel like I'm a completely different person, completely different trader. In that last interview, I was dying to tell you what size I had, 10, right? 15,000, thought I was the coolest guy in the world, telling you all the size I had, right? I must be a real trader, blah, blah, blah. Completely losing that, persona, completely losing that thought process, just trying to crush the ego and just kill performance, just crush performance. That's what it's really all about. Yeah, and that's really the main things I wanted to touch upon. I still think this market looks good. We saw the expectation breaker in semis, but if you don't have any more questions, maybe we could call it there. Your call, whatever you want to do.
I think that's a good spot to leave it. Were there any
Good
other
spot,
key takeaways that you wanted people to walk away with today? Anything else that you want to kind of double click on to really emphasize?
Be inventive. The more you look at charts, the more you'll learn. Understanding cycles. Look back. Look at 99. I am like a fiend for past analogs. I recently talked to a trader at PTJ fund. I don't want to blow him up. He's at PTJ's fund, and he's like, we don't put on a trade without an analog, right? And these guys just have a deep study of all the past market cycles that it gives them so much information in future cycles. And he famously, right, he shorted the 87 crash because it looked like the 1929, right? And it's just an analog. So if you're constantly learning about past cycles, right, this chop period, I was able to navigate this chop period so well because it reminded me so much of the 70s when we had that roaring inflation and the war started and oil's up and we have that gap up and everything changes, right? It's dynamically approaching these different strategies for different markets. And just never stop learning, right? You learn so much more about yourself. That knowledge compounds, and really that's the message I'm trying to send. Just so you win a few, you lose a few. You got to keep fighting in this game. You never know where you're going to be if you could just keep pushing. That's really my message to traders.
Awesome. And I think never stop learning is like perfect for, that's the whole goal of this conference, is to get exposed to so many different ideas. Take one thing from, each presenter. Today it could have been the keep one share, so you're staying focused on a name. It could have been get on your radar, let it come to you. All these little things just add to your knowledge base and will make you the trader you want to be over time. So Sheikh, thank you so much. Did you want to say anything else, or are you good?
No. And it was just like, all these things came about because I'm so focused on my emotional state, right? Yep. Letting it come to me is because I used to chase, right? And it's just having so much faith in my strategy and looking at so many charts over time that ridding your life of FOMO is another message I'd really like to leave with traders. You live just such a happier life if you can lose that FOMO of chasing. It's very important. You might miss a couple names here and there, but overall, you're going to take so many less losses in your career and just live a happier life, right? We're all trying to not have our P&L affect our outside lives, but we're all simple Neanderthals. At the end of the day, we are happy when we win. We are angry when I lose, right?
Yep.
And I can train myself to not be like that. But listen, I put so much time and effort into this stuff that I'm going to be upset if I catch myself making my mistakes in my strategy. I'm going to be happy when I win. And, you know, it's understanding that on the deepest level. That's my final message. You can get out of
Awesome. Shake, thank you so much for your time, for putting all this together. To everybody watching, I hope you guys enjoyed. Leave a like down below for Shake, and we'll be right back. Stay tuned. Okay, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Clement Ang. He's a portfolio manager and top performer in the U.S. Investing Championship Money Manager $1 Million Plus division. There's a little bit of a tongue twister there. And today he's going to be kind of dissecting the recent action in the market and distilling the key principles that we can apply to future market cycles as well. Because as we know, maybe they don't repeat themselves, exactly, but they often rhyme, and there's a lot of great lessons to learn here. So Clement, first of all, thanks so much for taking the time. Really looking forward to this. And let's dive right in.
Yeah, thank you, Richard. Thank you guys for having me back again after just a couple of months. It just feels like in 2026, like it's only been 6 months, but it just feels like a couple of years.
Time's compressed. Yep.
Yeah, markets are moving so fast and all. But anyways, I digress. Thanks for having me back. I think kind of before I start, just a brief introduction to myself. As you mentioned, I've been a trader for I think about 7 years so far. So I started trading in 2019, and then I decided to participate in the U.S. Investment Championships. Right. So for 2024, I think I returned over 80%, and then 2025, for the $1 million division, I returned 140%. And then from that point onwards, I was thankfully offered an opportunity to be a portfolio manager for a
Congrats.
family office. Thank you. And so yeah, like this year has been quite the roller coaster for me. But the timing of this TraderLion conference, it just lines up so well with kind of like kind of what I wanted to present today, which is, handling a market cycle, right? A lot of newer traders kind of have, questions about, okay, situational awareness, setups, stock selection and everything. So hopefully with this presentation, I could kind of like shed a little bit of light with regards to, the little details that you might have missed, especially if you're kind of a newer trader and, you've read the books, once, but then you didn't really pay attention to the details. And so I kind of wanted to rehash it here and hopefully, we could all learn something from it. So yeah, without further ado, I guess here we go.
Yeah, let's go.
All right. So kind of before I begin, I think the first thing that I wanted to kind of talk about is this concept of path dependency, right? So, as momentum growth type traders, we're all basically trading the same thing, right? So if we kind of think about, the leaders of this particular cycle, you count on your hands like NBIS, ARM, Marvell, AHR, we're all trading the same tickers, but then we all end up with different results, right? And so like, why would that be? And I kind of like have this belief that, in order to kind of maximize your returns, every single decision you make matters. And so you could kind of imagine, the decisions that you make over time, it's like a decision tree, right? So you either do A or do B, and like every decision will affect whatever happens later on. And so, for example, if you have made a trading mistake, that usually kind of spirals and domino effects into even more trading mistakes. Conversely, if you kind of start on the right foot, so say, starting out the year, you preserve your capital, you make good trading decisions in a poor market environment, and then by the time the market environment is favorable for your strategy, you're in a good headspace because you protected your capital, and then like you could kind of trade the same tickers, and then you get like tremendously better returns than someone who kind of started the year out over trading in a poor market environment, and then they dug themselves a hole. So by the time like, oh, the environment turns, and it's an easy uptrend, they're just not in the financial and psychological headspace to kind of take advantage of it. So like, it goes back to, trading is making good decisions over time. And like, the difference makers in terms of your performance, it comes from, number one, how deep you understand your edge, right? So when you should, when to recognize to step on the gas and be very aggressive, and when not to, how well you protect your capital. So, in our previous interviews, I kind of stress, you should always kind of approach your trading as a business from number one, kind of preserving your capital first. And once you're able to do that, you kind of aim for consistent profitability. And once you've built that cushion because you're consistently profitable and building your equity curve, at a certain point in time, when all the stars align, you can be very aggressive and you gun for it, right? Your mental capital and your mental fortitude. So people who are mentally tougher, so for example, someone who is very used to having a 20% hit rate strategy, and they could, someone like a Martin, for example, they could just, lose eight times out of 10, but then they'd be massively profitable. But, someone else may not be able to take that type of pain, right? Losing 8 times out of 10. And then, of course, the last thing is your experience in the market. So, the longer you trade, having survived so many market cycles, naturally you will have a better knack of, when to spot a big opportunity and, when to kind of go fishing or take your foot off the gas because the market environment just sucks. So path dependency is very important. When you're trading and investing, every single decision matters. And so like with that in mind, it kinds of like you could think about over trading as a problem, right? Like, okay, now that I know that every single decision matters and it will affect how my end results will be at the end of the year, you probably want to make good decisions, right? Over time. So like, I kind of wanted to start with the context in mind. So before 2026, let's kind of take a step back. So, we've had Liberation Day in, I'd say, April of 2025. And then, the markets bottomed then. And since then, we went on this like rip-roaring rally, right? Non-stop all the way into October. And, the 10th of October was when Trump threw a little tantrum. And then we had this very, very big downside bar, which marked the character change in the market, right? So previously, from Liberation Day all the way to that point, everything felt so easy, right? Of course, like in between, you have bouts of choppiness and stuff, but for the most part, you had, many themes firing, a lot of setups were following through. It just felt, easy to make money. And then after that character change bar on the 10th of October, things just got very choppy, right? So the opportunity set thereafter, going into, the end of the year and the beginning of the year was much different, right? So you notice that things got much choppier. It was very difficult to gain traction. The opportunities in general were limited. Now going into 2026, there were opportunities here and there. So like the beginning of the year, we saw SanDisk, break out of a pretty nice multi-week base. There was the whole parabolic short in the precious metal space. And then February was pretty good, right? Like, the market started to correct. So there were some very nice short side opportunities. So for example, Palantir reported earnings, it gapped up into resistance. It was an easy money short. And then, March was kind of when things got very difficult, right? So March was when we had the war. It broke out, and then things just got extremely choppy. And, if we look at the index, it just slowly kind of grinded its way lower. So even for, traders who want to trade the short side, like this grindy type action before the final flush towards the end of the week was quite difficult. And so like, this is the context, right? That the past 6 months was a lot of pain, a lot of chop. There were opportunities to do well, but for the most part, if you weren't on your game, it was just a very difficult market to trade. But, that being said, it was 6 months, right? So going into the end of March, you kind of saw like the price just kind of like cascaded lower towards the final week. And then eventually it actually undercut and rallied a prior low on the left-hand side of the chart. So this was the August, September, price low. And if you kind of noticed, ahead of a follow-through day, which is what, a lot of traders like to look out for before they kind of get involved on the long side, you would usually see an undercut and rally in the index. So another example was last year in November. I remember, I think it was the 22nd or 23rd of November, NVIDIA reported earnings, and, the markets kind of gapped up, but it was a gap into resistance short. So right at the open, I think we spoke about this last year, SOX S, like it just, open and then like kind of went sideways for 10 minutes and then it just ripped higher. And the next day, the QQQ undercut and rallied against the 10th October low. And the opportunities there were the precious metal space, the memory names, some space names, and the optics, right? And those names actually kind of carried over into next year, and it remains like very strong since then. So like the first tell of a potential trend change, when you look at the index, look for undercut and rally. So that's number one. Okay. The next thing was kind of taking into context of what was happening in March, right? So we had the war that broke out, and when the war broke out, you saw oil. So this is the bottom panel of the chart. It began to rip higher. And so what did equities do in relation, right? So as oil kind of worked its way higher, the NASDAQ or the Qs kind of slowly dripped lower, right? And it was just moving in an inverse relation to crude oil. But towards the end of March, you actually saw a slight divergence, right? So I don't know if you remember that period of time where, Trump kind of threatened to destroy the entire civilization of Iran, and oil kind of retired. But what did equities do? Equities went higher too. And so that was like a second kind of very, very subtle hint that, oh, something is different this time round, right? The narrative was always kind of crude go up, equities go down, but we're seeing crude go up, but equities go up too. So what's kind of going on? And like when you see that, if you closely follow the news flow and the narrative, Jason Shapiro likes to call news failure, right? You kind of expect the inverse relationship, but somehow you're not getting that anymore. So what's going on underneath the surface? You could argue that everyone's been shorting and they're all on one side of the boat, or they've all gone to cash because they got destroyed the past 6 months and they're so negative on the market. And you could kind of see it on social media as well. Like, you post a long set of it, like, no, I don't want this, this is bad. We're gonna, you're gonna go, I don't know, we're gonna go much lower in the market. And you could see the sentiment. So usually when you kind of see things like that, you could kind of think, okay, something is going on and I should pay, close attention, right? So that's kind of hint number 2. And then hint number 3 is, William O'Neill likes to talk about leadership, right? So if you kind of read How to Make Money in Stocks, and I kind of implore everyone to not just read it once, but read it many times. You could kind of spread it out like half a year, read it one time. Make sure to go through the first 100 pages. He always talks about leadership, right? And leading stocks like to take, the time, especially during a market correction, to kind of build bases, right? So, we always talk about relative strength. Like, what is relative strength? It's kind of when, a group of stocks kind of diverging against the index, making use of, market corrections to build constructive bases. And, the moment the market releases, its energy and decides to, come out of a correction, these stocks are usually near 52-week highs or all-time highs. And then they just kind of break out of bases and go on a very big run. And so that was kind of hint number 3. If you look at this set of 8 charts, right, and I've kind of like highlighted it in the yellow boxes, this was the period of time, like in 2026, especially, you could kind of see as the market was going lower, some of these stocks are going higher. And it isn't just that, right? Like, if you look at the group of stocks, you begin to notice a theme. And so what was the theme then? Like, most of these stocks have something to do with the AI infrastructure build out. And that, has been the dominant kind of driver of this bull market since the beginning of, 2023, when we kind of got out of the 22 bear market. So when you see a large group of stocks kind of diverging against the index, you really have to kind of pay very close attention, especially when, positioning is offsides, right? Like, everyone's negative on the market. They don't want to buy stocks anymore. They kind of feel like it's the end of the world. Being somewhat contrarian, you want to look the other way and see, like, what happens to these group of stocks. So even prior to, the index gap up on the 8th of April, when I think it was Trump finally decided to tackle and announce a ceasefire, there was plenty of time to kind of get position into all these leaders. You could either buy pullbacks, or if there was a way to buy a breakout, you would have been able to get pretty well positioned before, the run-up that we've seen in April and May. And so before I kind of go forward, I'll probably stop here. Do you have kind of any questions for me?
Yeah, this is fantastic. I wanted to jump in and ask, how did you notice these charts? Is it just in your routine as you're going through the normal screens you're looking at that you start to see this group together? What's kind of your process for spotting RS during a correction? If you could explain that.
Yeah, that's a very good question. So the first part, definitely the routine that I run. And so, especially during market corrections, right? So let's just say, hypothetically speaking, you don't trade the short side at all. You're just a long only, growth investor. You only want to do the long side. And so corrections are actually your best friend to kind of spot the spot relative strength and pay very close attention, right? And so part of my routine is, first of all, over the weekend, I kind of, use deep view and I run a general screen, right? So of stocks in uptrends, right? So, things that are trading above the 200-day, trading above the 50-day simple moving average. Those two moving averages are sloping up. And then I impose like a minimum dollar volume. So let's say I want the liquid stuff. So I trade stocks that trade above $100 million on average a day. And then I also impose a volatility filter. So like how volatile these stocks are. I want stocks that move at least, say, 3.5% ADR on average. And I just kind of run through every single stock on that list every weekend. And I just, put that in a watch list. And every weekday, I trade in Asia right here. So when the market's open, it's at night. And so every morning when I wake up in Asia time, so markets are closed, I begin to run through that same list of stocks every single day. And in the process, right, I kind of have different watch lists. So, I have a general watch list, stocks that are trading above the 50, above the 200, above the 20. And then conversely, I have a breakdown watch list, which is, stocks that are trading below those moving averages. And every single weekday, I kind of like flip through every single chart and I start to tag them, right? Based on the technical position of that stock. And so that's one way. And then the other way is kind of like, I would call it like contextual based screening. So for example, let me kind of go back. So the NASDAQ, right? Say in the month of March, right, when it kind of like grinded lower as a result of the war, the NASDAQ was trading below the 50-day, the 10-day exponential, and the 20-day exponential, right? And so at that point in time, like, okay, if you think about what relative strength is it's a stock that is technically stronger than the index, right? So say for example, if the index is forming a lower low, but a stock is forming a higher low, that by definition structurally is relative strength. Another way you can look at it is the Qs is trading below the 50-day, but the stock is trading above the 50-day. That is also relative strength. And so like you could kind of modify your screens to look for stuff like that based on the position of where the index is trading. And then the other thing is, say you could do it based off of a time period as well. So for example, if the Qs traded down 5% on the week, you could screen for stocks that are up 2% on the week. Okay, then you could find stuff, that are relatively stronger. And then you kind of do that over time as the correction progresses, and you will begin to kind of see a group of stocks consistently show relative strength. And then the next thing is like, okay, other than just individual stocks showing consistent relative strength, you start to see a group of stocks belonging to the same theme showing relative strength. And then from there, you could begin to dig deeper, which will kind of eventually push you to, the list of stocks that I've kind of shown you right here. And so like my advice, especially for newer traders, is you should kind of view corrections as the best time, to pay attention and to be very excited about, because like obviously, if you were heavily long during a correction, you wouldn't be happy because you're losing money. But if you kind of recognize that a correction is here and you've stayed, 100% cash, or, if you trade short, you're kind of making some profits on the short side, you're kind of building up your cushion for the year, you'd be pretty happy to be in a position to kind of take advantage of, the start of a new cycle once the correction ends.
Yeah, perfect. It's like a full reset, right? It's like all the charts set up again. And can you go back one slide? I just wanted to add one quick thing. I love the different ways you were talking about spotting your S. So if the QQQ or whatever you're using to judge the market is below its moving averages, what stocks are holding above it? And also for me, it's like that last flush down. That's where the RS really shines often. Like we see the market making a lower low, what stocks made a higher low? And I think NBIS was a really good example of that this cycle. And then one more thing I'd add, just for what I do, is when that key low happened in late March, if you could point that out, maybe Clement, the low
right
for the
here.
correction. In the days after that, you can kind of run a screen, or in DeepView, you can kind of have a data point that's like price percent change last 3 days, last 5 days. and you see what's bouncing the strongest from that key low. So that's another way to kind of spot the RS very early, just on the snapback, right? What stocks are snapping back highest, which ones are closest to highs. All that is perfect. So Clement, yeah, great explanation. Thank you.
All right, no problem. Yep. And so yeah, kind of going back to this, just to summarize very briefly, look for leadership. Look for stocks diverging from the index. That's your biggest hint that we may be close to a resolution soon. Regardless of what the news flow is like, it's going to be the worst at the bottom. And so you want to pay attention to price, and pay very close attention, because if you could get this part right, whatever happens, we talk about path dependency, right? Whatever happens after, it's going to be a relatively easier ride compared to you missed the initial move and then now you're scrambling trying to get exposure, and then you will make mistakes. And trust me, because I've done it before. And so this is kind of like what I've eventually resolved to, which is to pay the most attention, during a correction.
Excellent.
Yeah. And then so I think this is so kind of like digging deeper into the cues, so the index action. The other hint that you could kind of take away from this is, so this kind of marked the start of the war, right? So this was the beginning of March. And I remember this very vividly because I was long precious metals and the miners, and I was heavily long. And then the war started, and then the Monday came, and I got absolutely smashed. Okay, but I digress. Anyways, so you would notice when the war took place in March, every single Thursday or Friday, you'd see a de-risking event take place. So you'd normally see the queues close down in the session going into the weekend. And it kind of makes sense, right? Because you could imagine that investors and traders don't want to take that weekend risk. Like, you don't know what's going to happen with the war. If there's some major escalation on Saturday and you're long, say goodbye to your profits come Monday, because we're going to eat a big fat gap down. And so you saw like weekend de-risking taking place on 4 separate occasions in the entirety of March. Now, like after the final low was made, and then we began to saw equities kind of move together with crude, what happened in the days after? So like on the 2nd of April, we actually saw the market gap down, reversed higher, and closed at the highs going into a long weekend, right? So you had Friday, Saturday, Sunday, and you're like, oh, this is interesting, right? Because we've sold down in every single weekend, and now we're going to close higher. So it's another tell, if you kind of pay attention, that, okay, we've had that decoupling, right, with regards to crude and equities. We have leadership. And now on an index level, and probably in individual equities too, we're kind of having this strength come back in. And if you look on the left-hand side of the chart, you like all these like very dark gray bars. These are distribution bars. And then finally, to be in April, we have our first. So this dark blue bar is a 10-day pocket pivot volume signature. And so you're like, okay, this is accumulation. Another tell for you to kind of pay attention and start to maybe test the waters in terms of exposure. Yeah. And so the next thing I kind of wanted to go through is this clip from Dan Zanger. I don't know if you guys are able to hear it, so I'm going to try. Richard, you just let me know if you could hear the audio, but I think this is very important.
What would be your biggest single lesson, do you think, in 2005?
Not to be in the market all the time and to trade far less than I do. Far less. I mean, I really have found that the market may have 2 big moves during the year, and they may last 6, 8, 10, 12 weeks, and other than that they just exhaust themselves after that, and really the rest of the time the market is just consolidating the gains. So the big lesson for me this year has been, just to trade less, trade fewer.
Yeah, but did you manage to hear the clip?
Yeah.
Okay, so this is Dan Zanger. He's a little bit of a legend, making his fortune in the .com market. If you don't know him, highly recommend you kind of read up his story. But the reason why I wanted to bring this up is to kind of bring across the point that, momentum markets actually, occur 1 to 3 times a year, sometimes 0 in a bear market, right? So when I kind of look back at my trading in 2025 in that competition, I realized that there were really 2 easy periods to kind of take advantage of, right? The first period was shortly after Liberation Day in May, when the market leaders had shown themselves, and then they kind of went on this massive run, right? It was a very nice momentum market in the month of May 2025. You had your IPO CoreWeave go from, I think it was 60 to 180 in a couple of weeks. And that was like very, very easy. Like you would find that breakouts were following through, pullbacks were getting supported. It was just very easy. And then kind of like the in-between periods, it got choppy, right? Breakouts weren't following through. You probably get a morning push for the first 15 minutes. The next thing you know, price comes back and takes out your low of day stop, or stops you out, generally. And it's just a very, very choppy affair. And usually it's like, if you're participating in that type of environment, you're going to lose money, right? If you're not nimble, you're not fast enough, and you haven't adapted and changed your trading tactics to suit the environment. The other momentum period last year was in September, going all the way into November. Sorry, not November, but October 10. So you had, the quantum names. So IonQ, Rigetti, QBTS, they were forming like picture perfect multi-week bases, and they just broke out and doubled very quickly in a couple of weeks. You had like multiple themes kind of running at once. You had your strategic mineral theme, as a result of Trump. You saw like MP, and then a lot of the strategic mineral shitcodes, they were like going bonkers, going crazy. Christian like bought USAR, and then in a week it just up 140%. So that was easy, right? And then after that, like it got choppy again. So like kind of when I look back at my trading, I'm like, if I were to cut out the excess fat, if I decide to be like Dan Zanger and commit to just trading the easy periods, I would be able to keep a lot more of my P&L, and also kind of to preserve my mental capital to be able to take full advantage of these periods, as compared to say, okay, I trade a momentum market, the environment changes, and then now like, okay, now I have to short, I have to go for 1 to 3 day swings. I'm marginally profitable or I'm losing money. It's very frustrating and aggravating. So I kind of deplete my mental capital. And then by the time the next momentum market comes, I'm not fully equipped to take advantage of it. And so kind of like looking back at this clip, I just felt like, okay, if I were to make trading easy for myself, what is the low-hanging fruit? And the low-hanging fruit is you trade at the beginning of a momentum cycle, which usually occurs after a long consolidation period or after a market correction, ideally, right? So after market correction, you want to be the most active. And then as the trend kind of matures in duration, you want to kind of begin to take your foot off the gas, be less aggressive because things are going to get crowded. The environment will likely change after a period of time and things will get tough, which is kind of like what we've seen in April and May. And then now going into June, July, it's been very tough, right? So I wanted to bring across the index chart to just, to reiterate on this point. So like, okay, going back to 2026, we had a brutal sideways and then a chop correction lower. And then we got, the momentum higher, right? So to begin April, you notice, the trend is changing. And why I say like it pays to be the most aggressive and to be the most active at this time is because of, generally speaking, it's because of positioning, because nobody is in the pool, right? So what you'll realize is that breakouts will follow through easier. Pullbacks are getting supported because, to an uninformed retail investor, they just think that the market is crap or it's not doing well. Whereas someone who's paying attention and, understands the strategy, this is the part when you should be paying the most attention to be the most aggressive in establishing exposure, provided you're gaining traction. Now, as the rally kind of extends in duration, so, okay, say April was the easiest to get position. May, still okay, but then it's getting more and more difficult as you kind of go towards the end of May, where everyone, your mother and son, my grandma, my grandpa, now knows that the market is making all-time highs. And like the rally is pretty mature. Your leaders have probably doubled already in a month. And, that's kind of when you begin to notice, right? So first of all, the quantity and the quality of your setups later into the cycle begin to deteriorate. So compared to the beginning where, oh my God, like everything is setting up, everything's breaking out. I have so many things I want to buy, push, push, push. And then now, like as the rally matures in duration, say a month or a month and a half later, you're like, what can I buy? Like, what are the setups? What is the new theme? Where could capital potentially rotate into? You begin to have these questions. And usually before a market pullback, you start to think, hey, I don't see any setups. What's going on, right? So when you kind of think about that, when you think about it from that perspective, it makes sense to kind of put on risk at the beginning. And as the rally matures, you're kind of like feeding the ducks, right? Like you're reducing your risk. You're being a little bit more cautious. You're probably holding on to a couple of leaders, so you don't have to be you don't have to actively trade or get position. You sit there, and the moment you sit there, you're not pressing the button. You're making less trading mistakes. So then you're able to keep more profits because you're not making dumb trades and then losing money. And so the point I wanted to bring across here was, we talk about like progressive exposure, and I think like a huge mistake is some people take progressive exposure a little bit too literally, in the sense that, okay, you start off with say 0.1% capital risk. Okay, this trade works. Then you do 0.2 and you do 0.3. And then by the time you reach 1% capital risk per trade, you're already late, and you're like the biggest at the end when you should be the biggest at the beginning, and then you kind of peel off at the end. So I'll stop here. Do you have anything you wanted to ask me?
Yeah, let's dive a little bit more to the progressive exposure, because I think it's an important point. So you're basically saying, in general, your observation is that traders are a little bit too cautious scaling up when they see that initial progress, and they should be a little bit faster with that. Once trades start working early in the cycle, things are working, there's more setups, all of that, you should very quickly get to whatever your full risk size is, right? But then later in the trend, even if you've got your profits, that's a time to be maybe even a little bit less risky. Maybe if your normal risk per trade is 0.6% of your account, maybe at that time it's 0.4 or 0.3. Just to dive deeper, I don't want to put words in your mouth, but is that how you typically approach it? Is very quickly you're ramping up to full risk size, and then later in the trend, as you start to see, that this is more mature, it's already mature, there's some rotation out of some things, that's when you start to scale back that risk. Is that right?
Yeah. That's about right. So for example, at the beginning of the trend, like, so it depends on a couple of factors, right? So the first factor is how much cushion you've built up to that point. Say if you look at year-to-date performance, right? How much cushion you have built up to that point to have the confidence when, the environment kind of shifts, you're able to be quick, right? And ramp up exposure, provided, say, you take one trade, there's traction, and then the next couple of days you see more setups, and then you kind of go back to normal risk size. The second thing kind of like closely related to that is how well you know your strategy, right? So really taking this time to study like what happens after market correction, it gives you the confidence, once you see all those signs that we've kind of spoken about above, to really, take that bet and step on the gas. Again, the context, provided that you have traction, right? So you take a tester, say you start off 0.2% of equity capital. Oh yeah, and it works, right? And so the next trade, when you see a couple more setups, you're like, okay, I'm doing 0.5%. Let's just see how we go. And I also want to caveat that everyone's different. So it also depends on your psychological makeup, right? So some people are naturally more risk averse. And so they want to be a bit slower, which is fine, because if we kind of think back to April, there was a pretty large window, like I'd say 1 to 2 weeks, where there were a lot of things that were setting up. So I'm not saying like, oh, you have to go, full margin in 2 days, but if you're able to be quicker, then it kind of makes the difference in terms of performance, right? Because what I've also noticed is like as the market turns out of a correction, you get those A+ setups, but as the rally matures in duration, you don't get the A+ setup. So you want to size your A+ setups bigger, and anything after that probably smaller.
Yeah, and using this uptrend as like a case study, it was kind of a little bit tougher to get invested in those first 1 to 2 weeks because we had that gap up, right? We had that news related to gap. So what was your kind of mindset going to that gap, and how did you kind of start building, even dealing with that? Because a lot of people see a gap up and they think it's going to get filled, right? Even though it's kind of a sign of significant strength. So what was kind of your mindset with that? Because that's likely going to happen again. And actually, this whole rally started in early April with an unfilled gap off the very lows, if you want to point that out. And that's
right here.
that's maybe not one that's directionally actionable, but it's like a really positive sign that people should be looking for.
Yeah, that's a good question. So kind of how I approached it here was I was actually pretty heavily invested before this gap up. And it's because, first of all, we had that unfilled gap up, right? And then going into April, there were actually stocks that have begun to set up and run. So I was kind of putting a couple of testers and they were working. And I saw even more, even before this April 8 gap up occurred. And kind of like, I've kind of, I wouldn't say I'm very good at it, but like I've kind of studied what happens after a correction. And I took the time to really kind of look at what happens to a market leader, how they kind of form bases and things like that. So, and then kind of looking at all the signs that I kind of picked up and we discussed about, I had the confidence that even before that gap up, like I know like people can say it's a binary event, but like number one, I had cushion for the year. Like if I get stopped out of everything, I'm fine. I just go back to the drawing board. So it was kind of like a go big or go home mindset. And then number two was like I was getting traction. Like the positions I was putting on was working. So like on that gap up, I was kind of a net seller because, I wanted to kind of lock something in and then, see what happens. Because like I shared the same worry, like what if this gap gets filled, right? Like I have no way of predicting the future. But that being said, like even after the April 8 gap up, there were still many opportunities to hop on board, right? So, I don't think it's too much of a worry, like especially at the beginning of the trend. It's just
it's a sign of strength. It's a sign of breadth expansion, all of that, and then you just kind of have to wait for the stocks themselves to show low risk entries, whether that's a tight area, a pullback, whatever it is. Would you kind of agree with that? I don't want to put words into your mouth.
Yeah, that's right. So then like, once you've kind of recognized that the environment has shifted, it's then a matter of, finding the stocks that are presenting the low risk entries according to your strategy, right? So for me, like, I don't just buy breakouts. This year I've kind of evolved to buy pullbacks a lot more. And that has been easier for me in terms of establishing exposure. Cause like, this particular rally, like, you've mentioned, Richard, like it was quite special in the sense that it was basically lockout. So like AMD as an example, we could pull up the chart later. I couldn't find my way into it. It just went, it formed like this multi-week base and then it just went straight up. So it was difficult, but then, there were other opportunities that allowed you, other stocks that set up that allowed you to hop on board.
Yeah, perfect. I like what you said there about the mindset shift. Like what you've studied corrections in the past, and like what you're presenting today is a good template to learn from. We had those months of chop, the final flush out, and then that unfilled gap off the low. That was like the first clue, right? And then we had, like you said, the changing character where instead of in the end of the week we're de-risking, we have a buy up of a week open. So those clues, if you can start to kind of build a list of those type of things to look for early in a market rally, they'll get you in the right headspace to start testing trades earlier, and that can pay off in a big way. That starts that decision tree off on the right foot. So perfect.
Yeah, that's right. And now, like, what I would kind of implore, newer traders to kind of study is you could also kind of take this template and study the Liberation Day low. It was quite similar, shockingly similar to last year. Not saying that, like every correction will be different. It just so happens that, okay, this seems like eerily similar. So, from my perspective, that was kind of thinking back to last year. I'm like, oh, okay, I'll just repeat. And then I just make sure I don't make the same mistakes I made last year.
Yeah, and one thing to add on that is like the fundamental narrative will be different each correction. Like for this one,
That's right.
It was the Iran war. For that one, it was the tariffs. And it's when the market starts ignoring bad news related to that that fundamental event, when it's not like clear yet, like it's not solved yet, but when there's like a hint of it, that's often when the market like starts its rally. So I think I think in the 2025 one, we there was like news of a start of discussions with China to clear the tariffs with that, and that's what like actually kicked off the strong period. So it's always going to be the first hint of a resolution that is when the market's going to start ignoring it, because we're looking 6-9 months ahead. The market's always looking ahead. So yeah,
that's right.
Awesome.
Yeah. So in the next couple of slides, I just wanted to kind of rehash, right, spotting market leaders. And why I wanted to do that is because this was something when I first read How to Make Money in Stocks by William O'Neill, that I looked at the first 100 pages. I'm like, what's this? I'm like, oh, so many charts, what do I do? And I just kind of skimmed through it. I just read the book. I'm like, okay, can slim. What do I do now? But then, over time, when I picked this book up again and I began to go through the 100 pages slowly, and I kind of read every detail, it started to stick out to me. I'm like, oh my God, I missed this, right? And so like, if kind of going back to my performance last year, especially in May, like did I catch the market leaders in May 2025? I did. Did I realize the significance of what that meant? I did not. And so that's why I sold Palantir early at the end of May. I sold Robinhood early at the end of May. I sold CoreWeave, and I did not really catch the entire meat of the move, right? If I had that context in mind, I would have done much better, and I would have made fewer mistakes, which would have bolstered my performance. So the point I want to bring across here in the next couple of slides is, this is a chart, from 1944. So this is like, if you think that it doesn't work now, it actually does work because it's timeless, right? So this at the top here was a market correction. And as the market is correcting, what do leading stocks do is they form bases, right? So this particular chart here is a 43-week cup and handle. Okay, in 1958, Zenith Radio, I believe this was a stock that Darvis bought, if I'm not wrong. But market correction, stock forms a base, 11-week cup and handle, eventually forms a buy point and goes up like crazy. We go further, 1967, market correction in Skyline. This to me kind of looks like a base on base type of thing. But like, it forms an 8-week base, breaks out, forms an 8-week base, breaks out, basically ignores the market weakness. Now let's go forward in time back to 2023. So I don't know if you remember the third quarter of 2023 before the year-end rally, we had a pretty brutal 3-wave down type correction. So at the top here, this is a chart of the QQQ. So we had 1 wave, 2 wave, 3 wave. Now look at what CrowdStrike was doing. As the market was making the wave down, it was making waves up. It was a base on base on base. Eventually it breaks out over here. And then if you kind of look back at the chart, if you could pull it up, it eventually goes up 100% for that move, right? So market leader potential. This is 1998, Charles Schwab. So we spoke about like, how do you spot relative strength? So as the NASDAQ was creating a lower low, this was creating a higher low. So by definition, it was relative strength. And then like we spoke about the index undercut and rally, right? So what was the Nasdaq doing? It undercut and then it rallied. So like another nuance to kind of pay attention to ahead of a follow through day. This was Marvell of this year. So this was the leader of the cycle, or one of the leaders. And we had that grinding correction down. And what was Marvell doing? It was forming a multi-week base. So if you look at the weekly chart, it's multi-week, and it began to diverge, form higher lows, and then eventually break out. And this one was a monster. It just went up, I don't know, like 200% or something. Yeah. And so like the point I wanted to bring across here, so why is post-market corrections the best time to be a buyer? And of course, this is in the context of a bull market. So bear market, just ignore this slide, is, as the market is, correcting, the true market leaders are diverging from the index. It's showing relative strength. And it's because institutions are accumulating these stocks. Or the other way to think about it is as institutions, in a market correction, they're going to be forced to eventually, pare down exposure and sell. Do they want to sell their favorite stuff? Probably not. They want to sell the stuff that they don't want, right? And so those go down the worst. And the stuff that they don't want to sell are probably the market leaders. And that's why you see the divergence between the index and the stock. The other thing is with market corrections, you're basically clearing the deck, right? Like you're shaking out the weak hands. Retail's completely wiped out. They stayed long until they hit their uncle point and they're like, oh, I don't want to do this anymore, and they sell everything out. And you could kind of see this, right? So especially towards especially in let's just say mature trends. So say a rally of 3-month in durations, you'd see a lot of choppy action, right? So especially what we've seen in the last month and a half is a lot of choppy action. You failed follow-throughs, a lot of the volatility, and it's because those are crowded trades. And so with the market corrections, you're wiping out the excess. There's no more crowded trade because no one is positioned, or they're not positioned enough, right? And then the last thing is what I would say, it's like a spring effect, right? So it's kind of like, you hold a spring, it's compressed, and then when you let it go, it expands. And you could kind of think of like this like very expanded spring. I'd label number one. It's like a market in a prolonged like uptrend or downtrend. It's like still in a correction phase. But then as like the market nears an inflection point, we're nearing the end of a correction, like the spring just begins to compress and coil, right? And the leaders, on the other hand, would compress and coil even more than the market. So when you eventually hit an inflection point and you start to emerge into an uptrend, the environment changes. Like the leaders will spring much harder than the index, and that's your alpha. That's your outperformance. When you buy it, it's up 20% in 3 weeks. You're like it's easy, right? So, and you get your traction very quickly, which will give you the cushion to hold as the rally kind of matures in duration. Yeah. So these are like a couple of my trades that I took that I kind of wanted to go through, and I'll go through it in chronological order so that you kind of see my successes, my failures, my mess ups, and like I kind of like ended with some reflections. So this year, given kind of looking back at my trading over the past 2 years, I've decided to make a somewhat of a stylistic switch from being predominantly kind of short-term swing trading to having my go at position trading and trying to hold position for as long as I can. And so to me, like I kind of begin to take inspiration from Dan Zanger, right? Like I want to be the most active coming out of a correction in these momentum markets, and then the rest of the time I kind of want to chill. So I've decided to become lazy in a sense, but then you could also argue I've decided to become more efficient.
Become smart, you mean, not lazy. Smart.
I like lazy. Anyways, so UCTT was one of the stocks. I kind of want to point a couple of things out. So first of all, it was part of the AI infra build out. It's a pick and shovel play. it serves the semi-equipment makers, AMAT, LRCX, so on and so forth, KLAC. And as the market was correcting, so the top panel here, it was forming a higher low, ensuring relative strength. You would also notice, TraderLion, RS line, I like to look at this. This stock is actually in an RS phase during a market correction. So that's my second tell. If we look at the volume, so the volume throughout this base, of course, this is a little bit of a thinner stock, even though it trades about $80 million a day. Volume was drying up within this base. So again, it kind of signifies to me that, okay, there's not a lot of supply coming into the market, especially when we're distributing, right? So it kind of signifies to me, okay, the weak hands are gone. Strong hands are taking hold of the stock. They're accumulating it. It's diverging against the index. And then my buy point was a pullback buy into the 20 EMA. So on this day, I believe it was it was a market gap down open and then reversal higher. And so then, kind of recognizing the character change, I was thinking okay, if UCTG kind of gaps down together, but it is gapping down into support. So you had the 20 EMA, you had that base structure. It should serve as a good risk reward spot to get long if it turns higher, right? And so then at the market open, I put in a buy order as it was turning higher, and this was a pullback buy in the 20 EMA, stop at the low of day. It went sideways, so there were more opportunities to hop on board, and then eventually, I think this was the 8th of April, it just kind of gapped up, and then it kept going. I was trying to hold this, but then I remember towards the end of April, we had earnings season, and I was holding a couple of names, and earnings season is kind of you roll the dice, right? Okay, you got cushion, you want to hold it, and then I got caught in the GLW gap down, and I was like, oh man, I'm not having a good time, so I sold this ahead of earnings. And if you pull up the chart, UCTT, it just kept going higher, and so this chart kind of reminds me a little bit of Palantir. In May, going into, I think, June, July, it had no respect for the 20 EMA. It's just kind of choppy, but it just kept moving higher together with the 50-day. And so for me, I think I called 30% of this move. I guess it's okay. Could I have held this position all the way trailing the 50-day? Maybe, maybe not. But then, it didn't bother me too much because I had a couple other positions that were performing really well. And so this was the 6th of April, right? So where we kind of spoke about 8th of April gap up. Actually, before that, there was stuff setting up. So NBIS was another one where the day before here, it kind of okay, sorry, the day before the day I entered. So I'm pointing at this downside bar here. So this white bar, it rejected the 20 EMA. But then the next day, it gapped down below the 50, and then it ripped higher. So to me, when I saw that, it was an expectation breaker. And then, of course, the other thing is NBIS was forming a higher low as the NASDAQ was forming a lower low. And then, so I decided on that day, well, the next day, because I missed it, I was okay, if I can get it as close to the 20 EMA as possible, I want to buy this because this is a leader. It was also forming a multi-week base, which is what you want to look for. And then, thankfully, it kind of kept going higher. So the thing with this trade, the thing with this trade was kind of looking back at it. I was a little bit too active and cute with how I handle the position. So, we're kind of going back to, I want to be a position trader now. But I'm handling this like a swing trade, right? So I make my buy here, I add on the base breakout, okay, it pulls back, and then it pulls back into the base breakout level plus the moving averages. So you had 2 layers of support, pull back buy. You add to it, and I partial it off, and then it pulls back, gets extended, partial off even more. I add, and then I reduce to a core towards the end of May into June. What that did was it raised my average cost up way too high, right? So, if I had a broker that can allow me to, have separate positions, then I can manage it individually. I think that's fine. But the reality is like after all my ads and reducing and my add backs, my average cost is just pushed up there. And so then when I kind of think about that in the context of, oh, I want to be a position trader, I can definitely hold through a 30% base building period, top to bottom. I can't. It was difficult psychologically speaking. So with this trade, I eventually kind of sold it out when June got very volatile. And I'll speak about it in my reflections later, but I realized that I can't. Position trading is very difficult, man. 6th of April again. This was ST Microelectronics. If you pull up the weekly chart of this, so first of all, again, like same thing. It was base building as the market corrected, and then it staged a base breakout. And so I was kind of buying this with an arbitrary stop. So I was just like, because at this point, like on this base breakout day, I kind of felt like I was chasing it. So then I put a wider stop because like if it breaks out, it will go on a big move. And it did work. It went on a big move. But I made a mistake of kind of arbitrarily selling it a week or two later. And if you kind of look at this chart, it went way higher. So this was a case where I caught a leader, but I messed the trade up. Like, if I decide I want to sell at the 20-day moving average, this never even touched the 20-day moving average.
Selling is hard, man.
Selling is hard. Yeah. We live and you learn. Anyways, ARM. So ARM was one of my biggest winners this year. Notice that this trade, my initial trade was the 7th of April. So even before the April 8 gap up. So it's kind of going back to the point of there were things setting up. You just had to find your way into it. So actually, I initially bought it on this gap up here. I believe it was a catalyst that day. So this is another thing.
Yeah.
GPUs, yeah. Agentic AI, GPUs. So this is kind of another thing you could pay attention to closer to an inflection point is like you begin to see companies like announce catalysts, which happens to fit a theme. So like ARM was with like, they're beginning to make chips for agentic AI. So this was the whole CPU theme along with AMD and Intel. The 31st of March, I believe Marvell had some sort of catalyst around that time period as well. And then AHR as well had a catalyst. It was somewhat AI related, gapping up. So when you see stuff like that, that's a kind of another tell like, oh, okay, things are changing. We're beginning to see some sort of follow through. I digress. Anyways, so ARM was also showing relative strength. It was moving higher as the market went lower. RS line is in an RS phase, so it's trending above its own moving average. I tried the gap up day, and then I didn't have too much confidence back then, so like I was skittish. I sold out of it as it began to squat. But then shortly after, it begins to kind of like, tighten in range, and then volatility was beginning to contract. So my first buy was a pullback buy, and the reason why I made this pullback buy was, number one, kind of recognizing the market is beginning to turn. So in my mind, I was thinking like, okay, every dip should get supported. And then on the second level is looking at the individual stock. Like if I draw this like blue line here, you could kind of take it as, that gap up day was a break of resistance structurally. And then now it's pulling back into structural support. So that's your first layer. The second layer was this purple line here is my 20 EMA. And this like a faint red line is my 200 SMA. So then you had two moving averages acting as like a guardrail or support to price. So you had three kind of edges there to work with. ARM was gapping down. I believe like the day before, like folks got excited. They're like, okay, inside day, I want to buy through the inside day high. And then like everyone got stopped out. So then in my mind, I was thinking, okay, like a positioning cleanse, right? Clear the deck. Everyone's stopping out. I want to buy it into three layers of support. And so when it kind of flushed and began to recover, I made my entry and I put my stop slightly lower. The kind of like the base or like structural low, right? Which was tight enough for me. Eventually, I made an ad through the breakout point, and then I was selling again. I made the same mistake with this as with NBIS, where I was swing trading my position trade. So I reduced, I added, and then it formed a flag, thankfully, and then I oversized it. So I kind of like added to the position, and then I initiated a new position with RMG, which was the 2x ETF. And then as it kind of went up, like I sold RMG into strength, and I'm telling myself, okay, I've got a pick position in ARM. I'm gonna hold this for, my core. And then like it gets extremely extended, and then like going to June, it got choppy, and then I reduced it into a core. But then the same mistake was I kept adding and reducing. I shifted my initial cost of $130 all the way up, such to the point where when ARM, like right now at current state, is like pulling back 30% and it's like trading wide and loose, I can't hold on to it, and I had to capitulate and get out of it, which is, to be honest, quite a disappointment. But it was nonetheless a good trade. It was one of my biggest ones.
Dude, what a trade! First and foremost, like great trade. You were I like the note there, triple taps, on that fresh breakout. And you had kind of you killed those first two legs. So maybe it's a little bit like the market cycle awareness, where like you want to be heavy in the first two legs, and then maybe aware that the trend is a little bit more mature and you can handle it a little bit differently there. But one observation I made, both this with this ARM trade and the NBIS, if you could go back to that, is big bases, both of them big bases that they're coming out of. And NBIS also had catalysts in do you see the gap up in March 8th or so? March. Yeah. So I think there's like an NVIDIA partnership and then a Google partnership. So it's showing RS during the correction. It's having these catalysts. It was just waiting for the market to take off. So that's just like some looking at these trades that you killed. Like those are commonalities: big base, recent theme related catalysts. Those are like things to add to for everybody watching. These are things to add to your list of like the blueprint of a great position trade. It's got those elements. So great stuff. Thanks.
Yeah, no problem. Micron was another winner. So this one with Micron, you actually did not see any sort of divergence. So it kind of like moved together with the market. So like, for example, like right here, if you look at this flush, it also kind of made a flush. The only reason why it made it to my watch list is, so first of all, like you could take like this kind of rectangle here as a base, right? It flushed, it reclaimed, right? So that was your first sign of strength. And then the second thing was, if you look at SanDisk, if you look at Seagate and WDC at that point in time, they were all setting up in tandem. So you had like, the memory trade seems to is like kind of picking up in strength and setting up, right? It's not over yet, right? You have the whole theme of the memory bottleneck, I think, and then their earnings and sales are fantastic, right? So this was one where I felt like, okay, there could be another leg to this. And then I was basically doing a pullback buy. I believe a couple other traders were trading this too, into the 50 SMA, and then like somewhat, I guess, the 10-20 right below. And, I was just buying that pullback turn on that 5-minute 620 chart. So for anyone who doesn't know what a 5-minute 620 chart is, it's a tool kind of that Gil Morales came up with, where it's like a 6 and 20 period MACD on the 5-minute chart. And then you're basically looking at price kind of like stabilizing intraday and then beginning to turn higher. And then you'll see the MACD cross, you'll see the moving averages cross, and then you're a buyer there. And so that was how I got my entry in Micron. And then I added on the base breakout. The only thing with this, I kind of felt like I was a little bit too aggressive with selling into strength. So like, when we spoke last year, I told you like one of my rules was like, okay, if a stock gets like 8 to 10 times HER extensions from 50-day, I'm taking a position off. And that was kind of how I handled this particular one, where it got to 7 times, I was taking a piece off. And then with every HER extension, I'm like taking 10% of the remaining off, 10% of the remaining off. And then eventually, like at this point, like I was like, oh man, I have such a small position. You know what? It makes no difference. So I sold it. But then after that pullback, it went up another 50%. So, again, like this is another trade that kind of looking back, I could handle better, but, still a good trade nonetheless in terms of P&L.
Yeah, great stuff.
Yeah. Now I kind of want to make a segue into situational awareness, right? Like kind of going back to, okay, you want to be most aggressive during the beginning of the cycle. As the rally matures in duration, you want to kind of be a bit more aware, take note of the traction in your trades, and then kind of maybe risk less, right? Because things are getting more crowded. Everyone wants to jump into the pool. Now, this, credits to Kina and Anthony Shi, on the concept of swing cycles. So like this was in 2024, right? Like when you think about a swing cycle, coming out of a consolidation or say a market correction, what are the first stocks to run? They're usually the market leaders, right? So, and then like as like the uptrend begins to mature, you begin to have like the tier 2, tier 3 stuff. So like, you'll see your a rotation into software names. That's the next batch of stocks going higher. They're not your market leaders, but they're making decent moves. And then like as trades get increasingly crowded, you begin to see all the bottom of the barrel stocks, or I don't want to use the bad word, begin to run. And so in this example, you could see, okay, NVIDIA ran on the 10th of January 2024, goes up 100%. Shortly after that, you had your second tier stuff like your SMCI, right? Which eventually turned out to be a fraud. And then as you kind of go further down into the cycle, 14th of March 2024, you have SoundHound, SOUN, bottom of the barrel stuff. And so when you start to see like this phenomena take place, it gives you a gauge of where you are in the cycle. And from there, you have that situational awareness of what you should be doing in terms of your aggression, right? So like, let's kind of go into an example with this cycle. Probably not the best example, but 31st of March 2026, we had Marvell breakout of a big base, right? So this went up 242%. 4th of May 2026, we saw a rotation into software names. So the narrative was, oh, okay, so, IGV was killed. So the software ETF was killed at the beginning of the year because people thought that, oh, with AI, I could just code up my own software. All these companies are useless. But then it turns out, oh, actually, they are beneficiaries of AI too. So select software companies actually, are doing quite well because of AI. And this was kind of catalyzed with Twilio's earnings first. So Twilio reported earnings. They said that, oh, AI is more of a boon than a bane for their company, and it gapped up, right? And then since then, like you kind of pay attention, all the software names that are supposedly perceived beneficiaries begin to like, show strength, and they all kind of gapped up throughout the month of May in the thick of earnings season, right? So you had DDOG, you had Frog, you had DocuOcean, DOCN, which kind of actually resisted the market correction as well. You had Snow, and then the cybersecurity names like CrowdStrike. So these are kind of like I would say your second tier names. They didn't kind of run at the start of the rally, but they kind of began to set up and they began to run later on, right? And then as you went into the 26th of May, what I saw was laggards rallying. So you had Palantir rallying to the 200-day. You had AppLovin, which was a former darling, a former market leader in 2023 and 24. And then actually shortly after that, what we saw was a market pullback, right? And then eventually in June, it was like, okay, environment change. Things got very difficult. So kind of like monitoring themes, monitoring like where the stock is in its cycle, it helps to develop the situational awareness to know when to be more aggressive and when to be less aggressive. Yeah, so kind of going back to my trades, rotation into software, right? So, as I was like kind of trading the rally, I began to notice software names beginning to show strength. So CrowdStrike was actually forming a very, very nice pivot, grinding right below the 200 SMA. And kind of the narrative was, okay, I would ask myself the question, do you believe that cybersecurity stocks would kind of not benefit from AI? I kind of find it hard to believe. And so when it kind of pulled back into the anchored VWAP from the previous all-time high, I believe there was the 20 EMA as well. And then if you kind of draw a line here, so previous peaks, it broke out. And then now, like, you kind of expect a support resistance flip. Again, like, it's very similar to ARM. You had 3 layers of confluence to perform your pullback buy. And then I eventually added on the breakout. And this was kind of like a very fuss-free trade for me because it just kept locking people out and rallying along the 10 EMA. I eventually sold out of it because of the volatility in June, and I missed the latest run, which I'm still coping about. But anyways, this
It's not much
stock
higher,
actually,
so you're good.
yeah. Again, like this stock also kind of showed structural relative strength to the Qs. Yeah. D-Dog, very similar. So like kind of speaking about the software rotations, earnings season, what I noticed with this particular earnings season was a lot of software stocks were gapping up at least 30%. And then what they would do, I wonder if this is a technical theme, but they would pull back intraday. And then as they kind of base, you buy that and then it just follows through and closes back higher. And so like kind of noticing that was what I did with D-Dog. I believe I initially tried an opening range. I got stopped out. So I had to try this a few times. But I eventually kind of nailed the turn. And then like I was like kind of reducing it egregiously because like it looked somewhat extended on this day going into June into a core position. But again, like eventually I sold out of it because of the volatility. Cloudflare was similar. This one wasn't easy to trade because if you look at the chart, it's disgustingly choppy. But I kind of made use of the pullback buy because I believe Zscaler, ZS, it was gapping down in earnings. And then like rotation to software, right? I was thinking, okay, this is an opportunistic gap down to get into. And then, you know, if you plot the anchor view up of the latest swing highs, it was right there. You had like a moving average launch pad type setup. So I bought it with my stop slightly below the low of day. And then I eventually sold into strength because notice the date, 27th of May, we're quite late into the rally. So the other thing that is kind of worth thinking about is beginning of the cycle, you have your position trades. Towards the end of the cycle, you want to swing trade. You want to sell stuff into strength. You want to kind of like have all those mini equity curve boosters to push your equity curve higher and higher. So you have the cushion when, you know, environment changes, market correction comes or whatever, you don't get hurt as much because of all the cushion you've built up. Yeah. So yeah, like now I kind of want to talk about character change, right? So especially the last 2 years, I've noticed the market goes into an uptrend and then all is good, everyone's having fun, we're in the party, things are gapping up 50%, 70%, and then suddenly boom, you have one character change bar and then the environment just changes, right? So just to give a couple of examples, this was the 2024 market. I don't know if you guys remember, but after the yen carry trade crisis, which established an August low, you know, if you know traders were trading this particular uptrend, although like on an index level it looks choppy, but dude, it was awesome, man. Like there were so many setups, things were just going crazy to the upside. It was very possible to make 100% in 2 months. And then all that changed going to December. So you would notice going into December, you had so much fun the last 2 months. Themes are firing. There's so many setups. Suddenly, there were no setups. Follow through was getting much more difficult. I found myself buying DJT, which is a bottom of the barrel stock, trying to gain traction. And then like going into the middle of December, I think it was like a Fed meeting or something. And then we had this character change bar. So like this very huge white bar, boom, all the way down. After that happened, the entirety of December, January 2025, February 2025, it was a difficult market, right? It was very choppy. There was no follow through. And then eventually it resolved into Liberation Day, right? Before we established the Liberation Day low and then boom, new uptrend. Last year in October, so we spoke about 10th of October, you know, we had such a fun time, you know, everything was moving, party. Trump decides to throw a tantrum, character change bar, and then since then, 6 months of chop sideways pain, right? Again, kind of like similar pattern that I was picking up. This time around, smooth, orderly uptrend, many setups, things are moving like crazy, lockout rally. And then I believe this was the 2nd or the 3rd of June, we had the character change bar. Things began to unravel. And, it's been very difficult since then. For me, like I got chopped up in this consolidation and I gave back more than I was comfortable with, which I can speak about more in my reflections. So like, again, like another point on situational awareness is learning to kind of pick up the very subtle clues of a changing environment. So, a couple of like guiding questions you can ask yourself the next time you trade a new cycle is, first of all, is market leadership. So what are the leaders doing, right? We could pull up a couple of charts later, but if you look at, the leading sector, which is mostly the semiconductor names, what are they doing right now? They're like trading extremely wide and loose. You get a gap up one day and the next day you give everything back on a gap down. It's very volatile. Like you could ask yourself, is that wide and loose price action or is that constructive consolidation? So like the first clue. The second clue is with regards to, I spoke about, your themes and setup proliferation, right? So, all the themes that have kind of ran in April and May, like, as the AI kind of trade developed, you had a lot of different sub themes. Like, what are they doing as a whole? Like, are there more kind of breakdowns or breakouts? Are there more setups? If you don't see much, and that's another tell, right? And then the last thing, and this the most important thing, is your trading traction. Like, look at your last 3 to 5 to 10 trades. Are you in a losing streak? Have you been making money on a net basis? Has, like, if not, then you kind of have to pay attention. And then emotionally, like, has trading felt easy, or have you been more aggravated than normal, right? Like, you buy something, you're like, yeah, happy. And then the next thing, it stops you, like, oh, geez, I don't want to say bad word, geez. So all these are kind of signs that kind of points to an environment that is potentially shifting, in addition to, that character change bar. We may not get a character change bar the next time around. It could be something different, but then, you have additional pointers to kind of like think about, when you're trading a cycle. Yeah. So like kind of, I wanted to bring across a point, like with ARM as an example. If you look at these 3 kind of yellow boxes, you could kind of see what is nice and tight and what is wide and loose, right? So this consolidation here, top to bottom, 17%. The next flag, okay, 19%, about the same. The bars are relatively tight. And then you kind of see it. Like, so blue bars are up bars for me. Sorry if, you're not used to it. And then the white bars are red bars. So like you could see there are more up bars than down bars. And then like look at the latest consolidation. You have more down bars than up bars, and top to bottom, this is a 35% kind of deep correction or consolidation. You also see a lot of gaps, right? So price closes down for the day, next day gaps down, and then go sideways, okay, gaps down again, okay, find support at the 10-week moving average, gaps up, next day gap down. So the volatility is crazy to the point where it's very difficult to manage risk, right? Especially if you're a tight risk, tight stop loss trader, you're gonna get killed on these gap ups and gap downs, right? The other kind of clue that I like to look at, so kind of going back to the TraderLion RS line, is when you see leadership begin to break their RS phase. So like the RS line begins to break its own like 20 or 21 day moving average, and you see a bunch of them. That's usually a sign for me that, okay, things are getting choppy. We're kind of losing relative strength. We're losing leadership in the sense. If you look across all the semis, the optics names, you would see the RS line break ahead of time, right? Light as an example, the RS line became really, really choppy, the past, I guess, month and a half, 2 months. And then now it's like, it's broken down. Yeah. Oh, there you go. Lumentum. So you'd see like, okay, non-linear choppy action, gap up, gap downs, and then look at the RS line. It just looks disgusting. Yeah. So like at this juncture, I kind of wanted to bring across the point of patience and the importance of patience. This relates to overtrading, which I think this year I'm still kind of guilty of overtrading at times, even though I think I've toned it down a lot more, compared to last year. But, two quotes. So first by Jesse Livermore, like when you're doing nothing, speculators who feel like they must trade day in and day out are laying the foundation for your next venture, right? So it goes back to the question of, do you want to trade hard mode or do you want to trade easy mode? Yeah, do you want to put in a lot of effort and burn your mental capital, or do you want to be lazy trader like me, or like at least what I'm trying to do? The speculator who insists on trying to profit from daily minor movements will never be in a position to take advantage of the next important change market-wise when it occurs. And so like my interpretation of this is in relation to kind of, choppy market environments versus after correction, nice, clean uptrend momentum market environments, right? If you're kind of stuck trying to trade every single day and pressing the button, you're burning your mental capital, and you potentially put yourself in a position where you've made so many bad trading decisions that you're just not in the right headspace to take advantage when the market actually becomes easy again, right? And so like, such weakness can be corrected by studying records of stock price movements. So again, kind of doing your deep dives, studying studying market history, studying great traders, how they do it, studying how stocks move, building a model books, and the last thing that Jesse Livermore says, taking the time element carefully into account. So like you could the time element of trading is like very, people don't talk about it too much. So like, just to give you an example, like, okay, we've seen all these semis rip up 100, 200% in the span of 2 months. Like, are you expecting, like, what is your expectation of that? Like, they're formed 2-3 weeks flags now. Do you expect them to rip from 2 to 3 week flags another 100%? Like, or, you start to take the time element carefully into account. You're like, okay, my expectation is after a big move, we probably need a couple more weeks or, months to set new bases, reset the deck before we move higher. So taking the time element carefully into account, making sure you protect your mental capital when times are tough is very important. Yeah. And then the last quote by Gerald Loeb. So Battle for Investment Survival, this book, a successful investor will keep his capital idle in times of popular overinvestment and overconfidence, right? So the point on sentiment, right? At the bottom in April, sentiment was very, very negative, right? No one wanted to own stocks. People think that, this war is going to cause a depression or whatever. We're going to get a market crash. Contrast this to right now. Like, what I'm kind of seeing is that it seems like every single dip has to be bought, right? Everyone is very enthusiastic to own stocks right now because they've ran up 100, 200%. And so like, from a sentiment perspective, like there's a tinge of overconfidence at this juncture where actually right now you should be quite careful and you should be protecting your capital, right? Until, we get another easy environment. Yeah. Yeah. And so like that being said, like I kind of wanted to speak about, I think it's worth asking the question, what type of trader you are, right? So my presentation today is mostly from the perspective of like, being a positional type trader, going for the larger moves. So, for a day trader, it may not be too applicable, right? The next point that I kind of want to bring across is, there are pros and cons to each trading style, right? So, for a day trader in this environment, it's a gift for them. They can like lock in 10 to 30 R a day every day for the past week, and they make a huge return. But then, the downside of being a day trader is you have to make many decisions. So you increase the likelihood of being wrong. You can't catch big moves, right? Because you have to close out your positions at the end of the day. And then there are swing traders and position traders who, benefit from these trends, but then, they get killed in times like this. The volatility having to deal with equity curve pullbacks and stuff like that. So I think like, you have to kind of ask yourself what type of trader you are, and then kind of balance, what works for you psychologically. And why I kind of wanted to talk about this is, having like some of the reflections and the lessons I've learned is, first of all, I April and May was probably the best cycle I've ever had performance-wise. But then I did not heed to the change in market environment well enough. So after that character change bar, like I kind of felt like, okay, I should step off the gas. But then like I was seeing all these names form flags. I'm like, okay, I got to get position again. And then I just found myself getting chopped up to the point where like, okay, if say like I'm giving myself 15% off equity curve highs as a maximum, like I blew past that because of the gap up and gap downs. And I'm like, oh, okay, I need to stop, right? I kind of realized heeding the change in environment is very important. And I made that mistake this cycle, even though it's still a good year for me. But, like I drew down more off equity curve highs than I'd like. And then the next thing is like in relation to kind of the last slide, right? Finding my balance. I've realized trying a positional trading style that I can't do it. Like I can't stomach that 30% like move off highs once like, leaders get extended. And like a 30% move off highs is still at the 20 EMA. But then like I've given so much unrealized profit back, like psychologically, it was too hard for me. And so now like right now I've been in preparation for the next cycle, I'm kind of thinking like, okay, how do I find my balance? Because I've literally went from one side all the way to the other side. Now, how do I go back and find my happy medium? And then the last kind of reflection that I had dealing with this cycle is negative self-talk. Like I found, especially this year, like I've been a lot more harsh on myself. Like, so to give you an example, like I say like with this, like I pull back off equity curve highs, and I find myself like saying things like, oh my God, you're the worst trader ever. Like, how can this even happen? You suck. And I realized like what that happened, like the implications of that is like it becomes like a negative loop where it actually spills over into my trading, and then like it just keeps getting worse and worse and worse. And I realized that it's happened to me, especially this year, and actually not so much last year. So like last year I would make a mistake. I'm like, oh, you know what? Dust myself off. I can get this done. I can do this. And then I kind of recover quite fast leaning on my process. But this year it just kind of felt like worse. And it's something like I'm much more aware of now. And it's like, I'm kind of having to reframe every setback as being positive again, and kind of adopting a growth mindset. And why I wanted to bring this point across is like, I'm sure like there are other traders out there who kind of are in the same shoes. But it helps to kind of take a couple steps back, look at the grand scheme of things. And, like trading is a lifelong journey. You kind of have to adopt the growth mindset, and you really have to have that mental resilience and fortitude to come back from these setbacks, right? Like it's never going to be a perfect game every single time, and I shouldn't have that expectation of myself to trade perfectly, because I will make mistakes along the way. So yeah, that's kind of it in a nutshell. I don't have much to go through, but yeah, this is just kind of like my reflections on trading this cycle, kind of like showing the growth I've had since our last interview, what I've been working on as a trader myself, and just hopefully you guys can learn something.
Yeah, Clement, first and foremost, I think this was fantastic. I think this is like a decade's worth of lessons really condensed into one presentation. So I think a lot of people are probably scribbling down a ton of notes. So thank you first and foremost for taking the time to put this together. To your last point about being kinder to yourself, negative self-talk, I think that's a really underrated and really important concept to think about. I think, with social media, we're comparing ourselves to, everybody's killing every trade. If you didn't catch this stock, you're a terrible trader. when the reality is like everybody has their own process, their own system. You're going to miss a lot of things. And like you said, it's about adopting that growth mindset and just trying to be the best you can be for that cycle. And you're going to make mistakes because we're human. We're not going to catch everything. So I think a lot of people can relate to that. So thank you so much for sharing that. This was excellent. Again, I think there were so many lessons and concepts in here that I think many people are going to have to watch this multiple times. A few follow-up questions for you. Could you elaborate a little bit on the 620 charts? Because you mentioned the MU trade and that was your entry. And I think it's worth mentioning, focusing on, you were framing using the 620 charts at a spot where there was confluence of daily and weekly levels, right? It was at a key level. You're not just looking at an intraday chart and trading the setup in the middle of nowhere extended for the moving averages. It's when everything combines into the setup. It's like the last piece of the puzzle, right? So yeah,
Yes.
would you mind kind of explaining a little bit more the 620 charts? That'd be great.
Yeah, of course. So first of all, no one should use the 5-minute 620 chart as a setup. So it is literally a tool to kind of attempt to time an inflection point intraday, right? So again, you kind of have to take a multi-time frame approach to it. So, Brian Shannon's really good at kind of looking at multi-time frames. You always have to kind of find a setup on the daily chart before you zoom in and then try to time a trade and be more surgical with it. And so like going back to the MU trade, you have to had, multiple confluences on the daily chart. So you had like, the I believe it was the 50 SMA. So let me kind of go back to it.
And I love all the examples, by the way. Yep.
No problem. Yeah. So you had the 50 SMA, right? You had like the 20 EMA slightly below, and you had you had the market kind of like transitioning into an uptrend. MU was beginning to enter its RS phase, and then it was part of a theme. So you had the other three stocks, SanDisk, STX, WDC, all setting up in tandem. So all these are your edges and your kind of like setup on the daily chart, right? So like, your technical edge, your market edge, you have the theme, and so you had those couple of edges. So once you've had that on the daily chart, you see it kind of pulling back into the 50-day. You then zoom into the 5-minute chart, right? And then you kind of like watch it kind of like pull back into the moving averages. And then you see if price is kind of moving sideways and begin to inflect higher. And usually that coincides with, the 620 MACD kind of begins to cross to the upside. The moving averages begin to like flatten and slope up, and you're buying that turn, and then you're putting your stop. Either you could do it if you want tight stops, you do it at the low of day, or you could do an arbitrary kind of percentage below the low of day or something like that. Whatever is comfortable for you. So yeah, the point I want to bring across was like, always keep the daily chart set up in mind before you go into the 5-minute chart and then trying to time that turn. Because like one thing I've done in the past is like, oh, okay, 5-minute 620 chart, this sounds awesome, right? And I'm just like going into the 5-minute chart and I'm buying every single turn, but there was no setup. And then what happens is you will overtrade and you'll dig yourself into a hole. So that's the last thing you kind of want to do.
Yep. Perfect. I wanted to ask if there was one takeaway or concept that you want people to walk away from today learning. What is kind of the one concept that you think is most important from your presentation that you want to make sure people write down, right now and remember and take forward into their trading?
Yeah. I have two actually, but it's kind of closely related.
Fine. Yeah.
So the first one is best time to buy stocks after a market correction in an uptrend in a bull market. Okay, just remember that, and then go and study it. Confirm what I say. So don't just take it for face value. Actually study it. Study how stocks set up after a market correction, how they move, how they base, the price and volume cues, and then try to like fit it into your own strategy, right? Like, I buy pullbacks and I buy breakouts, and other people who buy pullbacks and breakouts may do it differently. So like when you study those charts, kind of envision and kind of like mark out where would you buy, where would you sell, build that muscle memory to kind of, when it happens next time in the future, you're ready to capitalize on it. So best time to buy stocks after market correction. Second thing is always view stocks in the lens of relative strength or relative weakness, right? So if there was one edge that you must have before you press that button to buy or sell, is relative strength or relative weakness, right? Because that is kind of like the sign that a stock is beginning to make its move and outperform. So you realize like why I like to have the TraderLion RS line on here is usually I kind of find that before a stock goes on a big move, like it would set up and then it will go into an RS phase. And that's usually my signal, like, okay, we're getting near to a point where we're going to go. Yeah. And so like, yeah, relative strength, relative weakness. Just remember that.
Perfect. And then I also wanted to ask you, throughout your trading career, what have been some resources, they could be books, they could be whatever, that have helped you personally, learn key concepts that obviously you have to go out and apply yourself. And there's a lot of lessons we have to learn actually trading. But what are a few resources that you would recommend to traders? Maybe they're 2 years, 3 years into their journey. They want to take this very seriously. What are some of the resources you point them to help them kind of speed up their learning curves?
Yeah, that's a good question. So a couple. So first, definitely it's hitting the books. So a couple of good books to start with. Mark Minervini's books are really great, to build that foundation in, risk management, progressive exposure, the concept of volatility contraction. So his books like Trade Like a Stock Market Wizard, and I believe it's like Think and Trade Like a Champion. Those two books I've read like numerous times in my beginning years. Definitely read How to Make Money in Stocks by William O'Neill, 4th edition. That's a book where I kind of began to find that I loved. Whereas in the past, I read the ones like, oh, okay, Can Slim, whatever, and then now I realize, oh, Can Slim, yes, that's the key. So How to Make Money in Stocks by William O'Neill. I like John Boyk's books a lot. So I think you had John Boyk on, a couple of times on the podcast. How Legendary Traders Made Millions. I think it's kind of like a very good, quick read in terms of market history. I personally really enjoy that read. And then Monster Stocks, kind of. So then you see like what are the characteristics of a monster stock that goes up thousands of %, right? I like the Trader Handbook by the TraderLion team. That's a very good one for to build that foundation.
Not paid.
And there are a lot of other
paid
books.
Endorsement. Yeah.
No paid endorsement. I have it right here. I paid for it. You didn't give it to me for free. Right here. Psychology wise, I really liked Mastering the Mental Game of Trading by Stephen Goldstein. So in that book, it kind of talks about why traders go on tilt, right? So it gives you the
death spiral, right?
The death spiral. You can't reset because every time you take a trade, you don't actually review it, and then you take another trade, and then like there's no like reset mechanism to bring you back into balance emotionally. So that's a very great book. The hour between dog and wolf.
Yep.
That's a really good one because it talks about the biological changes that occurs within you, in a raging bull market and in a brutal bear market. So like being aware of that, is quite important. Trade the Trader by Quinn Tatro. It's the one book I've kind of mentioned recently. Speaks about, beyond just technical analysis and, the whole mechanical bits and pieces of trading. It goes a little bit into, trading psychology, sentiment, and how like in the market, it's, you're not just trading the charts, you're trading other traders. So kind of like, especially for experienced traders, if they've traded different styles, they kind of have an idea of like what each style's pros and cons are. And from that respect, they can kind of trade the trader and make use of, that experience and the tendencies. So that book's a pretty good read. So those are the books. There are many others, which I could point to. Those are the main ones. There are a lot of communities, like Discord communities, that are awesome as well. So like I highly recommend, Ariel. So Real Simple Ariel. He's got an amazing Discord group, fantastic trader, is a great person. Shake, I believe you have on the conference this year as well. So Pinpoint Trading. Shake, open up more spots for more people, guys. Yeah. And then Uncharted Territory is a good one. Braco, Pat, and the rest of the crew. There are great communities to learn from. I think I'm missing one. People Wish. So DTR, that's a great one too. So yeah, like there are a lot of communities out there, fantastic traders that can speed up your learning curve, I would say. As compared to, like, for myself, it was really kind of reading the books, trading the markets, and going through a lot of pain myself, which you still have to go through. It's a rite of passage. But having a mentor really helps accelerate that learning curve and lessens the pain, right?
Yep.
So those communities are awesome. They're great. And then, your TraderLion YouTube channel, like there's so many interviews from top traders in competitions, fund managers. They share a lot of wisdom, go through everything. And then kind of in each interview, make sure you kind of study and jot down notes, figure out, like, with every single person, they trade the same strategy in a different manner because they have a different psychological makeup. You kind of look at it and think to yourself, like, what fits my psychological makeup, like what works for me. And then you kind of take bits and pieces of everyone and, like, make it your own, right? And that's kind of how you find your own edge. And then, of course, lastly, with X, right? Like, I know X can be a noisy place sometimes, but there are a lot of fantastic traders on X as well. So, like, lately I've been following Jay from the PBA. Dude, he's been killing it. I love him. Jeff Sun, he's amazing as well. Lone Stock Trader, Fred, and there are many more people, like Francesco. So nowadays, like in this day and age, there's just so many resources that can help you learn trading.
Yep, excellent. No, those are fantastic resources. And to your point about the Trading the Trader book, that's kind of like your when you went through the ARM chart, right? Your ARM trade, the first pullback, you notice, like, it's tightening up. It's a stubby base. It's not mature yet, but people are probably watching that gap down to support. You're trading the trader in that because you knew people would be watching that tight area, expecting a breakout and all that. So that's a good example of it. But Clement, thank you so much for your time. I think this is absolutely fantastic. To everybody watching, I hope you guys enjoyed. Leave a like down below, subscribe to the channel. Thank Clement in the chat for a great presentation. And Clement, again, thank you so much for your time. You're killing it, so thanks so much.
Thank you.
And appreciate you being here. Thanks so much for being part of it.
No, thanks for having me. I appreciate it, Richard.
Of course. All right, so we'll be right back, and we'll see you in the next one. Cheers.
All right, so that's it for day 3 of the 2026 TraderLion conference. Super excited once again to be building this resource every year. This is my favorite event, favorite time of the year. Helping traders, that's our mission, and this conference is a big way to do that. So first and foremost, let us know in the chat right now, what was your favorite quote or biggest takeaway from today? Who was your favorite speaker? And if you've got a couple, let us know in the chat as well. And first and foremost, a huge thank you to our presenters, our speakers. We couldn't do this without you. Every single trader who's presenting this year has brought their A game and has shared incredible information. So huge thank you to you guys. You guys are absolutely awesome. All right. So a few quick reminders to wrap up today. First, how to get the most out of the experience. Make sure you're subscribed down below. Join the VIP Pass to have every recording, resource, all of that organized in one place for you. It's completely free. You can scan the QR code right here or click the link down below in the description and pinned in the chat. Also, and you guys were great at this today, engage in the chat with others and with the speakers. And I want to see a bunch more of this. Share your notes, key takeaways on X. We'd love to hear what you thought, and we'll retweet and comment on every single note share that we see. Also, everything is recorded today, so feel free to scroll back in time on the same URL and rewatch your favorite presentations. And I'll go ahead and add timestamps, so it's very easy to jump back to a specific one. Here's a reminder once again to unlock your VIP pass, 100% free. You get the slides, resources, recordings as they're made available, and the link to that is in the description. A huge thank you again to our sponsors that are powering this conference: DFU, TraderLion, TradeLab. All of them have special deals going on right now. DFU, we have the summer sale. Visit dfu.com. TraderLion, we have the TraderLion University summer sale. Everything is 25% off with code SUMMER. So check out TraderLion.com/university for that. And for the TradeLab, if you're interested in my educational service, which includes my daily market report, as well as many educational resources and courses dedicated to you, basically just email me at richard@TraderLion.com, and I'll be sure to let you know the details about that deal. Again, we also have a bunch of TraderLion University free resources along with the masterclasses. So if you're looking to improve your process, this is a great place to build your foundation, from the ultimate screening guide to studies of historical corrections and how they bottom and transition to uptrends, the beginner's guide to stage analysis, the stage analysis model book. There's so many fantastic resources here. It's completely free. Just scan this QR code, create a few free accounts, and all of this will be available to you all in one place. Again, each year we partner with a charity to help, again, with this conference, not only help spread sound trading advice and knowledge, but also, partner with a great cause. So this year it's more personally meaningful for me because the cause is Parkinson's research. My grandmother passed earlier this year with complications from Parkinson's disease. It's a devastating neurological condition that affects, speech, movement, all of that, and impacts those who have it and their families. So if you found value today and haven't yet donated, any amount, even $10 is fantastic. It goes to a great cause, the Michael J. Fox Foundation for Parkinson's research. This is a very highly rated charity, very efficient charity where the proceeds really go towards the cause that they're for. I personally donated $1,000 already, and I challenge you to, give what you can and pay it forward for a great cause. So thanks again in advance. And here's a photo of my grandmother, as well as my mom and aunts. So thank you guys sincerely in advance. All right, another reminder to subscribe to the TraderLion channel if you haven't already. The link to that is down below this video. Make sure you're subscribed, 100% free, and you get the TraderLion podcast, in-person interviews, tutorials, free webinars, key clips, and much, much more. You can help us reach 200K, and 1 million is our goal. So help us get there. If you're not already subscribed and you like great trading education, definitely click that button. It's 100% free. All right. And with that, that wraps up day 3 and weekend 2 of the TraderLion conference. We'll be back next weekend with day 4 and 5. Should be a fantastic ending, and I look forward to seeing you guys there. Again, let us know in the chat who was your favorite presenter from today. What was your favorite moment? What was your favorite quote? And what do you think of the conference so far? Hopefully you guys are enjoying it and getting a lot of great takeaways. I know I have. So again, thanks so much for being a part of this event. You guys and the speakers help make this possible. So thanks so much for attending, for your time, and we'll see you at day 4 next weekend. Thanks so much, everybody. Take care. Bye.